Let's begin CMA Inter exclusive marathons for June 24 or December 24 exams. This video, this introduction of mine is going to be a common intro for all the CMA marathons. So here I just want to give a couple of instructions. Please kindly watch these instructions and then only start watching from the respective timestamp. Don't hurry up. I know you are thinking to skip this introduction and want to directly go and watch. Please have patience. If you want to succeed in life, you have to follow certain instructions. That instructions I'm going to give you. The first and foremost instruction, kindly watch these marathons at standard speed. Don't increase the playback speed. Please, when you are listening to the class, your purpose is not to finish the class. The purpose is to absorb something, to get something, to connect with the subject, to absorb something. Absorption is important. When you listen to the class at standard speed, you require very, very, very less time for revision. When you listen to the class at higher playback speed, you require lots of time for revision. Getting it? And when you listen the class at higher standards, higher playback speed, generally you will not get that command on the subject. Getting it? That's it. Now we are going to upload for all the CMA Inter, all the 8 subjects related marathons. So we will be uploading it from 11th of May onwards. Will be uploading for June exams. Even for December students also can absolutely use these marathons. So until May end, we will be keep on uploading whenever one marathon is completed, we'll be keep on regularly uploading. So P5, our faculty Subramaniam Sir will take this marathon, law, and Radhika Gelot from Pune. So she'll be handling industrial and commercial laws. Company law and ethics, Subramaniam Sir will handle. And P6, financial accounting, will be by Sai Babu Sir. By the way, you can just open our YouTube channel, see a Ram Harsha. Inside that playlist you open, you see the playlist, first playlist, CMA Inter June 24 marathons or strategies. So CMA Inter playlist you will find like this. So inside this preparation strategies, 3/4 preparation strategies. What is 3/4? Very simple. A student need not study 100% of the entire syllabus to qualify. In order to get 50, 55 plus, if you are very good at 3/4 of the syllabus, that's more than enough. So for every subject, the faculty has given guidance on which 3/4 syllabus you must be very strong at. So you watch that, you will understand. So, and coming to, by the way, in this marathon, we have used materials, right? These materials that we used in this marathon can be downloaded from Open Srestha CMA website. Inside the CMA Inter, you open PDF resources. Just click on the PDF resources, open CMA Inter. So below group 1, you just see here. So law, taxation related, accounts related, tax related, and cost accounting, everything, even marathon notes and all also. If at all we have a marathon notes, that also we will insert here. You will find it here. Getting it? So there you can download the materials. Financial accounting by Sai Babu Sir, direct taxes by Bhaskar Sir, IDT by Pavan Sir, cost accounting by Ganesh Bharadwaj Sir, and the same Ganesh Bharadwaj Sir will handle management accounting as well. Paper 11 part A, financial management by Funny Sir, analytics by Mahamood Sir, P10 auditing by Mahamood Sir, corporate accounting by Sai Babu Sir of our Srestha faculty, and operational management by Subramaniam Sir, who is actually handling corporate law, and strategic management by Harish Krishnan Sir. We will be uploading all these marathons as and when completed, and we try our level best to upload all these marathons, within this May month itself. Getting it? So make use of it. And even RTP videos also we will be uploading very soon for each subject. So just make use of these resources and do well in the exams. And while you're listening, just post your appreciation, whatever. After watching the marathon, please post your appreciation, whatever, as a comments, and like this video, especially importantly, because it will recommend to other CMS students as well. All the very best. Thank you. Continue watching, by the way.
Hello, my dear students. Hope you guys are all doing good, and I hope you guys are all doing your preparation as expected. Let me introduce myself first. This is Mahamood Sheikh. I'm a chartered accountant and also a cost accountant. I'm currently into practice, but I have been teaching this subject of auditing from the last 3 years to both CS students as well as CMS students. I'm very excited to bring this CMA Inter Audit Marathon before you. As we all are aware, the exams are approaching and I all know how much tensed you are all. So this marathon is definitely going to be a value addition in your preparation. So without any delay further, let us directly go into the discussion of the key concepts from this marathon. Right. So talking about the nature of the subject, as we all know, this particular subject audit is forming part of your paper 12, whose title is going to be Company Accounts and Audit. And as we all are aware, here auditing is only contributing for 15 marks. But this is the most ignored subject among the students because generally they have a misconception that this particular concepts are very dry in its nature and they feel it very theoretical, so they did not give much of the importance to it. But if you understand the concepts in a correct perspective, if you follow a approach in your preparation, definitely this subject of audit is also going to be a helping hand for you to score a good marks in your exams. So without any delay further, let us now start revising the marathon. First, let me put my objective very clear. So this marathon is going to be like a very quick revision. So if we have done one level of preparation, this marathon will revise all the key concepts from the entire subject, which have a high scope of getting tested in the exams, so that you will get very good marks in your exams. That's it, guys. Now let us start going into the marathon directly. So definitely the discussion will never be fruitful unless we don't have a proper introduction. So we'll be spending some time on introducing the content regarding this auditing subject. Then we will go into the concepts. And even this introduction is also not something which is out of syllabus. Definitely it is going to be forming part of our syllabus only, from where the questions will get tested. So let us start now. So it becomes meaningless if we start our marathon without revising the definition of the term audit. So how basically the term audit has been defined? So the term audit has been defined as it is an independent examination of financial information of any entity, whether profit oriented or not, and irrespective of its size or legal form. When such an examination is conducted with a view to express an opinion thereon. So this is how basically the term audit has been defined. So if we start highlighting the key terms in this definition, so you'll be able to realize that first of all, an audit is an independent examination. And the next key term in this definition is financial information. Then they are saying something called whether or not profit oriented, irrespective of its size or legal form, when such an examination is conducted with a view to expressing an opinion thereon. So, if we understand the significance and meaning of the terms which I have highlighted in the definition, then the definition of the audit becomes very much clear. So, let us try to understand individual concepts of this definition so that our entire definition will start making some sense. So, starting with the definition says an audit is an independent examination. So what basically happens in the audit is we are examining. Examination in the sense verification. Even we can call it as checking. So what we basically try to do in the audit is we are examining, we are verifying, we are checking. And that examination is not an ordinary examination. That examination is going to be an independent examination. So basically, what is the meaning of the term independence? We hear this term a lot and it is having different meanings. But when it comes to the auditing context, the term independent means free from influence. That means we should not be changing our decision according to others' belief. If we find something as correct, we should say it as correct. If we find something as wrong, we should say it as wrong. We should not be changing our opinion, keeping other person's perception in mind. So that ability of a person to take a decision without any influence from the other parties, that we call it as independence. So in simple terms, if I have to put it, free from influence. So what basically happens in the audit is we are examining something, that is we are verifying something, we are checking something. And that examination process we are going to carry out independently without any influence from third parties. That means we should not be changing our decision according to other person's wishes and directions. So in such an independent manner, we are examining. And what is the thing that we are examining? That is addressed by the next part of the definition. So if we go to the next part of the definition, independent examination of financial information of any entity. So what is the thing that we are independently verifying? So the definition says that we are going to independently examine the financial information. So now what is financial information? So basically, financial information means not just financial statements. Financial information means financial statements. And if you add to that the source for the preparation of the financial statements, which is nothing but going to be books of accounts. So the financial statements, which comprises, if you go by the definition of the Companies Act, it is an actually inclusive definition. So financial statements includes balance sheet, statement of P&L, cash flow statement. It includes statement of changes in equity, and it even includes notes to accounts. So all these five items put together, we call it as financial statements. So what are the five items included in the financial statements? Balance sheet, statement of P&L, cash flow statement, statement of changes in equity, and also notes to accounts. And to this financial statements, if you add the source for preparation of financial statements, see, basically in the balance sheet, we know that we will prepare the financial position. Like if you take the balance sheet like this, so it will have fixed assets, it will have current assets, it will have shareholders funds, it will have liabilities. So all these things will be there. Now, from where we have taken these figures from where the fixed assets value has been derived, from where the current assets value has been derived, where we are getting the source for all this information. So that is basically we get it from books of accounts. So financial information basically means financial statements along with the books of accounts. That collective information, we are going to call it as financial information. So now if we read the definition, they say that audit is an independent examination of financial information of an entity. So what we basically try to do is we get the financial statements of an entity, we get the books of accounts of an entity, and without any influence, we try to examine them. Then coming to the next part of the definition, whether or not profit oriented. Very important term. They are saying whether or not profit oriented. When they say whether or not profit oriented, what does that signify? That signifies that the entity whose financial information that you are verifying, is that a profit making entity, is that a non-profit making entity, that doesn't make any difference. So basically, if you take any kind of entity, we can broadly divide them under two phases. One is a profit making entity. Most of the examples which we have today, like if you take Reliance Industries Limited, Infosys, Tata Group of companies, everybody have been created with the intention of making profits. So most of the entities are profit making entities. But there are some exceptions also. Even we have some entities which are not existing solely or exclusively for the purpose of making profits. Like if you take places of religious worship, charitable institutions, old age homes, orphanages, these are all entities which are not created with the intention of making profits. So basically, there will be non profit making entities also. Now, when they say in the definition whether or not profit oriented, what does that mean? Means the entity whose financial information that you are verifying, is that a profit making entity or is it not making a profit? All that things are irrelevant. Now, talking about the next part of the definition, irrespective of its size or legal form. So, two more things they are using here in the definition. One is size, other one is legal form. Now, what is this? And they say irrespective of size or legal form. Let us address both the items here separately. Talking about size. See, in India, we have the biggest value, the top conglomerate in our country, as we all know, Reliance Industries Limited, which is having on a consolidated basis a total turnover of 6 lakh plus crores. And not all the companies are of equal size. We have some companies in our country which are incorporated, which might hardly have a turnover of 1 crore also. So on one hand, we have the top conglomerates of our country, like Reliance Industries Limited, which is having 6 lakh plus crores of turnover. Whereas on the other hand, we will have even small companies also, which will have a hardly turnover of 1 crore. Now, when they say irrespective of size, what does that mean? They say that even size also doesn't matter. Size of your client also doesn't matter. Which means if I go and conduct the audit of this Reliance Industries Limited, there I will be doing independent examination of financial information. If I am conducting audit of so and so company X Limited, which is a very small company having a turnover of only 1 crore rupees, there also my scope doesn't get changed. There also, if I am getting appointed as an auditor, I will do independent examination of financial information only. So size of the entity for whom I am doing audit, that doesn't have any impact on audit. So irrespective of the size means that. And one more term they are saying, legal form, irrespective of legal form, which means a legal form of the entity also doesn't matter. First of all, what basically is a legal form? When we say legal form is nothing but legal constitution which you are giving to the organization. How your entity is legally recognized. Like if I want to carry out the business, if I have all the capital with me itself, I can create simply a sole proprietor. If I want to take the help of my friends who are ready and willing to contribute the capital and also they are ready to share profits and losses, I will take up the form of partnership firm. If I want to carry out my business at even higher volume and also higher extent of transactions in future, I have an intention of having access to the public funds also, then I will create a company. So these are all nothing but the legal structure which I am giving to my entity. So that constitution, that status, how your entity is recognized, that we call it as a legal form. So now they are saying that irrespective of legal form, which means even legal form also doesn't matter. So whether your client is a company, whether your client is a partnership firm, whether your client is a sole proprietor, whether your client is a society, whether your client is an LLP, all this will not going to change my entire objective of the audit. So if I do a audit of my sole proprietorship business, I will do independent examination of financial information. If I do an audit of a partnership firm, there also I will do independent examination of financial information. If I do a audit of a company, there also I will try to independently examine the financial information only. It is not going to have any significant impact on my audit. This is what the meaning of irrespective of legal form. Now, if we read the definition once again from the beginning, I hope till now, till this part, the definition has become clear. So if we read it once again, an audit is independent examination of financial information of any entity, whether profit oriented or not, irrespective of its size or legal form. So basically what I'm trying to do in the audit is I'm independently examining financial information of an entity. Is that profit oriented or not? Is it big company or small company? Is it a, what is its legal form? All that doesn't matter. Sir, now what is the ultimate purpose of doing all this independent examination? If I am doing this activity, that means there should be some ultimate objective. No, I'm not simply doing it for time pass. So what is the ultimate objective here? So that is addressed by the last part of definition. When such examination is conducted with a view to express an opinion thereon. So why basically we are all doing this independent examination of financial information? So we are going to do it with a view to express what? Express an opinion. On what? On what I'm going to express the opinion? What is the thing that you are independently verifying? You are nothing but independently verifying financial information only. So on what I will express my opinion? On the same financial information I will express my opinion. When we are doing any activity, there should be some ultimate outcome of out of it. Even for audit also, there should be some ultimate outcome, and that ultimate outcome is expression of opinion on financial statements. If you take any opinion on this world, that can be broadly divided into two categories only. One is basically a positive opinion, one is negative opinion, or even you can say one is a good opinion, other one is a bad opinion. So now what is this good opinion? What is this bad opinion? Like if you take for example, I have given you some food to taste it and tell me your opinion. What you will say, if you like the food, you will say, yes, the food is tasting very good. If you doesn't like the food, you will say that the food is tasting very bad. So simply a positive opinion or negative opinion. Or if your friend asked you some opinion about his dress, how the dress looks on your friend, what you will say? If you like it, you will say, yes, the dress is looking good on you, or you will say the dress is looking very bad on you. So either a positive or negative opinion. Even when it comes to opinion in an audit, there is no exception. In the audit also, either there can be good opinion or there can be a bad opinion. So what do you mean by good opinion? That is, you have verified financial information, and after verifying the financial information, if you are satisfied that whatever information that has been presented in the financial statements, be it financial position, profitability, cash flow statement, whatever it is, whatever information that has been presented in the financial statements, whether it is giving true and fair view, what we need to express our opinion regarding whatever information that is getting presented, where it is getting presented in the financial statements, it is getting presented. So whatever information that is getting presented in the financial information, whether that is giving true and fair view, that means that information should be presented in a proper manner, that should not be misleading, that should present only that information which has actually happened, and you should not try to mislead anybody through these financial statements. So if after verifying all the financial information, if I am satisfied that yes, this financial information is not misleading, it has been presented in a proper manner, it is giving true and fair view, then I will express a positive opinion. Whereas if I came to know that financial information, they are trying to convey wrong information, like either the profits have been overstated or understated. The actual profit was only 100 crores, but the management is trying to show 120 crores in the financial statements. Whereas assets are understated, actual assets are 1000 crores, but the management is trying to show it as only 900 crores. Whatever it is, when I say misleading, the misleading can happen in any of the ways. So if the financial statements, if the financial information is misleading, if it is giving wrong information, if it is conveying wrong information, then I will give negative opinion, bad opinion. I will say financial statements are not giving true and fair view. So like any other opinion in this world, even auditor's opinion also will be of only two types, either a positive opinion, that is a good opinion, or a negative opinion, that is a bad opinion. So actually there are technical names assigned to it, which we will try to talk about in our further chapters. So this is what basically the entire definition of audit is. So if we read it once again, the definition of the audit, so how they have typically defined it, an audit is an independent examination of the financial information of any entity, whether or not profit oriented, irrespective of its size or legal form, when such an examination is conducted with a view to express an opinion thereon. So by now, I hope so you all would have memorized the definition of audit. And basically, few more things here. The term audit has been derived from Latin words audire. This is actually the roots. The term audit has been taken from the Latin word audire, which means to hear. So in early days, what used to happen is people used to hear the explanations and they used to confirm it. But today, as we all know, hearing is not the only way of verification. We can actually go and check the documents and all that things. So this is what regarding audit definition. Now, basically, I have a doubt going on in my mind. Let me put it before you. So, I am saying that auditor will verify financial information. So, basically, what is audit? Who is auditor? We understood the definition of the term audit. Then, who will be auditor? Auditor means simply a person whoever does the audit. So, audit is a process of independent examination. So, whoever is doing that independent examination, that person we call him as auditor. So as we said, auditor is going to examine the financial information. Now, who is going to prepare this financial information? If you take some company, assume I am conducting audit of Reliance Industries Limited. If I am conducting audit of Reliance Industries Limited, just now as I have told, I will go there and independently examine the financial information there. But who would have prepared the financial information? Who will basically prepare the financial information? I told financial information means nothing but financial statements along with books of accounts. Will the auditor also prepare this? No, auditor will not prepare this. Then who will prepare this? It is always going to be the responsibility of management of the client. The preparation of financial statements is always and always responsibility of whom? Management. Whereas what is auditor's responsibility? He is just going to verify whether the financial information is given true and fair or not. We have to be very clear about this. Auditor will never prepare the financial statements. Basically, what is auditor's duty? What is the process actually is? Financial information will be prepared by management, and auditor's responsibility is just to go and verify it. That's all. Never be under a misconception. Auditor also will prepare financial information. No, his responsibility is restricted only for verifying or examining the financial information. So this is what basically the definition of audit is. This is what actually happens in the audit. Now let us come to the next part. What are objectives of the audit? So just now as we have seen, the objectives of the audit are basically to express an opinion. Audit will be basically done to express an what? Opinion. And this opinion has to be expressed on two matters. One is, first thing on which you have to express an opinion is whether financial statements are free from material misstatements. Number two, whether financial statements are prepared as per applicable financial reporting framework. So these are basically two objectives of the audit, whether financial statements are free from material misstatements and whether they are prepared as per applicable financial reporting framework. Let us try to understand these objectives now. Now, once again, we are coming across two more difficult terms or new terms. Once we understand these two terms, obviously the definition is going to be these objectives are going to be very clear. So what are the two complicated terms which we are coming across? One is material misstatements, other one is something they are saying applicable financial reporting framework. So let us try to understand them. So coming to the first one, whether financial statements are free from material misstatements. So let us try to understand now the phrase called material misstatements. If we understand it, first objective will be clear. So what is basically a misstatement? If I have to define it in simple sense, misstatement means a mistake in the financial statements. So that has been given technical name called misstatement. But in simple norms, if I have to put it, a misstatement means what? Simply a mistake in the financial statements. But as we know, things doesn't work in a simple way. This term has been defined technically, the term misstatement. So how that has been defined? It is defined something like, it is a difference between amount, classification, presentation and disclosure which is there in reported financial statements and amount, classification, presentation, disclosure required as per applicable financial reporting framework. If there is a mismatch between the two, that we call it as misstatement. So how the term misstatement has been defined? So if we read it in the material, yeah, if you could see it here, the difference between amount, classification, presentation, disclosure, which is there in reported financial statements, and the amount, classification, presentation and disclosure required as per applicable financial reporting framework. So what they are trying to say, once again here, reported financial statements, they are saying reported financial statements means, as the name itself says, the financial statements which are already prepared. Who would have prepared them? Just now as I have told, management. So the financial statements which are already prepared by the management, and there is a difference in the applicable financial reporting framework. So now it becomes necessary for us to know what is applicable financial reporting framework. So very lengthy phrase actually. What we will try to do is we will divide and understand it. First of all, talking about framework. Framework means what? We hear about this term a lot. Framework means simply a set of rules and regulations. Whereas financial reporting means the process of preparation and presentation of financial statements. So framework means set of rules and regulations. Financial reporting means preparation and presentation of financial statements. So if we combine both, financial reporting framework, which means what? The set of rules and regulations which are required to be followed in the preparation and presentation of financial statements, that we call it as financial reporting framework. So when the management is preparing financial statements, as we know, they can't do it as per their own wishes. There are some set of rules and regulations which they have to follow. Like if you are preparing the financial statements of a company, the management has to follow Schedule 3 and accounting standards. So Schedule 3 and accounting standards are basically nothing but set of rules and regulations which are followed by the management in the preparation of financial statements. So we'll simply call it as Schedule 3 and accounting standards as a applicable as a financial reporting framework. Now they're saying applicable financial reporting framework. Now, what is this financial reporting framework and how does that differ from applicable financial reporting framework? Let us try to understand it. So, applicable financial reporting framework means, as I have told, the management of the organization when they are preparing the financial statements, depending on nature of organization and purpose of financial statements. What they are saying, the management while preparing the financial statements, depending on nature and purpose of the financial statements, the management themselves will adopt which set of rules and regulations they have to follow. That itself we are going to call it as applicable financial reporting framework. So what does that mean? So take for example, if the management of Reliance Industries Limited, if they are preparing financial statements, keeping in mind the nature of the company, what nature of the entity, what is the nature of the entity company here? They have decided that they will follow Schedule 3 and accounting standards while preparing financial statements. So Schedule 3 and accounting standards is an applicable financial reporting framework for Reliance Industries Limited. Who adopted it? The management adopted it. Now, the management of SBI while preparing the financial statements, keeping in mind the nature of the entity. What is the nature of the entity? It is a banking company. So they have decided that they will follow Banking Regulation Act in the process of preparation of financial statements. So now Banking Regulation Act becomes applicable financial reporting framework for SBI. LIC, while preparing the financial statements, the management, keeping in mind the nature of the entity. What is the nature of the entity here? It is an insurance company. So the management has decided they will follow IRDA Act in the preparation of the financial statement. So it becomes applicable financial reporting framework. So if we have a look at the definition of applicable financial reporting framework, so like if you see here, financial reporting framework means set of rules and regulations that are required to be followed where in the process of preparation and presentation of the financial statements, that we call it as applicable financial reporting framework. Example, Schedule 3 and accounting standards. Who will decide it? Basically, in view of nature of the entity, who will decide? Management themselves will decide which will be applicable financial reporting framework, what set of rules and regulations they have to follow. Now this makes our second objective clear. We are trying to understand first objective, but in that process, since we understood what is this applicable financial reporting framework, now if we read the objective, so auditor shall express an opinion whether financial statements are prepared as per applicable financial reporting framework. Like if I am conducting audit of Reliance Industries Limited, I will check whether the management has prepared the financial statements as per Schedule 3 and accounting standards or not. If I am conducting audit of SBA, I will check whether the management has followed Banking Regulation Act or not. If I am conducting audit of LIC, I will check whether they have followed IRDA Act or not. That is one of my objective, auditor's objective, to verify, not to decide. Selection is management's responsibility. So this is the this is the second objective. Now, where we started this discussion, we have started understanding something about the term called misstatement. So how they have defined in that they are using the phrase applicable financial reporting framework. Now we understood that. Now let us try to understand what is the meaning of the misstatement. So how the misstatement has been defined? It is a difference between amount, classification, presentation and disclosure which is there in reported financial statements, and the amount, classification, presentation, disclosure required as per applicable financial reporting framework. Now what they are trying to say, that means let us talk about amount. you came to know that management in the financial statements, they have recognized the revenue as some 10 lakh rupees. Whereas applicable financial reporting framework, some accounting standard like AS 9 says the revenue figure should have been 11 lakhs. So applicable financial reporting framework is trying to say something, that is accounting standard is saying you have to recognize a revenue of 11 lakh, but your client has recognized only 10 lakhs. Difference, this we call it as misstatement. Or sometimes there could be a difference in classification. Assume some applicable financial reporting framework, some accounting standard wants you to treat certain expenditure as a capital expenditure, but what the management they have done in the financial statements is they have treated it as a revenue expenditure. Difference in the classification, this also we call it as misstatement. Or sometimes there can be a difference in presentation also, like schedule 3 will ask you to prepare the financial statements in a vertical format, but management has followed the T format of the financial statements. So here there is a difference in presentation. This is also a misstatement. Or sometimes there could be a difference in the disclosure also, like some schedule 3 is asking you to give some disclosure regarding related party transactions, but the management did not give that disclosure. Or schedule 3 is asking you to give some explanation in the notes to accounts. Disclosure means basically an explanation in the notes to accounts. So notes to accounts means whatever information, whatever explanatory information that we presented in the financial statements, that we call it as notes to accounts. Sometimes there could be a difference in the notes to accounts also. A misstatement need not always happen. A mistake need not always happen only in balance sheet, only in the P&L, only in the cash flow statement, or only in figures and amounts. Basically, when we say mistake in the financial statement, we generally assume that some amount is overstated, some amount is understated, profit is wrong, assets are wrong. This is what comes to our mind. But basically, misstatement need not always be a quantitative figure. Sometimes a mistake can even happen in notes to accounts also. So what is basically notes to accounts? Nothing but an explanation. Like if we check some copy of the financial statements of some company, so let us have a look at it. So if we have a look at Reliance Industries Limited annual report, let me show it before you. So it's getting downloaded. So we'll have a practical understanding. Yes. So this is basically annual report. So let us directly go to see every listed company's financial statements. We can download it free of cost. Why? Because listed company will have a mandatory obligation to upload their financial statements in their official website. So that is where even I have downloaded from. I have simply Googled it. So just let us go to financial statements. So this is how typically a financial statements of the company will look like. We are saying the Reliance Industries Limited financial statements. So first, as usual, we have here balance sheet, and immediately after the balance sheet, we have something called statement of profit and loss. Then we have something called statement of changes in equity. Then we have statement of cash flows, as we know. And then finally, we have notes to accounts. So I was saying notes to accounts. No, what is there in the notes to accounts? It is not simply working notes which you show in the preparation of financial statements in your accounts. Notes to accounts is actually much bigger information. So if you see here in the notes to accounts, they will give detailed explanation regarding the items which are there on the face of the balance sheet. Like if we go here, so you are able to see that there is a inventory. So if you see the current assets, there is a here. Here, if you find inventories are there 45,923. I want to know breakup of this inventory. So what I can do is I can go to note number 6. So now if you go through the notes below, you will be able to find one note with the note number 6. In that note number 6, you will be able to find the breakup of 45,923. So not just that, for every item of P&L, balance sheet, and what accounting policy, see all these notes and accounts, all these are notes to accounts only. What accounting policies you have followed, what accounting standards you have applied, what is the accounting treatment, detailed explanation to the information in the notes to accounts. So all this is nothing but the information which is there in the notes to accounts. Like for example sake, if I show it to you here, so as we have seen somewhere, inventories. So if I go to here, see here, inventories are there. This is what the figure which we are able to see it on the balance sheet, 45,923. Now this is the breakup actually. Raw materials are 16,325, work in progress 9,479, and finished goods are so much amount. So like this, notes to accounts is a very detailed information, but most of the people ignore it. When we say financial statements, they generally misunderstand it as it includes only balance sheet P&L. Not exactly. It even includes notes to accounts also. Now let us come to the definition of the misstatement. So the misstatement means what? There is a difference in amount. There could be a difference in classification. There could be a difference in presentation, or even there could be a difference in disclosure. Between what and what? In the financial statements which the management has prepared and the applicable financial reporting framework. That means applicable financial reporting framework is expecting you to follow something, but management is following something else. Some accounting standard is expecting you to show some amount as something, but management is following something else. This simple difference only we call it as misstatement. Now you tell me, misstatement means nothing but what? In simple terms, a mistake in the financial statements. That itself they have tried to give it in a complex definition. Clear? Now talking about further regarding this misstatement, a misstatement in the financial statements can happen because of two reasons. So misstatement could be either error or it could be fraud. A misstatement can happen from error or even it could happen from fraud. So what is basically an error? The differentiating factor between the two is error is something which is always unintentional, whereas fraud is something which is always going to be intentional. So if you do some act intentionally, knowingly, willfully, that we call it as fraud. On the other hand, if something happens by mistake, that we call it as error. That is what basically the differentiating factor between the two. So a misstatement in the financial statements can happen because of fraud also. It can happen because of error also. So which one is a more matter of concern? Fraud is always the most important matter of concern. Why? Because it is always done intentionally with a view to deceive others. So like if we see the differences here, error versus fraud differences. So error is something which is always unintentional, whereas fraud is something which is always what? Intentional. And impact, whose impact is very serious? Fraud impact is very serious when compared with error. Errors happen something by mistake, so it might not be that much bigger element which require you to pay attention, but since fraud is done always intentionally, that is always going to be a matter of our concern, so we have to be very serious. The impact is very serious. Involvement, who will do fraud? Generally low level or high level, anybody can do the fraud. When you want to show wrong information, when somebody wants to commit a fraud will be generally committed by low level employees also, or it could be committed by high level employees also. Like if a cashier is stealing the money from the cash box, that is a fraud simply committed by one of the low level employee. Or on the other hand, if you take the scam which has happened in the recent times, Punjab National Bank scam, PNB scam, there even top level management are also involved, board of directors are also involved. So fraud will be basically committed by higher level management also, or even lower level employees also. But when it comes to error, it is always committed by low level employees. Generally we expect low level employees like accountant, cashier, these kind of people to do errors, unintentional things. Liability, when error has been noticed, the person will undergo civil liability, nothing but some sort of fines, penalties will be there. But if a person is charged with the fraud, if someone has committed fraud and if it was found out, the liability is going to be criminal liability like imprisonment, all these things will be there. So these are the points of difference between error and fraud. So this is what the meaning of the misstatement. So why we came to this misstatement, this term misstatement? Why? Because our discussion started somewhere in the objective. So what they are saying, first objective, whether the financial statements are free from material misstatements. Now they are not simply using the term misstatement. Instead, they are using the term material misstatement. Now what is this material misstatement? So material misstatement we understood. Now what is material? The simple meaning of the term material is, in common parlance, if we have to put it, we can call it as something which is significant or something which is important. So material misstatement means the misstatement which is significant or important. They are saying we should not be concerned with each and every kind of misstatement, each and every small fraud we should not be concerned. Take Reliance Industries Limited itself. The company is having crores of turnover. In that company, 1 crore rupees of fraud or error happened. Will we be concerned about it? Will we dedicate all our team to investigate on that 1 crore rupees of fraud? Not basically. Why? Because comparing it with the size of the company, comparing it with the turnover of the company, this is not at all significant. This is not at all material. But there is no thumb rule how to decide materiality. Why? Because materiality is all a relative term. Whatever is material in all the circumstances that we can't decide it. In some cases, like for example, in Reliance Industries Limited, I told 1 crore is not material. Now assume that this 1 crore misstatement has happened in a company called X Limited, where the amount of misstatement is 1 crore, but the turnover of the company itself is 10 crore. So now what will happen? Now the same 1 crore will become material. So there is no hard and fast rule how to decide what is material, what is not material. It all depends on various factors like size of the entity, facts and circumstances. So many things are going to involve in that decision. So that is what the meaning of the term material. And if we have to define it, the standard says that if you have to look at the definition of the term material, like if we see it here. So material, here if we observe, material means basically significant or important. A misstatement will be considered as material if it influences the decision of users of financial statements. So what they're simply trying to say, if any misstatement, if any mistake is going to influence decision of user of financial statement, if some users definition is getting affected because of some misstatement, that only we call it as material. Now they are saying users of the financial statements. As I have told, management will prepare financial statements, but who will use the financial statements for? Who and all are the users of financial statements? If we talk about users of financial statements, the users are so many, like shareholders. They want to know about profitability and performance. That could be management. They use that for their decision making purposes. They could be government. Why? Because from that they will determine whether taxes have been paid promptly or not, or they could be some creditors or bankers to decide your loan repaying capability. Like this, users can be plenty. If any misstatement is influencing decision, if any misstatement is causing the user to change his decision, that only we call it as material. Assume I'm a shareholder, prospective shareholder. I want to invest my money in the Reliance Industries Limited. I want to invest my 1 lakh rupee. Just before I can do the investment, then only I came to know that actually there is a 1 crore rupees of fraud happened in Reliance Industries Limited. Will I stop myself from investing? Need not be. Why? Because being a shareholder, I will think that out of 6 lakh plus crores of turnover of a company, 1 crore doesn't matter at all. I'm not saying there is no misstatement. There is a misstatement, agreed. But that is not influencing my decision. That is not going to have any significant impact on my decision. So that's why I call it as immaterial. So that is how the term materiality has been defined. So what does the term say? If it influences, if it changes the decision of users of financial statements, that we are going to call it as material. This is what basically the first objective is. Now if we try to read both the objectives, now the objectives have become very clear. So the objectives of auditor are to express an opinion on what, whether financial statements are free from material misstatements and whether they are prepared as per applicable financial reporting framework. Now auditor will verify for both these things, and if he is satisfied with both the things, he will give a positive or a good opinion. If he is satisfied with, if he is not satisfied with either of the things or both the things, then he will give something called a negative opinion. So that is what basically the objectives of auditor are. So with this, we have covered all the key concepts of the introduction. Now it's time for us to go and understand the contents of the first chapter, which is regarding nature, objective, and scope of audit. Nature, objective, significance, and scope of the audit. So let us try to understand some key concepts out of it. First of all, what we will try to do is, since we understood the basic discussion regarding audit and what actually happens in the audit, now let us try to first understand how the terms, how the concepts of auditing and accounts differ. What are the differences between auditing and accounts? See, there used to be a saying that auditing starts when the accounting ends. This is what used to be the popular phrase. So accounting means what? Accounting is basically preparation of financial statements, maintenance of books of accounts, and also preparing trial balance, ledgers. All this collective process, we call it as what? Accounting. Whereas auditing is something which will start after the accounting process gets completed. That means once you have prepared the books of accounts, once you have prepared the financial statements, and after you have completely given the final copy of the financial statements, then audit process will start. So what basically are differences between auditing versus accounting? Let us try to revise it quickly. Then we will try to proceed with the further aspect. So like if we see here, we have a dedicated question. So accounting versus auditing. So if we see here, accounting is basically collection, classification, and also summarization of data for preparation of books of accounts and to make the financial statements. That means the process of collecting the information, classifying the information, summarization in the form of preparation of financial statements and balance sheet. This entire process we call it as accounting. Whereas what actually happens in the auditing, it is an analytical and critical examination of books of accounts. In audit, we will not prepare anything. Instead, what we do, whatever financial records which are already prepared, that we are going to examine it in a critical manner. Next, what is the time of happening it? Basically, accounting will happen as and when the transaction occur. Like for example, today I am making revenue. When I will record the accounting entry, today itself I will record. If I am making a sale, when I will record immediately at the time of occurrence. If I am doing a purchase, when the accounting will be done at the time of making the purchase. So accounting is something which will happen at the time of occurrence, whereas auditing is a post-mortem activity, which means after the financial statements are prepared, after the books of accounts are prepared, then I will start doing audit. So that's why we say audit is a post-mortem activity. That means after completion of a process, after completion of some transactions, then audit we will start. Then it measures, accounting basically measures business events in monetary terms. In accounting and financial statements, we are all basically concerned with the amounts. What is the amount of profit? What is the amount of assets? What is the amount of the liabilities? What is the amount of loss? What is the cash flow? So in accounting, we measure business events, that too in monetary terms. Monetary terms means in the amounts and values. Whereas what in audit we do? Audit reviews or verifies financial records to form an opinion on authenticity, genuinity of the financial statements. As I was saying, true and fair. So basically, we do the audit to establish whether the financial statements are genuine or not. Then it is whose primary responsibility? Accounting is always the responsibility of management, whereas auditor is an external person. Management is someone who run the business, so it is a primary responsibility of management themselves who run the business, whereas auditor is an external person, an outsider who will come inside the organization, verify the financial statements. So auditor is an independent person appointed by the entity to review financial statements, whereas accounting is whose responsibility? Management's responsibility. And an accountant is not expected to review or report. Accountant is not preparing any report. Accountant is not reviewing or checking anything. He is not expected to do any kind of review. But auditor, after completion of all his audit, I told his ultimate objective is to express the opinion. No. Now, how that opinion will be expressed? In the form of a separate report. That itself we call it as audit report. So auditor will give audit report, but accountant will not give any report. He is not doing any review, whereas auditor is doing review. His ultimate objective is to express the opinion, and he will express that opinion in the form of a written report. Next. So an accountant, if an accountant is there, basically for whom he will work? For the management he will work. Now auditor, for whom he will work? He will not work for anybody. He is an external person, come and do the audit, express the opinion, give it to the shareholders and relevant stakeholders. So auditor is an independent person accountable to owners or shareholders, not to the management, whereas accountant is always responsible to management. Then in certain circumstances, auditor would be held liable to third parties also. If something goes wrong in the auditor's opinion, if you give wrong opinion, in some circumstances you will be made liable to the third parties. No such liability generally exists in accounting. Then, do you think accounts are mandatory? Not basically. Maintaining accounts are also not mandatory. Like if you go through Income Tax Act 44AA section says that only some entities are required to maintain accounts. So maintenance of accounts may not be mandatory. One basic example is section 44AA of the Income Tax Act. And whereas some companies, whereas some other laws, like if you take Companies Act. Companies Act 2013 says every company should maintain books of accounts. But when it comes to partnership firm or sole proprietor, generally they are not required to maintain books of accounts. Whereas for every entity which is maintaining books of accounts, all that entity need not undergo their accounts audited. Like we have under Income Tax Act, which says subject to fulfillment of some conditions, then only audit will become mandatory for the for the sole proprietor or partnership firm. Whereas Companies Act says audit of companies is mandatory. So there is no one rule which we can say accounts is mandatory for every company or auditing is a mandatory for every company. No. It depends on applicable laws and regulations. For some companies, accounts, for some entities, accounts are mandatory. Same with the audit also. As per some sections, as per some laws, audit is mandatory for some entities, audit is not mandatory for some other entities. And what is the scope? Accounting work is determined by Ind AS accounting standards. Basically, we are doing the audit, we are preparing financial statements. Like in financial statements, one of the important item is inventory. How do we value how do we value inventory? As we know, a general rule, inventory should be valued at cost or NRV, whichever is lower. Who told us to do this? Accounting standard has told us to do this. So like this, and we need to follow three fundamental accounting assumptions like going concern, accrual, consistency. Who told us this? Same. Once again, accounting standards has told us to do this. So accounting will always be done as per the principles of Ind AS or accounting standards. Whereas for auditing, we once again have separate series of standards which are nothing but the standards on audit. So accounting will be done as per accounting standards, whereas auditing will be done as per auditing standards, which we generally call it as standards on audit. This is how the functions auditing and accounting basically differ. Both are two different concepts. And as I've told you that important phrase, auditing starts when the accounting ends. So this is what the major differences between accounts and audit. Now coming to the next thing, as I have told, is audit mandatory for all the entities? Basically, no. So now on the basis of requirements of law, audits are broadly divided into two categories. One is statutory audits and the other one is non-statutory audits. So the requirements of the on the basis of requirements of law. First, one general statement is audit is not mandatory or compulsory for every kind of business, for every kind of legal form. Depending on requirements of law, audits are classified into two categories. One is statutory audit and the other one is non-statutory non-statutory audit. As the name itself says, statutory. What do you mean by statutory audit? Statutory audit refers to those kind of audits which are mandatory under any law for the time being in force. So statutory audits are those audits which are mandatory under law. Then what will be the non-statutory audits? Those audits which are non-mandatory, not compulsory, which are just going to be voluntary audits, which the clients are getting it done on their own. That we call it as non-statutory audits. So now examples of statutory audits are what kinds of audits are mandatorily required under law? Very simple. The Companies Act says that the audit of every company is mandatory. So company audit is a statutory audit. Tax audit will be required in some cases as per Income Tax Act. That is a statutory audit. GST audit will be required in some cases. That is also a statutory audit. Bank audit is mandatorily required under law. That is also a statutory audit. So those audits which are mandatorily required under law, that we call it as statutory audit. Whereas when it comes to non-statutory audits, which are not mandatory, which are voluntary, out of the client's own choice is getting the accounts audited. Like if I give you some examples for this, sole proprietors audit, it is a non-statutory audit. Partnership firms audit, it is a non-statutory audit. So like this, even though there is no voluntary requirement, but still if the clients are getting their accounts audited on their own, that we call it as non-statutory audit. So this is what the basic rule of thumb, basic difference between statutory versus non-statutory audit. Now, coming to the next part. Sir, if it is a statutory audit, who will decide objectives, scope, etc.? Scope and objectives of the audit, who will decide? Respective law itself will decide. Whereas when it comes to non-statutory audit, scope and objective will be decided by the appointing authority, those whoever has appointed you. Like for example, if the sole proprietor is appointing you, he will come and say, what you are supposed to do in the audit. Whereas when it comes to statutory audit, like if you are doing company audit, what is under which law the company audit is mandatory? Under Companies Act. The Companies Act itself will say what you should cover in the audit, what you should not cover in the audit. Whereas in the case of non-statutory audit, since there is no governing law itself, that will be decided by the person whoever is appointing you. So this is what when it comes to objective and scope. So one is mandatory, other one is non-mandatory. So objective and scope will be decided by law. Objective and scope will not be decided by any law. Your appointing authority himself will decide. And talking about qualities and all, who can be appointed as statutory auditor? Statutory audit should always be done by a qualified person, like a chartered accountant, cost accountant. Only a qualified person can do the statutory audit. But when it comes to non-statutory audit, there is no specific requirement of qualification. Anybody can do the non-statutory audits. So this is how basically the two kinds of audits will differ from. So if we have here, yeah, statutory audit. So legal compulsion, which is compulsory under law, statutory audit is compulsory under law. Whereas non-statutory audit is not mandatory. Scope, who will decide the scope? Statute. Nothing but under whatever law the audit has been made mandatory, the same law will tell you what is your scope also. Whereas in the case of non-statutory audit, management. Example, so audit of companies like company audit, bank audit, cooperative societies audit, trust audit, etc. Whereas examples here are sole proprietors audit, partnership firms, clubs, association, etc. Qualification, the person should always have requisite qualification like chartered accountant. Whereas when it comes to non-statutory audit, there is no specific qualification required. Rights and duties, who will decide? Rights and duties will be decided by the concerned law only. Whereas when it comes to non-statutory audit, who will decide rights and duties? It is purely decided on the basis of agreements between auditor and appointing authority. That means whoever is appointing you. Liability, in the case of statutory audit, liabilities, you will have two kinds of liabilities if you do something wrong. One is by the consent statute and also with common laws of the country. Like in case if you are doing company audit, if you do something wrong in the company audit, you will be liable even under Companies Act, which is a governing statute. In addition to that, the common law, like Indian Contract Act, we have no. So your liability will be fixed under two consent statutes. One is under Companies Act and also under common law of the country. Whereas in case if I am doing the normal sole proprietor's audit, you will your liability will be there only as per Indian Contract Act. You will have nothing to do under any specific consent statute. So in the case of statutory audit, your liabilities will be twofold. One is by the concerned law under which audit has been made mandatory and also under common law. Whereas if it is a case of non-statutory audit, your liability will be only under common law. You will not have any kind of liability under any specific concerned statute. Why? Because here there is no law itself to tell you that audit is mandatory. So, and also publications of audit report. In case of statutory audit, whatever report you give, that will be published for the entire public. All the common people will have access to that audit report. Whereas when it comes to non-statutory audit, your audit report will be published only to the internal person, like employers, partners, internal people only will have access. Whereas if it is a case of statutory audit, like company audit, like you and me, ordinary person, common shareholder, an outsider, even he can also have access to that audit report. So this is how basically statutory versus non-statutory audit will differ. Okay, so let us now proceed further and try to have further understanding of the concepts. So now we will discuss something about what is the nature of auditing, or we can even call it as what are the features of audit or what are the characteristics of the audit. So as we could see here, the definition of audit, we already know about it. Now coming to the nature of audit or talking about what are the characteristics or features. So sometimes they might ask you a question, not just nature of audit, even if they ask you what are the features of audit, or even if they ask you the question, what are going to be the characteristics of the audit, we are supposed to write the same thing. So what are that characteristics? So as we all know, audit is a systematic and scientific examination of books of accounts. Nothing but independent examination we are going to do. Are we going to do it in a scientific manner or just like a layman will we try to do it? So we basically try to do that examination of books of accounts, that too in a systematic and a scientific manner. And it is always done by an independent person. As a definition of audit itself says, audit is an independent examination. So the person, whoever is doing that audit, he should always be independent. He should not have any kind of influence. At the same time, he should be qualified person, should possess certain kind of qualifications. And apart from that, as we know, the basic objective with which we are doing the audit is checking whether the financial statements are giving true and fair view. True and fair view of what? True and fair view of profit or loss for the period, and also true and fair view of state of affairs. State of affairs means nothing but the financial position of the entity. Along with that, audit involves critical review of accounting and internal control. So what basically is this accounting system and internal control? So here they are making use of two phrases. One is accounting system and the other one is internal control. So let us try to have understanding now what is basically accounting system. So when we say accounting system, it is nothing but it is a combination of any policy or procedure or any system followed by the management of the entity for the purpose of maintaining accounting records. When I say accounting records, it is books of accounts along with financial statements. So, for the purpose of maintaining books of accounts, for the purpose of preparing financial statements, whatever procedures management is following, whatever policies management is following, whatever systems they are following, that we collectively call it as a accounting system. Now, coming to the other term which has been used in the phrase that one is internal control system. Now, what is basically internal control system? Internal control system is also defined more or less in the same manner. It means any policy or procedure or any system which is implemented by management of the organization to achieve the objectives of the organization. So how the term internal control has been defined? It is any policy, any procedure or any system which who has implemented, management has implemented. For what purpose they have implemented? To achieve their objectives. Like if I give you some examples. So if you want to enter inside any IT company, so what they will generally expect you to do is just like that any person cannot go and enter inside the company's premises. So what will basically happen is you will be given one identity card and your fingerprint will be registered. So if you have to enter inside the company's premises, you have to scan your identity card. Along with that, even you need to give access to your fingerprint also. Now the system is going to match whether the fingerprint is matching with the identity card. If yes, then the gate will open, then only you can enter inside. This is simply an example of internal control system. Or having a CCTV camera installed in the premises of the company, internal control system. If you go to any supermarket, buy any product there, and if you get the items billed before you come out of the store, security guard will check it. That is a policy implemented by the management. That is also internal control system. Today, if you are making any banking transaction, after you have entered all the account to which you have to transfer the money, a OTP will get sent to your mobile number. You have to enter that OTP, then only funds will get transferred. Internal control system. So like that, any policy or procedure or any system which is followed by the management to achieve their specific business objectives, we call it as internal control system. And being an auditor, we need to verify the client's accounting system as well as their internal control system. That is what the objective which has been covered here. So we need to verify client's accounting system and internal control system. And how we will come to know whether the financial statements and books of accounts are correct or not? Example, assume that you went to the client's premises, your client has given you books of accounts. In that books of accounts, there is one purchase entry. How you will come to know whether that purchase entry is correct or whether that purchase entry is genuine or not? With the help of supporting documents, which we call it as vouchers, documents, or information. Nothing but I will check invoice. I will check the purchase order. If you find any rent payment in the books of accounts, I will try to check it with its supporting document, which is going to be a rental agreement. If your client has paid any insurance premium, I will check it with a copy of the insurance policy. So like that, we will do the scientific and systematic examination. For that, we take the help of supporting documents like vouchers, invoices, agreements, contracts, bills, whatever you call it, we'll take the help of that supporting documents. and the auditor has to satisfy himself with authenticity, genuinity of the financial statements. Once again, more or less the same thing, whether the financial statements are giving true and fair view or not. Then auditor has to inspect, compare, check, review, scrutinize the vouchers and supporting documents, and examine other documents also, like incorporation documents, MOA, AOA, in order to know whether the books of accounts are correct or not. So basically, these are all the characteristics of the audit. These are all features of the audit. This is what the nature of audit. So if we give a quick glance of all the points, it involves systematic and scientific examination. It is done by an independent person, that to a qualified person. Here we check whether the financial statements are giving true and fair view. We verify accounting system and internal control system. We will take the help of the supporting documents to check whether that information is correct or not. At the same time, we check the genuinity, and even we check other documents like incorporation documents, for example, AOA, MOA, etc. All these things we will try to check it. This is what basically happens in the audit. Now, talking about, write a short note on scope of audit, or enumerate the scope of audit. What exactly will be included in the scope of the audit? So now basically, as I have told, the audit can be statutory audit, and or the audit can be non-statutory audit. As I've already told, if it is a case of statutory audit, the scope will be decided by the respective laws and regulations. Like if you are conducting audit of company, it will be governed by Companies Act. If you are conducting bank audit, it will be governed by Banking Regulation Act. If you are conducting insurance companies audit, you will be governed by IRDA. And at the same time, in case if you are doing a non-statutory audit, it depends on agreement whatever you have entered with the client. So the scope, what has to be covered in the audit, what need not to be covered in the audit, that will be decided either on the basis of laws and regulations or on the basis of agreement with the appointing authority. Those persons whoever are appointing you, they will decide what will be included in your scope actually. So now if we have a look here, if you see it here, there are few factors which are affecting the scope. That means what is included, what is not included in the scope, that will depend on size of the organization. That will depend on legal form of the organization. Nothing but, are you conducting audit of a sole proprietor? Are you conducting audit of a partnership firm? Are you conducting audit of a company? So it depends on the legal form also. It depends on purpose of the audit, for what purpose you are doing, like as I have told, statutory or non-statutory. It depends on agreement, especially in the case of non-statutory audit. It depends on accounting system, what accounting system your client is following. And even it depends on standards on auditing also, standards on audit. As I have told, accounting related, in accounting we follow principles given in accounting standards. Whereas in auditing, we follow the principles given in standards on audit. So standards on audit are going to be somewhat like your guiding principles for the audit. So standards on audit will tell us what is there in our scope, what should not be there. And it even depends on relevant statutes. This is particularly important in the case of the statutory audit. And sometimes even we have to take into account any legal decisions are there. Like if you take in the Income Tax Act, we take the help of case laws. So wherever there is a mismatch between the provisions, and wherever there are some no clear guidance from the tax provisions, there we take the help of that case laws. That is what here also they are saying, legal decisions, nothing but somewhat like case laws. You have to take the help of case laws also while deciding what will be included, what will not be included in your scope. So keeping all these factors in mind, auditor will decide what should form part of his scope, what should not form part of his scope. Now coming to few other aspects, like if you see pronouncements, the scope of audit, what is included, what is not included, it depends on pronouncements. Pronouncements means nothing but, as we have told, standards on audit. So ICA will give standards on audit. Along with that, they will give something called guidance note. So these collectively we call them as pronouncements, and these pronouncements will decide. Apart from that, we should cover all aspects of the organization which are related to financial statements. So, assume I'm telling, as an auditor, you are supposed to independently examine the financial information. Assume that a client is coming to you, and you went to the client and told, Sir, I want to go to your warehouse and I want to check whether the quantity of stock is really there in the godown or not. But your management, but your client is saying, no, sir, you are supposed to do independent examination of financial information. We have given you books of accounts and supporting documents. That's all. Your scope is restricted only to the copies of the books of accounts and financial statements given to you. You don't have any power to come to our warehouse and check the stock. Can the management say it? Is the management authorized to stop the auditor from entering the premises and check the stock? Definitely not. Why? Because even going to the warehouse and checking the stock, that is also forming part of auditor scope only. Why? Because if you go and verify the stock, then only you will come to know whether closing stock value which is stated in the financial statements is correct or not. So you should cover not just the copies of books of accounts and financial statements given to you. You should cover all aspects of the enterprise which are related to the financial statements, not just the copies of the financial statements which you have received. Then coming to the next one, SA 200 is the first and foremost standard talking about the overall objectives of an auditor and how to conduct an audit in accordance with standards on audit. See this SA 200 is something like the role whatever AS1 plays in the accounting. The same role SA 200 will play in the standards on audit. Like AS1 is the basic fundamental standard which sets the scope and guidance for the entire subject of accounting. Similarly, SA 200 is the first and foremost standard on audit which is going to set the base and foundation for rest of all the standards, rest of the entire auditing subject. So we don't have SA 1, 2, 3 and all. Like AS1 is the first accounting standard. SA 200 is the first standard on audit, which is going to talk a lot about what and all will be included in the auditor scope, what exactly auditor is supposed to do. So let us see what does that SA 200 is expecting the auditor to do. Let us see now. So according to SA 200, whose title is Overall Objectives of an Independent Auditor and Conduct of an Audit in Accordance with Standards on Audit. This complete sentence is title of the standard. The title itself is so lengthy, but title itself is saying what is included in this standard. So from the title itself, it is very clear that this standard is going to talk about overall objectives. If you are an independent auditor, what will be included in your overall objectives and how to do the audit as per standards on audit. So that SA 200 says that the auditor's scope should include the following aspects. What are they? Number one, the auditor shall assess reliability and sufficiency of information contained in the underlying accounting records. Nothing but whatever books of accounts are there, whatever information that is included in the books of accounts, whether that is reliable. Reliable in the sense what? Trustworthy. At the same time, whether they have completely presented the information, that is, are they having sufficient information or they're hiding something. And even auditor has to determine whether relevant information is properly disclosed in the financial statements with the applicable generally accepted accounting principles and also as per statutory requirements. This is what we simply call in our terminology as applicable financial reporting framework. That itself they are trying to expand it. Nothing but we need to check whether financial statements are prepared as per applicable financial reporting framework. And the auditor will be principally concerned with items that either individually or as a group or material. And once again, as we have seen in the objective, you should not be concerned about every kind of misstatement. You should be concerned only with that misstatements which are material. So if we do a summary, SA 200 says that as a part of our scope, three things you have to do. So one is you need to check reliability and sufficiency of information in the books of accounts. Then we need to check whether the financial statements are prepared as per applicable financial reporting framework. Number three, you should be concerned about only material misstatements. You should not be concerned about every kind of misstatement. So that is what included in the scope. So what basically we have seen is in the scope of audit, first it depends on auditing pronouncements, nothing but guidance notes, standards, whatever are given by ICI. Along with that, even we need to cover all aspects related to the entity which are related to financial statement. And even we have seen essay 200 is also trying to say something about the scope. Then even we need to consider various factors like size of the entity, legal form of the entity, agreements, laws and regulations. So all these things we have to keep in mind. Then collectively we should decide what is included in our audit, what is not included in our audit. Now, so coming to the next concept now, what are the objectives of the audit? So the main objective, which we are already aware, the basic objective, the main purpose why we are doing the audit, obviously to express an opinion. So the primary object, the principal object, the main objective with which we are doing the audit is simply to what? To express an opinion on the financial statements. And in order to do that, the auditor has to verify accuracy and judge the reliability of financial statements. Just in the previous point we have seen. In order to express that opinion, first we need to do verification whether the financial statements, books of accounts, whether they are reliable, they are accurate or not. And expressing an opinion on the financial statements by the auditor is specifically included in essay 200. Even essay 200 also says that the main objective of express or the main objective of the auditor while doing the audit is to express an opinion. Okay, agreed, the main objective is expressing opinion. Apart from that, will he have any other objectives? Apart from expressing the opinion, does the auditor have any other further objectives? Yes. There is a secondary objective. There is one more objective given along with that primary objective. Now, what is that secondary objective, sir? The secondary objective is to detect frauds and errors in the books of accounts. Sir, why are you saying it's secondary objective? Why? Because the primary responsibility for preventing the frauds as well as for detecting the frauds both will rest with management. It is whose primary responsibility? Management. Whereas secondary responsibility is with whom? Auditor. Regarding what primary and secondary responsibility? So when it comes to detection of frauds, detection of frauds and errors. So in this matter, the primary responsibility always and always rests with management. So since management are the people who are running the business, like board of directors of the company, they are the people who are running the business. They are the people whom shareholders have trusted. They are the people on whom the shareholders are keeping the confidence. So that's why the management of the organization is primarily responsible for detection of frauds and errors. Whereas the secondary responsibility rests with whom? Auditor. So we are not appointing mainly the auditor only for detecting frauds or errors. Frauds or errors. Did I say it anywhere? As our earlier objectives, even we have read the definition of the audit. Did they say it in the definition? The auditor is responsible for detecting frauds and errors. Did they say it? No. So the primary responsibility is always to express an opinion. Detecting frauds or errors are something which is secondary objective. Whereas for detection of frauds and errors, the primary responsibility is resting always with management. So this is what the secondary objective. Then talking about few more things from the social perspective also, from outsiders perspective also, there are some objectives. Like for example, why basically audit has been introduced is to protect the shareholders' interest. Assume what if there is no activity called audit. So if there is no activity called audit, generally what would happen? Who will prepare the financial statements? As we know, management will prepare. And after the management has prepared the financial statements, there will be different users who use that financial statements for their decision making purposes. One of the main user will be shareholder. Now, why shareholder will be using financial statements? Depending on financial statements, he will come to know about financial performance and profitability. On that basis, he will take a decision whether I should invest in this company or not. So now assume financial statements are prepared by the management and directly given to the shareholder. Now what will basically will happen is the shareholder will not have any confidence on this financial statements. Why, sir? Why? Because the management will run the business. They are the people who are doing decision making. They are the people who are preparing financial statements. Then what is the guarantee whether the financial statements given to them is reliable? So that's why shareholders will not have that much amount of confidence. So that's why the regulatory authorities have also thought about it, and they told something else. So once the financial statements are prepared by the management, before they reach the shareholder, one independent qualified person called auditor should verify that financial statements. Then they will become audited financial statements. If these audited financial statements are given to the shareholder, since an independent qualified person has verified them and is saying they are giving true and fair view, this will boost up the confidence of the shareholders. So this is what one of the social objective which auditor is fulfilling. That is, he is protecting the interest of shareholders, especially. Not just that, it can even act as a measure for avoiding the taxes by the clients. Generally, all the people will be happy when they are making a lot of money, but when the actual time comes for payment of the taxes, then the actual pain comes. So that's why, even if so some managements will be ready to go to any extreme to evade the taxes. Now if the audit happens, that will act as a control for evasion of the taxes. Especially this will happen in the case of tax audits, GST audits, etc. And even this will safeguard against capital erosion, capital reduction. Sometimes management will do bad management of the funds, and because of that, the value, the capital of the company will get eroded, reduced. So if the audit happens, auditor will check whether management is properly utilizing the company's funds or not, and intimate the information to the shareholders on time. And it will even ensure fair returns to the investor, nothing but more or less similar to protect the shareholders' interest. And even it will ensure reasonable prices are paid to customers. Whoever customers are there, whether they are paying reasonable prices, are they overpaying, are they underpaying, this information also can be got by customer by reading financial statements. See, financial statements is a public document. Any user can have access to it, be it shareholder, be it creditor, be it debtor. Anybody will have access to this financial statements. Customers use it, suppliers will use it. So many, even you and I, for our learning purposes also, we can download the financial statements and use it. And even to ensure fair compensation to the workers. Even some workers also refer to the financial statements to determine is the company making them correct the payment of bonuses, correct the increments they are receiving or not. That also can be found out by workers on the basis of financial statements. And as we know, some companies are required to undergo spend certain percentage of their profits on social welfare, which we call it as CSR. And as per Companies Act, 2% of the average net profits of last 3 years are required to be spent on social welfare. By doing audit, even auditor checks this matter also, whether the company is fulfilling all its social responsibility related matters also or not. So this is how auditors' objectives are divided. So one is primary objective to express an opinion, secondary objective detecting frauds and errors, and from social perspective, these many objectives are there. Now, talking about importance of the audit or significance of the audit, or even sometimes they might ask you a question, what are the advantages of audit? For all these things we are going to write the same answer. Now they have given advantages under three categories. One is from legal point of view, other one is from management or internal point of view, other one is from external point of view. Let us try to understand what are that advantages. If you look it from the legal perspective, just now we have covered this. It will help for filing income tax return. Why? Because income tax authorities will accept the payment of taxes only on the basis of audited financial statements. So if you get your financial statements audited, it will become easy for you to file your income tax returns. And whenever you go to the banker for the purpose of loan, banker, the first thing which he will ask you is get the audited financial statements. So if the entity gets their financial statements audited, it becomes very easy for them to go and get the loans from the borrowers. And even insurance claims, whenever you have suffered some loss in your premises, like some fire accident happened or there is some calamity, but luckily you have an insurance policy. So whenever you have an insurance policy and you have any calamity, the first thing which we will do is we will submit a claim to the company. Now company has to pay compensation. So assume the insurance company has to pay compensation. The company is saying we have suffered 10 lakh rupees of loss. Just if you pass that statement, will the insurance company pay you entire 10 lakh rupees as compensation? No. Even insurance company also wants to get the evidence that whether really 10 lakhs worth of damage happened or not. Now, how the insurance company will find out whether really 10 crores worth of damage, 10 lakhs worth of damage has happened or not? Now, they also will make use of financial statements. So, audited financial statements will help you even in the settlement of insurance claims also. Apart from that, if at all the client is going for bankruptcy, if his financial position becomes very weak and he has gone bankrupt, how much amount is required to be paid to each of the creditor? That official receiver will do it? No. On what basis he will decide how much amount should go to which receiver? So that will also be decided on the basis of audited financial statements. So from legal point of view, basically there are four advantages. One is it will help you to file your income tax returns. It will help you to make your borrowings much easier. It is even helpful in the settlement of insurance claims, and even it will avoid you even it will help you in the case of at the time of settlement of insurance claims also. Now from internal or management perspective, let us try to understand what will be the benefits or how why audit as a function is important from the management perspective. Number one, if the audit gets happened, auditor will, as a secondary objective, he will also even try to find out errors and frauds. So even if the management misses on detection of errors and frauds, auditor will somehow, as a secondary objective, find it out and report it to the management. If he reports it to the management will take appropriate action on time, and even they will take rectification measures to make sure that these kind of errors and frauds do not happen again and again. And also, if the audit happens, it will act as a moral check on employees. Moral check means a moral control on the employees. Even if the employees of the client think of committing a fraud, they will have a fear in mind that even if they commit a fraud or error now, in future auditor will come, find it out that fraud has been committed, report it to the management, and the management will remove that employees from their job. This fear will prevent the employees from committing fraud or error. So that's why we call it as moral check on the employees of the client. And not just that, even he can give advice to the management. But one thing which we need to keep in mind, it is never a mandatory obligation for the auditor to compulsorily give advice. Why? Because we have seen the main objective is to express opinion. If he wants, out of concern for the client, if he wants to give advice, he can give it also. So if he gives that advice out of his voluntary choice, even that is also going to help the management. So that's what they say. It may happen that management may consult the auditor and seek the advice of the auditor. Although it is not a duty of auditor. Don't be of a wrong perception that auditor is having a duty to give advice. No. Voluntarily, if he wants to give, he can do it. Next. From external perspective, how the audit will help, especially in the case of partnership firm for settlement of accounts. Assume that a new person wants to get admitted as a partner. Now he needs to bring in the capital contribution. How much amount he needs to bring in as a capital contribution, that will be decided on the basis of audited financial statements. If a partner is retiring from the firm, his account needs to be settled. On what basis accounts will be settled? Once again on the basis of audited financial statements. If a partner expires, his share has to be paid to his representatives. On what basis their share will be decided? Once again on the basis of audited financial statements. So if you get the audit done, it will help in the settlement of accounts of the partners at the time of admission, death, etc. And not just that, we will have to even value goodwill. On what basis goodwill will be valued? On the basis of, once again, audited financial statements, like by way of capitalization of the profits. So you might have seen various methods in the accounts. If you see in that methods which you use in the accounts, the figures which you take for the purpose of calculation of the goodwill will be from audited financial statements. And if at all, if you want to do projection of the future, how the future of the business will look like, even that future trend of the business can be predicted only if you know the current results. So on the basis of audited financial statements, even future trends of the business also can be analyzed. So these are the benefits by conducting the audit from legal perspective, or from internal perspective, or from external perspective. So that's what I told. Even if they ask you importance of the audit, or if they ask you significance of audit, or even if they ask you advantages of audit, for everything we need to write the same answers. Now, coming to the next aspects, what are the basic principles governing an audit? Or sometimes even they can ask you a question, what are the ethical requirements? Or even sometimes they can ask you, what are the basic requirements governing an audit? So for all that things, we are supposed to write the same thing. What are the basic principles, or what ethical values which you need to follow? What are the basic requirements which must be fulfilled in an audit? So they have given here a list of points. All these ethical requirements or all these basic principles are given under SA 200. So just now, as we have seen, SA 200 is the first and foremost standard on audit, which is going to set the entire base for the auditing subject. That SA 200 itself has given us what will be the basic requirements of audit. So what are they? Number one, integrity, objectivity, and independence. So the auditor should have three qualities. He should have integrity, he should have objectivity, and he should have independence. So what basically integrity means? Integrity means honesty. What is basically meant by objectivity? He should be unbiased. He should not show any kind of bias. And he should be independent. Independent means what? He should be free from influence. He should not get influenced. This we already seen it in the definition of audit. So three important qualities must be there for everybody. He should be a man of integrity. That is, he should be a honest person. He should be sincere. He should be straightforward. He should be objective. He should not show any kind of bias or superiorities. And even he should be free from influence. These three qualities are must for every auditor. Apart from that, he should maintain confidentiality, secrecy over the client's affairs. Being an auditor, we enjoy a privilege. We can ask any information from the client. Client will never say, why do you need this information? So, since we are enjoying such a privilege and getting access to all the information regarding client, sometimes you even might get to know about their business secrets. Will you simply go and disclose that business secrets to the competitors, or will you post somewhere in your social media platforms? No, we should not do it. We should maintain confidentiality, secrecy over the client's affairs. You should have enough of skill and competence. See, being an auditor, our subjects are of such a nature, we need to continuously get updated. Like if you take taxation, once in a year, budget meeting happens, the finance minister comes with tax related amendments. Sometimes laws will be altogether scrapped. Earlier, we used to have Companies Act 1956, now it was replaced by Companies Act 2013. Earlier, we used to have so many indirect taxes, now it is replaced by one single act, which is GST. So, like this, our subjects which we are associated with are continuously evolving, are continuously changing. Now we need to update our skills also. We should become capable enough, then only we can provide relevant services to the client, or else our services will be of no use. So it is our professional responsibility to maintain all the skills required, and also to become capable and updated about changes in the laws and regulations. Apart from that, as a part of audit, we get the work done by various other people also. All the work I will not do it. I'm a chartered accountant and I'm doing practice. Now, if I get some audit, it is not like I as a single person go and complete the audit. I will take with me some staff also, like article assistants, my office staff. So I will take my staff along with me when I go for audit. Now work will be divided among my staff. My staff will be doing work. Can I blindly believe whatever work they are doing? No, I can't do it. So whatever work which I have allocated to all my staff, whether they are taking care of their work respectively in a proper manner as per the standards or not, the supervising and monitoring is also whose responsibility? Being an auditor, my responsibility. Agreed, you are getting the work done through your staff, but don't blindly believe it. Supervise them, give them proper instructions, and also review once they have completed their respective work. And whatever work you are doing, you need to maintain documentation. Documentation means what? Nothing but whatever things you have checked, whatever evidences you have seen, whatever documents which you have verified. So, all that things need to be stored. You have to keep it for your future reference. Then, planning. You need to properly plan for your audit. Don't just go blindly. You need to follow one proper structured plan. When you are starting, when you are ending, which work is done by which person, in what area, how much time you are spending. Along with that, you should not form conclusion out of nothing. You need to have valid supporting information to form your conclusions. Like if you are giving positive opinion, that is, you are saying financial statements are giving true and fair view. On what basis you are giving this? On the basis of some supporting information. So basically, the process of audit will be something like this. So audit actually starts with auditor's appointment. And finally, the process of audit will come to an end by expression of opinion. This is our ultimate objective. We have to express an opinion. Now, if you take any opinion in this world, every opinion will have some sort of supporting information. Even the opinion which we give in audit, that also needs some supporting information, which we basically call it as audit evidence. So audit evidence means nothing but the information which is forming the basis for your opinion. If you are saying financials, I give a positive opinion. On what basis you have given it? If you are saying I am giving negative opinion, on what basis you are giving it? If tomorrow someone comes and asks you, I should need some evidence, no. So that information which is supporting your opinion, that information which is forming basis for your opinion, that information in audit terminology we call it as audit evidence. So the ultimate objective is to express the opinion. To do that, we need some supporting information, which we call it as audit evidence. And we will not just like that get the audit evidence. We need to perform some audit procedures in order to get the evidence. Nothing but audit procedures means those procedures or those steps or techniques which you are following to get that audit evidence. We call it as audit procedures. So the entire process of audit is going to be, first you will get appointed, then you will perform something called audit procedures. By performing this audit procedures, you will get something called audit evidence. On the basis of that audit evidence, you will express your opinion. This is what basically happens in the entire audit. And this we simply call it as structure of audit. So what is the process or structure of audit? It starts with auditor's appointment. He will perform audit procedures. He will obtain audit evidence. On the basis of that, he will express the opinion. So that is what even they are trying to say here. All your information, all your opinion should be supported by evidence. And next point, as we already know, we have to cover the client's accounting system and also their internal control system. We need to verify the client's accounting and internal controls also. I told you just now what is accounting system, what is internal control system. And finally, whatever our opinion is there, that we need to report. When I say you have to express an opinion, that opinion is just not like that you come before the public, say your opinion and go. Your opinion should be on the basis of a written document, and that written document only we call it as auditor's opinion or audit report we call it. So finally you have to express your opinion in the form of a written document, which we basically call it as audit report. So these are all the basic principles governing an audit. So what are they? If you have a quick and thorough revision: integrity, objectivity and independence, confidentiality, skill and competence, work performed by others you need to review, documentation should be there, proper planning should be there, audit evidence is required, you need to verify accounting system and internal control, even whatever your final conclusions are there, that you need to report it in the form of written document, which we call it as audit report. So this is what basically regarding basic principles or ethical requirements, or as I have told, even sometimes they might ask you basic principles governing an audit or ethical requirements also they can say. So this is what related to basic principles. Now let us come to the remaining concepts. So let us move on with the next concept, which is going to be about inherent limitations of audit. Now, what exactly are these inherent limitations? For this, let us have recap once whatever we have discussed at the beginning. So, as I was saying that the ultimate objective of an auditor is to what? To express an opinion. So, from the beginning, we are always saying auditor is responsible for expression of opinion. Now assume that you have verified the financial information of any entity and you are satisfied that they are not misleading, they are giving true and fair view. So you would have given positive opinion. Now, can this positive opinion be taken as a guarantee regarding the future viability? That means I have given the positive opinion on the financial statements. Looking at that opinion, some shareholder has bought the shares in this company. And subsequently, because of bad business, what happened is the company got failed miserably and the business came down. And obviously, the impact will be there on the share price of the company. So now the shareholders started complaining. I invested in this company only after reading the auditor's report. Let me punish him. That means he's filing a case and he's filing a case against the auditor and saying that the auditor will be liable to pay the compensation of loss to him. Is it acceptable? So the point which I want to make here is if an auditor gives a opinion, he is not giving any guarantee regarding future viability of an entity. I have nothing to do about the future of the company. I am just verifying financial information, that too historical financial information I am verifying. So I have nothing to do with the future of the company. My opinion can't be taken as guarantee regarding future of the company. At the same time, if I give positive opinion, it can't be taken as a guarantee that I am saying the management are very efficient and effective. No, I don't give that guarantee also. Why? Because I am not expressing opinion on the management, I am expressing the opinion on financial information. So that's what the conclusion here. If the auditor expresses an opinion, it is not a guarantee regarding future viability of the entity. At the same time, it is not a guarantee for efficiency and effectiveness of management. I am just verifying historical financial information and I am expressing an opinion how far that information is reliable. My scope is limited just to that kind of opinion only. And there is also one interesting terminology which we have to understand it here. Now, SA 200, which is the first and foremost standard on audit, it says that auditor have to obtain reasonable assurance that financial statements are not misleading. Now, what is this reasonable assurance? So they have defined the term reasonable assurance as high level of assurance, but not absolute assurance. So now what is this high level of assurance? What is this absolute assurance? Let us try to understand it. First of all, assurance means giving confidence. When I say absolute, it is 100%. So giving absolute assurance means you are 100% confident that there is nothing wrong here. But the standards are expecting you only to obtain reasonable assurance, but not absolute assurance. That means even the standards on auditing are also not expecting you to give guarantee. 100% assurance is nothing but more or less similar to guarantee. Even SA 200 is also not expecting you to give guarantee. The standards are also expecting for you to only give high level of assurance, a bit higher level of assurance, but no one is expecting from you guarantee. Sir, why you are saying this? Why the auditor can't give guarantee? Or why the level of assurance can only be high? Why not absolute assurance? Why? Because even though how effectively you do the audit, because of some limitations of the audit, there is always a possibility of our opinion going wrong. No matter how effectively you do the audit, there is always a chance of your opinion going wrong. So one such limitation is test checking, sampling also you can say. So basically, if I am doing audit of Reliance Industries Limited, do you think I will be verifying each and every entry which is there in the books of accounts? Or will I verify each and every transaction which is recorded in books of accounts? Do you think it is possible? No, it is not possible. So basically, what is the mechanism of audit is audit happens on sampling basis, test checking basis. So when I verify the transactions on sampling basis, take for example, total 1 lakh transactions are there. I verified only 1000 transactions out of it. If I am saying I verified only 1000 transactions, I am indirectly saying that I did not verify 99,000 transaction. In that, there could be a misstatement, whatever you did not verify. So this is one such limitation. This is not the only limitation. This is one example of the limitation that I do the verification on testing basis. Because of that, the transactions which did not come into my sample, that could contain a material misstatement which may not come to my notice. Now, this is what one of the limitation because of which auditor's opinion can go wrong. And this limitation is of such a nature that which is unavoidable. What is the nature of this limitation? It is unavoidable in nature. I can't avoid it. No matter whatever you do, this limitation will be there. So why? Because here avoiding the limitation means doing the audit on 100% basis. That is quite impossible. So you can't do it. You can verify only on sampling basis. And if you verify the audit, if you verify the transactions on sampling basis, there is a possibility of your opinion going wrong. So that's why this is one of the limitation. Since it is unavoidable in nature, we call it as inherent limitations of audit. What do we call it? Inherent limitations. Those limitations which are unavoidable in nature. So the point here is the process of auditing is suffering from some limitations which will not be avoidable, which means no matter how much audit you do effectively, there is always a possibility of auditor's opinion going wrong. And one example of that inherent limitation is verifying the transactions on sampling basis, that is test checking of the audit. So that's what they try to explain it here. Auditor can only obtain reasonable assurance, but he cannot obtain absolute assurance. And even auditor's opinion is not a guarantee regarding what future viability and efficiency, effectiveness with which the management has conducted the affairs of the enterprise. And also audit doesn't function of audit does not guarantee that all material misstatements will be detected. That means even if you have done the audit effectively, still there are some chances that some misstatement might not come to your notice. Why? Because it is suffering from some inherent limitations, those limitations which are unavoidable in nature. What are the examples of that inherent limitations? Number one, as we have seen, test nature of the audit. In simple terms, sampling. We verify the transactions on sampling basis. When you are doing it on sampling basis, there could be some misstatement which might not come to your notice, because of which your opinion can go wrong. Not just that, there are other limitations also, non-detection of errors and frauds. Sometimes you put all your reasonable efforts, but still you might not be able to identify some frauds. Especially you take some big frauds which are very sophisticatedly, which are very carefully carried out. Like you take for example, we had this recent times the PNB fraud we had. So this PNB fraud is one of the biggest scam or fraud which we have in the recent times. So even after having the audit also, auditors were not able to identify it. Why do we think so? Why? Because it was carried out in a sophisticated manner. Coming to the next point. So the third inherent limitation which they are saying here is audit is a post-mortem activity. This we have already seen. Accounting is something which will happen at the time of occurrence of the transaction, but audit will happen once the entire accounting process gets completed. So some people argue that, some critics argue that since it is a post-mortem activity which is happening after the events have taken place, so that's why there is no value addition in the audit. This is also some argument of some experts in the industry. And one more thing they say here, the evidence which is available to the auditor will be persuasive in nature rather than conclusive evidence. See, conclusive means 100% evidence, perfect, exact evidence. We never get perfect and exact evidence in the audit. We only get persuasive evidence. Persuasive means convincing evidence. We get only convincing evidence. We don't get conclusive exact evidence, 100% evidence. We will never get it. But instead, what kind of evidence we get in the audit? Persuasive evidence, which means convincing evidence. We are going to get it, not 100% evidence. So these are some limitations because of which no matter how effectively you do the audit, there is always a chance of your opinion going wrong. And these are the limitations because of which you can obtain only reasonable assurance, but not absolute assurance. Now, coming to one more last topic from this particular chapter, which is going to be the differences between audit versus investigation. One of the important concept, very frequently tested things in the exam. So like as you could see, basically if we talk about differences, investigation is a special purpose assignment. And as I have told, reasonable assurance, absolute assurance. Investigation is more of absolute assurance, whereas audit is only reasonable assurance. If I give you an example of investigation, like an income tax raid, that is an example of investigation where the person will have superior powers. They will come with only specific objective. Audit is a general purpose. Like audit, why we do? Just to ascertain whether the financial statements are giving true and fair. Whereas investigation will be done with a specific purpose, and in most of the cases, 99% of the cases, investigation will be done exclusively to find out the frauds and errors. But for auditor, it is a secondary objective. And also, auditing is very regular. Every year, audit will happen for every company. But investigation will happen only when required, only when serious irregularities are found, then only investigation will happen. But auditing will happen irrespective of any findings, irrespective of any observations. Year on year, audit will keep on happening. So some differences they are explaining here between auditing and investigation. Like if we have a look, auditing is an independent and systematic examination of the books of accounts, evidences, etc. Whereas investigation is also an examination of accounts to ascertain the facts. Here we do it to know true and fair view of financial statements. But here it will be always done with some special purpose to establish the facts, whether the facts are correct or not. To know that we do investigation. So it is always a special purpose assignment. But audit we generally do it to ascertain whether financial statements are giving true and fair view or not. See, the scope of audit is very wider. We try to cover all aspects. Like in scope, I have told you should cover all the aspects of the organization which are related to financial statements. So in audit the scope is very wider, but in the case of investigation the scope is very limited. Sometimes what will happen is you will be appointed to do investigation only of purchases, you will be appointed to do investigation of only sales, so your scope is limited. Objective, as we already know, here the main objective is to know whether the financial information is giving true and fair view, whereas investigation is basically a special purpose assignment. Depends on the facts and circumstances of each case. Then audit procedure. We generally do the audit as per the auditing standards, but here we do extended audit procedures. Here we have superior powers. Whereas when it comes to audit, our scope is governed only by auditing standards. But here we have extended, a little bit extra audit procedures. Next one, evidence. So here what we get here, as I have told in the previous answer, we try to get persuasive evidence, that is convincing evidence. Whereas in investigation, we will not get satisfied with the persuasive evidence. We always expect convincing evidence. We want 100% evidence. But in audit, persuasive evidence is enough. Now audit is skeptical and investigation is suspicious. Let me explain the difference between two. See, suspicious means you are believing that something is definitely wrong. I have to find out. So that is what suspicion. Completely negative attitude you will be having. Whereas audit is skeptical. Skeptical means you will just have a questioning mind. Questioning mind in the sense, assume that the management is giving you some information, some supporting documents, some bills. So you should not blindly accept everything. You should have one alertness in your mind that how far this information is relevant, how far this information is acceptable. Whereas in the case of investigation, you should always have negative attitude that something has definitely gone wrong in this particular thing. I have to find it out. So that is what suspicion is. Whereas audit is always what? Skeptical. Skeptical means questioning mind. Suspicious means completely negative attitude that something is wrong. Then periodicity. As I have told, audit is a regular activity. It is a routine exercise. It will happen year after year, whether any observations are there or not there. But investigation will be a special purpose. Sometimes for more than 1 year also investigation can take. Less than a year also you can do investigation. It all depends on facts and circumstances and requirements of the hour. Whereas when it comes to audit, it is a periodical activity. It will happen year after year. So these are all the key concepts from the nature, objective, significance, and scope of audit. So with this, we will end this chapter. Now we will revise the important chapter, which is going to be company audit. From there, we will try to revise the key concepts or key elements of the chapter company audit. Okay. So let us start now. Company audit. So this is one of the most important chapter, and there is very good amount of weightage of the questions coming from this chapter. So without any delay, let us try to understand these things. As you all are aware, the title of the chapter itself says, in this chapter, we are going to talk about the provisions regarding the audit of the companies. So now in the previous chapter, we have seen audits are basically divided into two categories. One is statutory and the other one is non-statutory audit. And basically, this company audit comes under statutory audit. So, because the Companies Act 2013 has clearly told that once you incorporate yourself as a company, audit becomes mandatory for you. And as we know, in the case of statutory audit, the scope, objective, rights, and duties, everything will be decided under respective statute under which audit has been made mandatory. Since company audit has been made mandatory under Companies Act 2013, this Companies Act is even going to talk about who is eligible for getting appointed as auditor, who is not eligible for getting appointed as an auditor, procedures for appointment, procedures for removal, procedures for resignation, procedures for selection of auditor. So like that, so many concepts are there which we have to cover along with rights, duties. So all these things they are trying to explain it in this particular chapter. Very important. So much of weightage comes from this chapter. So let us try to have a very quick revision now. So we will start with eligibility criteria. Who is eligible for getting appointed as an auditor of a company? As I have told, Companies Act has clearly told audit of every company is mandatory. So the act is not just leaving you saying that, they are even saying who is eligible for getting appointed as an auditor. So that provisions are contained in section 141 of the Companies Act. And section 141 subsection 1, this is talking about qualifications. Qualifications means nothing but who is eligible for getting appointed as an auditor. So the act says an individual can be appointed as an auditor provided he is a chartered accountant and he should have a certificate of practice. In simple terms, we call him as practicing chartered accountant. So an individual who is a chartered accountant and also he should have what? Certificate of practice. Only practicing chartered accountants are eligible for getting appointed as an auditor of a company. But the most common structure which we see in the society is audit firms we see. Audit firms means nothing but simply a partnership firm of practicing chartered accountants. So assume some two practicing chartered accountants are there. Both want to carry out the practice. So what they thought is why to carry out practice separately. Let us create one partnership deed. We'll create a partnership firm, and in the name of this partnership firm, we will try to do the business. So now this is simply a audit firm of two practicing chartered accountants. So can the audit firm be appointed as an auditor? The answer is yes. So what the act says is an audit firm can be appointed as an auditor provided majority of the partners are practicing chartered accountants. Now, what is this? Sir, why majority of the partners they are saying? Why? Because in an audit firm, all the partners will be practicing chartered accountants. Might not be. In the recent times, some firms are evolving where all the partners are not practicing chartered accountants. There are even other professionals like cost and management accountant, company secretary, lawyers. These kind of people are also becoming partners. So assume there is a partnership firm in which there are five partners. Out of them, some three are practicing chartered accountants. One is cost and management accountant, and one more person is company secretary. Can this firm be appointed as an auditor? Yes. Why? Because they are saying majority of partners are practicing chartered accountants. So since majority of partners are practicing chartered accountants, yes, this audit firm also can be appointed. Now assume that there are four partners in which two are practicing chartered accountants, one is a practicing cost accountant, one is practicing company secretary. Can this firm be appointed as an auditor? The answer is no. Why? Because in 4, 2 is not majority, it is exactly 50%. We say there is a majority when there is more than 50%. So this is what simply 141 subsection 1 says. who is eligible for getting appointed as an auditor. An individual is eligible for getting appointed as an auditor provided he is a chartered accountant having certificate of practice. Whereas even audit firm also can be appointed as an auditor provided majority of the partners are practicing chartered accountants. Majority means more than 50%. This is what 141 subsection 1 says. Now let us come to second subsection 141 subsection 2. Who will sign the auditor's report? If an individual is appointed, no confusion, the same individual, whoever is appointed, that person only will sign the audit report. What if an audit firm is appointed? So in case if the audit firm is appointed, there is no requirement that all the partners shall sign. At the same time, any partner cannot sign the audit report on behalf of the firm. So what they have told is a partner, a partner who is a practicing chartered accountant can sign the audit report on behalf of the entire firm. Like for example, assume there is a partnership firm which contains, in the previous example, 5 partners. Out of them, 3 are practicing chartered accountants, one is a cost accountant, and one also is a company secretary. Now, on behalf of this firm, who can sign audit report? Can this person sign? No. Can this person sign? No. Does all the 3 persons are required to sign? No. Any one of these 3 practicing chartered accountants can sign the audit report on behalf of the entire firm. This is what simply 141 subsection 2 says. So an individual, provided he's a practicing chartered accountant, an audit firm, any partner who is a practicing chartered accountant can sign on behalf of the entire firm. And generally that person, whoever is signing, will be referred as, in the audit terminology, we call him as engagement partner, we do call him. Now, let us talk about 141 subsection 3, which is regarding disqualifications. Is regarding disqualification. Now, when qualification means who is eligible for getting appointed as an auditor, what would be the meaning of disqualification? Disqualification means who is not eligible for getting appointed as an auditor. When I say who is not eligible for getting appointed as an auditor, am I referring to those persons who are already qualified chartered accountants or other than chartered accountants? So, I'm talking about those people who are already chartered accountants, who are already having certificate of practice, but if they attract to any of the circumstances given under section 141 subsection 3, then they will not be eligible for getting appointed as auditor of a company. I hope I have made the point clear. I'm repeating once again. 141 subsection 3 contains some conditions, events, or disqualifications which, if a person gets attracted, even though he is a chartered accountant, even though he is having a certificate of practice, still he can't be appointed as auditor of company, even after having chartered accountancy certificate and also having certificate of practice. So what are that disqualifications? Let us try to understand them. So for this, we'll go through the material and try to have a quick revision. So these are actually disqualifications. So what are that disqualifications? The following persons are not eligible for appointment as an auditor of a company, even though they possess chartered accountancy qualification. What is that? A body corporate other than LLP. So the first disqualification, 141 subsection 3 clause A, says that a body corporate can't be appointed as an auditor of a company. So now what is this body corporate basically? Body corporate means simply it will include companies. So what they are trying to say here is a company can't be appointed as auditor of another company. So what do I mean here? Assume there are some 4 practicing chartered accountants ABCD. They want to carry out the business collectively. Generally, they can take up the shape of partnership firm. But these people doesn't want that to want to carry out the business in the name of partnership. They have created some company ABCD Private Limited, and in the name of this company, they want to render chartered accountancy services. Now, can this company be appointed as auditor of another company? No. That is what 141 subsection 3 clause A is saying, a body corporate. But they just did not say only body corporate. They said a body corporate other than LLP, which means when they say other than LLP, an LLP can be appointed as an auditor. Even LLP also will come under body corporate, but still LLP can be appointed as an auditor, and a company can't be appointed as auditor of another company. So now you all will be getting a doubt, then how come big four companies are able to do the audit? Big fours are not actually companies, they are incorporated as LLPs. That's why they are able to do the audit. So that is what the first disqualification, a body corporate other than LLP. That means LLP can be appointed other than LLP, whatever body corporates are there. Generally, what will come? A company will come. A company can't be appointed as auditor of another company. Then, second disqualification, an officer or employee of a company. If a person is an officer or employee, officer means generally who will come there? Directors or key managerial person like CEO, CFO. These people will come under officer definition. So if you are an officer in some company, if you are a key managerial person in some company, or you are also an employee in some company, for the same company, you can't act as an auditor. So if you want to act as an auditor of any company, I should not be an officer there. I should not be an employee there. That is what the meaning of point number B, an officer or employee. Coming to point number C, a person who is a partner or who is in employment of an officer or employee of a company. A bit tricky point, but let me try to make it very simple with the help of one example. So what they are trying to say here, assume there is a person, Mr. A. He is a practicing chartered accountant also. Now the thing here is he is some officer in the company, or he is not an officer, he is some employee in the company X Limited. Can this person Mr. A be appointed as an auditor? No, the person Mr. A can't be appointed as an auditor. Because of which clause? Because of 141 subsection 3 clause B. Now assume that there is another person, Mr. B. Now he is also a practicing chartered accountant, but the thing is he is a partner. That is, A and B are having a partnership firm, audit firm, in which Mr. B is a partner of Mr. A. Or assume Mr. B is not a partner of Mr. A, but instead he is a employee of Mr. A. He is working under Mr. A. So now Mr. B will become a partner or a person who is in employment of Mr. A, who is an officer or employee of a company. Mr. A is disqualified because of 141 subsection 3 clause B. Now what they are trying to say here is Mr. B is also disqualified. Which clause says it? 141 subsection 3 clause C. So now the clause reads as, if we read it once again, a person who is a partner or a person who is in employment, in our example Mr. B, of an officer or employee, in our example Mr. A. So Mr. B is a person who is a partner or who is in employment of Mr. A, who is an officer or employee of the company. So because of this clause, even Mr. B also will get disqualified here. Both Mr. A also will be disqualified and Mr. B also will be disqualified. This is what 141 subsection 3 clause C says. Now, let us come to the fourth clause, which is clause D. This clause contains three subclauses actually. Let me try to explain what these three subclauses say. Very simple points. So first we will try to understand 141 subsection 3 clause D subclause 1, which says a person that is a practicing chartered accountant or his relative or his partner. Now when I say partner here, not the life partner, we are talking about business partner. Why? Because life partner will come under relative definition. So a person, relative or his partner, if they are holding any security or if they are having any financial interest like having shares, debentures, etc., or they are holding any securities, where they are holding any security or interest in the company for which you are doing the audit, or in its holding company, or in the subsidiary company, or in the associate company, or in the subsidiary of such holding company. So the thing which they want to say here is, if I am a practicing chartered accountant, if I want to do audit of some company, take for example, there is a company called Tata Motors. For Tata Motors company, I want to get appointed as an auditor. If yes, now being a practicing chartered accountant, myself, nor my relatives, nor my business partner, a partner in the audit firm, any of us, we should not have any shares or interest in the Tata Motors. Not just in the Tata Motors, in the holding company of Tata Motors, we should not have shares. In the subsidiary company of Tata Motors, we should not have shares. In the associate company of Tata Motors, we should not have shares. And even in the subsidiary of holding company. That means, like assume the Tata Motors is having one holding company, Tata Sons Private Limited. Now, Tata Sons Private Limited is not having only subsidiary Tata Motors, it is having one more subsidiary, assume TCS. Now, TCS will become subsidiary of holding company for Tata Motors, not the direct subsidiary. Tata Motors is having one holding company, that holding is having another subsidiary. That is what TCS is. So if I want to conduct audit of this company, Tata Motors, neither myself, nor my relatives, nor my partners, we should not have any share or security in the company for which we are doing the audit, in the holding company, in the subsidiary company, in the associate company, or even in the subsidiary of holding company also, we should not be having the shares. Now, one doubt which we will be getting is, sir, who will come under relative definition, sir? Has the act given me scope for me to define who is my relative, who is not my relative? No, act has not given you that freedom. Act is saying we are deciding who is your relative. That's all you have to follow, whether you like it or don't like it. Sir, who will come under that relative definition? So let us have a look at it first. Why? Because they might pose a true or false statements or some MCQs out of it. So who will come under relative definition? Very big question. So they say that all the members of HUF, Hindu Undivided Family, everybody will be considered as relative. If they are husband and wife, person and his or her spouse, or a one person related to another, like if we see here, father, mother, brother, sister, son, including their step relationships, son's wife, daughter, daughter's husband, these only will come under relative, whether you like it or don't like it. If you say that, sir, me and my brother are having some issues, we are not talking it for a long period of time, no, act is not going to consider. Brother is your relative, whether you like seeing his face, whether you talk with him or don't talk with him, a brother will always be considered as relative. So this is what 141 subsection 3 clause 1 says. So a partner, a person or relative or his partner, if they are having any securities or interest in the company or group companies, then they will be disqualified. However, there is an exception for this rule. Now, general rule is if you are having any shares or security, you can't get appointed as an auditor. When I say there is an exception for this rule, what do I mean by that exception? That means even if some people are having shares in the company, still they will not be considered as disqualified. Sir, what is that exception, sir? That exception is simply a relative is permitted to hold the shares in the company, but only up to a face value of 1 lakh rupees. This exception is available only for a relative. That means a relative can have shares in the company, but not for any amount. A relative can have shares in the company only to the extent of how much value? 1 lakh rupees. That to face value, market price is irrelevant, purchase price is irrelevant, fair value is irrelevant. Sorry, yeah, fair value is irrelevant. Only the thing which is relevant is face value. Sometimes in the exam they try to confuse you. They will give purchase price, market price, all that things. Everything is irrelevant. Only face value up to 1 lakh rupees we have to consider. This is what the exception for this rule. If the practicing chartered accountant himself or his partner, even if they are having single share also, they will become disqualified. Whereas exception is available only for a relative if he holds the shares up to a face value of 1 lakh rupees. So this is what regarding 141 subsection 3 clause D subclause 1 along with exception. Now let us come to subclause 2. 141 subsection 3 clause D subclause 2, which says that a person or his relative or his partner, if they are having indebtedness, if they are indebted, if they owe a amount for more than 5 lakh rupees, to whom, sir? To the company, to the holding company, to the subsidiary company, to the associate company, or the subsidiary of holding company. Same, the 5 above group companies. So very simple point to understand as a practicing chartered accountant yourself or your relative or your partner. If you are indebted for what amount? For an amount exceeding 5 lakh rupees. To whom? To the company, holding company, subsidiary company or associate company or subsidiary of holding company. For an amount exceeding how much? 5 lakh rupees. Then also you will be disqualified. So does that mean I should not be indebted at all? No, you can become indebted, but make sure that that indebtedness is only up to 5 lakh rupees. Don't have indebtedness for more than 5 lakh rupees. And one more thing here, it is immaterial in what manner you are occurring indebtedness. That could be in the ordinary course of business, or that could be a special transaction also. Like assume an auditor is there, he went to some company X Limited, he bought the goods from them, but he has bought the goods on credit basis. He has bought some 6 lakh worth of goods on credit basis. Sir, will it be considered as indebted? Yes. Now let me add extra information. Now this is the policy of the company to sell the goods on credit basis to every customer, not just to chartered accountants, but every customer they will sell the goods on credit basis. In the normal course of business only, they have sold the goods on credit basis even to this chartered accountant also. Sir, will the disqualification still persist? Yes, it will persist. So the point which I want to make here is, what is the reason for indebtedness irrelevant? That could be in the ordinary course of business. That could be just a one-time transaction. All that things are irrelevant. The moment you are indebted for more than 5 lakh rupees, you will become automatically disqualified. That's it. No need to check the reason for indebtedness. That is what the thing which we want to highlight it here. And along with that, if you collect the fees on advance basis from the client, that will also be considered as indebted. Whereas if you take the fees on progressive basis, then what is the difference between advance and progressive? Advance means you are not doing any work and just you have collected the money. Without starting any work, you have collected the money. That will be considered as advance. So if you collect the money on advance basis, you will be considered as indebted. That means auditor should not take an advance. No, you can take it, but make sure that you are taking an advance amount only up to 5 lakh rupees. Now, what is progressive basis? Progressive basis means proportionately you are completing the work. Assume total audit fees is 10 lakh rupees. You have completed 60% of the audit and collected 6 lakh rupees. This we call it as progressive basis. If you collect the money on progressive basis, that will not be considered as indebted. Whereas if you collect the money on advance basis, that will be considered as indebted. Does that mean auditor should never take an advance? No, you can take the advance, but make sure that advance amount is only up to 5 lakh rupees. That's it. This is what regarding 141 subsection 3 clause D subclause 2. There is even one more subclause, section 141 subsection 3 clause D subclause 3. Very simple clause here, no extra complications involved. So what is that is same points, person that is a practicing chartered accountant or his relative or his partner. What they have done, sir? They have given a guarantee or a security on behalf of third person. To whom? To the company, to the holding company, to the subsidiary company, to the associate company, to the subsidiary of holding company, for an amount exceeding 1 lakh rupees. Then you will become disqualified. Now what they are trying to say is, some third party, someone has taken a loan from any of these group companies. Now what you are doing is, you are acting as a guarantee, either yourself or your relative or your partner. Sir, so and so third party has taken a loan from you. In case if he does not repay, we will repay. In the previous point, direct indebtedness. In this point, indirect indebtedness. Some third party has taken a loan from the company or group companies. But what you are doing as a chartered accountant, either yourself or your relative or your partner, any of you are acting as a guarantor on behalf of the third party. But for how much amount? For an amount exceeding 1 lakh rupees, then you will become disqualified. That's all. This is very simple clause. So with this, we have completed 4 clauses of disqualification: clause A, clause B, clause C, and clause D. Let us try to proceed further with further clauses of disqualifications also. Now let us proceed with the next clause, which will be 141 subsection 3 clause E. Let us try to read that, what they are trying to say. So what does 141 subsection 3 clause E says? A person or a firm, that is a practicing chartered accountant or an audit firm, who or which has a business relationship with whom? With the company for which you are doing the audit, or subsidiary company, or its holding company, or associate company, or subsidiary of such holding company. One more company gets added to the list, subsidiary of associate company. So the main points which we need to pay attention here are, for the purpose of clause D, group companies are only 5. What are they? Company, holding company, subsidiary company, associate company, subsidiary of holding company. But for the purpose of clause E, one more company gets added to the list, which is subsidiary of associate company. Even this company will get added to the list for the purpose of clause E. For the purpose of clause D, only 5 companies. For the purpose of clause E, 6 companies will come under group companies. Now, what is clause E saying? So, clause E says that a person that is a practicing chartered accountant or an audit firm, if they are having any business relationship apart from audit, see, audit is also a basically business relationship. Apart from audit, if you have any other kind of business relationship with the company or any of the 6 group companies, then you will become disqualified. Which means instead of doing audit or apart from doing audit, I should not have any other kind of business relationship with the company or the group companies. But this will bring a lot of impracticabilities. Like what? So if you say that apart from doing audit, I should not have any business relationship, that means I should stop buying goods from the company. I should not receive any other services from the company. That means if I am doing audit of Indigo Airlines, I should not travel in Indigo Airlines. If I am conducting audit of Apollo hospitals, if I am becoming sick, I should not get myself treated there. And if you keep on implementing this, if you are conducting audit of HUL, you should stop fulfilling your daily essentials. Why? Because in all the daily products, whatever we use, HUL will get involved either in its manufacturing or in its branding or in its distribution or in its retailing. So this provision is putting so much of impracticability. So what the standard has, what the Companies Act has done is they have also come up with this exception. So what exception they have given? Exception means nothing but even though you have some kind of business relationships, that will not make you disqualified. Sir, what kind of relationships am I supposed to have, sir? The relationships which are permitted for you are: number one, you can provide those professional services which are permitted to be rendered under both Chartered Accountants Act as well as Companies Act. There are some professional services which you can provide in addition to company audit, which are both permitted under Chartered Accountants Act and also Companies Act. Like if I say examples, along with company audit, you can do tax audit. Along with company audit, you can do GST audit. These kind of professional services you can provide. Apart from that, they say even one more thing also. You can also provide those transactions which are in the ordinary course of business. And one more thing is they should happen at arm's length price. The transactions which are in ordinary course of business, and that too price paid should be what? Arm's length price. Now what is this arm's length price? Arm's length price means whatever price that has been charged from an unrelated party, the same price should be even charged from that client also. So if the transaction is happening at arm's length price, if the transaction is in ordinary course of business, that will not come under business relationship. Such a kind of business relationship you can have. So now because of this rule, if I'm conducting audit of Indigo Airlines, yes, I can travel in Indigo Airlines, but the price of the ticket which I am paying should be the same like any other unrelated party is paying it. So if you fulfill that condition, yes, those kind of relationships you can have. This is what 141 subsection 3 clause E is about. So the basic rule says if you are having any business relationship, you will be disqualified. But we are saying for this rule there is an exception. What are that exception? You can have professional services which are permitted both under Companies Act as well as Chartered Accountants Act. And also you can involve in those transactions which are in the ordinary course of business, but the price paid should be arm's length price. This is what 141 subsection 3 clause E is about. Now let us try to understand few more set of disqualifications. Clause F we will see, which says that a person whose relative is a director or who is in employment of the company as a director or KMP. Very simple. If I am a practicing chartered accountant, my relative, sir, who will come under relative? Just in the previous thing we have seen, who and all will come under relative definition. So those people, if I am a chartered accountant, if my relative is director in some company or he's some top level management in some company, don't act as an auditor of that company. Why? Because you will become familiar there. I'm a chartered accountant. My brother is some CEO in some company. Don't do audit of that company. That is what simple clause 141 subsection 3 clause F is. Now talking about clause G. Clause G actually contains two subpoints. A person who is in full-time employment elsewhere. If you are a practicing chartered accountant and also you are in full-time employment elsewhere, you can't do audit of any company. Assume I'm a practicing chartered accountant and also I'm a full-time employee elsewhere. I can't do audit of any company because the companies that doesn't want to compromise on the quality of the audit. So that's why what they have told is, if you are a full-time employee elsewhere, we will not let you do the audit anywhere. You are completely disqualified from doing company audit. Or a person or partner of a firm holding appointment of more than 20 company audits. Sir, can an auditor do any number of audits? The answer is no. A chartered accountant can do maximum of 20 company audits. How many company audits a chartered accountant can do? Maximum 20 at any time, which means if a client is approaching me today, I should analyze for the time being now how many company audits I am having. If I am already conducting audit of 20 companies, I should say no to the new company. If I'm having audits of less than 19 company, less than 20 companies like 19, 18, then I can accept the new company audit. So a chartered accountant cannot do any number of audits. The limit set is 20. You can do maximum 20 company audits. Sir, what if it is a case of a partnership firm? What will happen in the case of a partnership firm? In the case of partnership firm, the limit will be counted. The limit of 20 will be counted per partner in practice, per practicing chartered accountant. Assume in the partnership firm, there are some 3 practicing chartered accountants are there who are partners. Now, how many audits this firm can do? 3 into 20, 60 audits they can do. Assume there are 5 partners in the firm. Out of them, 4 are practicing chartered accountant. One is a cost accountant. How many audits this firm can do? 4 into 20, 80 company audits they can do. So the limit has to be counted per partner who is a practicing chartered accountant. Sometimes what will happen is a person can be a partner in multiple firms. Assume this person, Mr. A, he is a partner in 3 audit firms. Now for each audit firm, will the limit of 2020 will be counted? No. What the act says is you will be considered as a single practicing chartered accountant and the total limit of 20 will be given. It is your choice how you want to allocate it among the 3 audit firms. You will not be given 20-20 limit in each audit firm. The total of 20 will be given. It is your choice how you want to allocate it. And companies which are excluded from ceiling limit, that means some companies will not be counted in the limit of 20, which means for these companies we can do any number of audits. So what are those companies which are excluded from the ceiling limit? Those are going to be one person company, dormant company, small company, and a private limited company having a paid up capital of less than 100 crores. These companies, any number of audits I can do. Other than this, whatever companies are there, which are going to be private companies, private limited companies having a capital of more than or equal to more than 100 crores, and also public companies, listed companies, government companies, banking companies, insurance companies. So all these companies, total 20 only I have to do. These 4 companies, any number of audits I can do. And one more thing they say that the similar kind of ceiling limit is there even for tax audit also. A practicing chartered accountant cannot do any number of tax audit. For tax audit also there is a limit, and for tax audits the limit is 60. A practicing chartered accountant can do only 60 numbers of tax audit assignments. So this is what the concept of ceiling limit is. Now let us talk about next set of disqualifications. Yeah. So clause F, clause G we are done. Let us now try to understand clause H. So now what does clause H say? Clause H says that a person who has been convicted by a court of an offense involving a fraud and 10 years have not elapsed from the date of such conviction, which means if a practicing chartered accountant has been convicted means proven guilty. A court has passed an order that some chartered accountant has involved in the fraud. Since he has involved in the fraud and judgment has been passed. So from the date of such judgment, from the date of such conviction until 10 years are not elapsed. So today if the court is passing an order, so and so practicing chartered accountant has acted in a fraudulent manner. From today until 10 years are not over, that practicing chartered accountant can't do audit of any company, not just the company in which he has committed a fraud. For any company, he can't do the audit, not just for 1 or 2 years. For how many years he can't get appointed as an auditor? For 10 years from the date of such conviction, he can't get appointed as an auditor of a company. This is what point Hs. A person who has been convicted, that is a practicing chartered accountant, who has been convicted, who has been proven guilty and passed an order against him that he has convicted in a fraud, he has committed some fraud. From the date of passing of such order until 10 years are not over, you can't get appointed as auditor of any company. There is one note point also here. We'll try to link it in some other question. Now coming to the last disqualification, which says that any person who directly or indirectly renders any service as specified in section 144 of the Companies Act, either to the company for which you are doing audit, or to its holding company, or to its subsidiary company. Which means if you want to act as an auditor of this company, auditor of any company, you should not provide any of the section 144 services. Either provide company audit services or provide section 144 services, but not both simultaneously. So if we try to understand what are that section 144 services, the list has been given here. 8 services have been given: accounting and bookkeeping services, internal audit services, design and implementation of financial information system, actuarial services, investment advisory services, investment banking services, outsourced financial services, and management services. So, if you provide any of these 8 services to the company, not just to the company, either to the holding company or subsidiary company. See here, group companies are 3 only. You should not provide any of the 8 services to the company or holding company or subsidiary company. Then you can act as an auditor. If you provide any of the 8 services which we have read now, you can't get appointed as auditor of the same company. Either provide section 144 services or provide company audit services, but not both simultaneously. So these are the disqualifications. These are the conditions to which if a practicing chartered accountant gets attracted, he can't do the audit of such companies even after being a practicing chartered accountant. This is what 141 subsection 3 about. Now let us come to 141 subsection 4. So 141 subsection 4 says that 141 subsection 4 is talking about subsequent disqualification. Now you might have already understood what is this clause about. We have seen disqualification. What is disqualification? When a person can't be appointed as an auditor. Now I am saying subsequent disqualification. What does that mean? Which means that at the time of appointment, you are not having any kind of disqualification. At the time of appointment, you did not attract any set of disqualification. But after you have been validly appointed as an auditor, then you are getting attracted to some disqualifications. Then what you are supposed to do? At the time of appointment, you don't have any disqualification. You are validly appointed. But after you have been appointed as an auditor, then you attracted the disqualification. What you are supposed to do? The standard simply says one thing. The act simply says one thing. If you attract any subsequent disqualification, that means after getting appointed as an auditor, then if you are attracting disqualification, immediately vacate the office. Immediately leave the office. You are no longer permitted to continue as an auditor. You have to go out from the company's premises and stop doing the audit. You are no longer permitted to continue as an auditor. But however, there is one exception. Now when I say exception, what do I mean by exception? The general rule is you have to immediately vacate the office. But since I am saying exception, that means in some circumstances, in only one circumstance exactly, in one circumstance, if you attract subsequent disqualification, you need not vacate immediately. So what is that one circumstance? That one circumstance is if the reason for your subsequent disqualification is relatives face value of shareholding exceeding for more than face value of 1 lakh rupees. So as we have seen, a relative can hold shares, but up to how much face value? 1 lakh. See, at the time when you are getting appointed, either your relative does not hold any share, or your relative is holding the shares, but up to a face value of 1 lakh. But after you are validly appointed as an auditor, then he bought some extra shares and his face value has exceeded 1 lakh rupee. Then what should be done, sir? General rule is immediately vacate, but I am saying exception. So you should not vacate the office immediately. Then what you should do? Then what you should do is you should take some rectification action within 60 days. 60 days of time limit will be given. For what purpose? For taking rectification action. Now what could be the rectification action here? The rectification action here will be make your convince your relative and try to bring his shareholding up to face value of 1 lakh rupees. If you are able to do it within 60 days, you can continue. If you are unable to do it within 60 days, your relative's face value of shareholding exceeded 1 lakh rupees, you are given 60 days of time, but within that 60 days also you are unable to convince your relative, then what should happen is on expiry of this 60 days, then vacate the office. This is the only exception. In all other circumstances, vacate the office immediately. But if the reason for the subsequent disqualification is relative's face value of shareholding exceeding 1 lakh rupees, 60 days time will be given. Take whatever action you want to take within that 60 days. If you are unable to convince your relative and bring the face value of shareholding up to 1 lakh, then you have to vacate the office. So this is what section 141 talks about, most important section, and majority of the questions come from here only. So 141 subsection we have discussed, qualification, who is eligible. 141 subsection 2 we have seen signing, who can sign the audit report. 141 subsection 3 we have seen disqualification, who is not eligible. 141 subsection 4 we have seen, which is subsequent disqualification. After you are validly appointed, then if you attract disqualification, what you are supposed to do. This is what 141 section is dealing about. So the next concept which we will be revising. So first, basically section 141 is regarding eligibility, qualification, disqualifications, etc. Now the next few sections will be dealing about the procedural formalities. Like what is the procedure for selection of auditor? What is the procedure for appointment of auditor? What is the procedure for removal of auditor? What is the procedure for resigning? What if the auditor has to resign from the company? So like this, there are various procedural formalities. Let us try to have a quick revision of all those matters thoroughly. So starting with number one, the procedure for selection of auditor. How the auditor will be selected. So basically, all the companies, like if you take for example, the Tata Motors group of company want to appoint their auditors. First, they will, as we know, who is eligible for getting appointed. Like we have seen an individual who is a chartered accountant having certificate of practice or an audit firm. So if at all Tata Motors wants to appoint an auditor, there are thousands of individual practicing chartered accountants. There are thousands of audit firms. Out of these many options, how they will select one particular individual or one particular audit firm whom they deem fit for doing the audit. So what is that selection process? It is not so simple that one of the board of director have selected some person and that person will be appointed. The process is not going to be that simple. In the case of company kind of legal form, the decision is always a collective decision. By passing resolution, by having one common agreement, decisions will be taken. Similarly, for the selection of auditor also, there is one dedicated procedure given under Companies Act. Let us try to understand it. First of all, for discussing about selection procedure, the Companies Act has divided companies into two categories. Those companies where audit committee is constituted. So those category of companies where there is already a audit committee, or those other categories of companies where audit committee is not constituted. So in case if there is an audit committee in the company, then the selection process is going to be different. If there is no audit committee, then the selection process is going to be a bit different. Now, first of all, which companies are required to have an audit committee? So here we are giving the criteria. The following class of companies shall constitute audit committee. What are they? Listed companies, all public companies, if they fulfill any of these three conditions, not all the three, if they fulfill any of these three conditions, then they are also required to constitute an audit committee. So what are those conditions? If they are having a paid up capital of 10 crores or more, if they are having a turnover of 100 crores or more, or if they have outstanding loans or borrowings or debentures or deposits of 50 crores or more. So only these companies which fulfill this criteria, they are only required to constitute an audit committee. Remaining companies are not required to constitute an audit committee. So now what will be the procedure in case if the audit committee is constituted? So here the process is going to be something like this. If audit committee is already there, audit committee will do the analysis like how many number of partners are there in the firm, what is their experience, what is their existing client base, all these things they will study. Then audit committee will select an auditor, either an individual or an audit firm, and the auditor who has been selected, that name will be recommended. To whom it will be recommended? Basically it will be recommended to board of directors. Now, once the name has been recommended, two things can happen. Board of directors may agree with the recommendations of audit committee, or board of directors may not agree with the recommendations of audit committee. See, if the board of directors are agreeing with the recommendations of audit committee, then it is a favorable scenario. Very simple thing here. Since they agree with the recommendations, the same name will be recommended to shareholders. Shareholders will pass a resolution. Auditor, the selected auditor gets appointed. When the problem arises is board of directors do not agree with the recommendations of audit committee. Like audit committee saying so and so firm ABC and Co is suitable for doing the audit, but board of directors are not happy with that recommendation. So if the board of directors are not happy with the recommendation, first thing what they should do is they shall refer back the matter to audit committee. So what do you mean by referring back? Very simple. Just let the same thing known to the board audit committee. Sir, we are not happy with your recommendation. Please revise your recommendations. This is what the refer back means. Who will do the refer back? Board of directors. Now, after referring back the matter to the audit committee, two things can happen. So the two things which could happen is audit committee may change their recommendation. This is a favorable scenario actually. So what even audit committees thought is, okay, board of directors are not happy with our recommendations. Let us do the analysis once again and select a new auditor. Whereas sometimes what even could happen is audit committee is saying, we will not change our recommendation. We have all done all the analysis and selected suitable person only. So we will not change our recommendation. Anything could happen. So either they may change the recommendation or they may not change. Who can change or who cannot change? Audit committee. So if the audit committee changes the recommendation, well and good. Once again, the name will be recommended to board of directors. If they will agree, they will recommend the same name to shareholders. So it is not a problematic scenario. When the actual problem arises is if audit committee is not changing the recommendation. Board of directors are saying we are not happy with your recommendation. We will not accept. Audit committee is saying no, we have done selection properly only. We will not change our recommendation. Now, if you observe carefully here, there is a complete deadlock in the management. Now, in these cases only, generally, law will interfere and give superior hand to some authority between the two people. Now, if you see here, the conflict is there between audit committee and board of directors. Now, if the matter is left out as it is, the matter will proceed nowhere. So, between audit committee and the board of directors, someone should be given a upper hand. So who do you think has been given the upper hand? The act has given upper hand to board of directors only. So finally, if audit committee is not changing their recommendations, then superior power has been given to board of directors. Board of directors will select the auditor and that name will be recommended to shareholders. Now, to the shareholders, the board of directors should let them know some things. What are that? Let the shareholder know the fact that board of directors disagrees with audit committee. Let this fact known to shareholder. The audit committee has made recommendations of so and so auditor, but we are not happy with that. So we do not agree to that. That fact should be let known to shareholder. Not just the fact, even they have to let the shareholder know the reasons for which the board of directors have disagreed with the recommendations of audit committee. So now finally shareholders have the recommended auditor by the board of directors and they have the reasons also. Now they will take suitable action. So this is what going to be the appointment procedure. So very simple procedure. We have a quick recap. First, audit committee will select the auditor, recommend the name to board of directors. Board of directors may agree with the recommendations, may not agree with the recommendations. If they agree with the recommendations, well and good, that name will be recommended to shareholders and the shareholders will decide. So if the board of directors do not agree with the recommendations of audit committee, first the matter shall be referred back to audit committee. After referring back, and after referring back, two things can happen. Audit committee can change the recommendation, or audit committee may not change the recommendation. If they do not change the recommendation, the superior power rests with the board of directors. They will select the auditor, recommend the name to the shareholder, but let the shareholder know the fact and reasons. Now shareholder will take appropriate decision. Coming to the next part, sir, what if audit committee is not constituted? Here, all the headache has been eliminated. Audit committee recommending, we accepting, all these things will not happen. Simply what will happen is board of directors only will select the auditor, recommend the name to the shareholders. That auditor will be appointed by the shareholders. That's all. Here the process is going to be very simple. So this is what the process related to selection of auditor. Coming to the next topic, the next important thing is appointment procedure for auditor. Now, how the selected auditor will be appointed? what procedure has to be followed for appointment. Now we are basically going to concentrate on time limits. So for the purpose of appointment procedure, the companies are divided into two categories: government companies and the other one is non-government company. So procedure for appointment of government company is going to be different. Procedure for appointment of non-government company is going to be different. Now once again, in the government company also, two more categories: appointment of first auditor, appointment of subsequent auditor. Here also, in the case of non-government company, further two categories: appointment of first auditor, appointment of subsequent auditor. Now, so let us start with non-government company. How the first auditor? Nothing but first auditor means whoever is conducting the audit of the first financial year, that person we call him as first auditor. After the first financial year, subsequent years will be there. Whoever is conducting the audit of subsequent years, that person we call them as subsequent auditor. Starting with non-government company first auditor, very simple. Board of directors will do the appointment. That too within how many days? Within 30 days they will make an appointment of the first auditor within 30 days of incorporation of the company. If board of directors fails to do it, then the power will go to shareholder. They shall do it within next 90 days at an extraordinary general meeting. Now coming to first auditor of a government company, here and regulatory authority is going to involve. First the power will be there with C&AG and they will make an appointment. The power will be there with them within 60 days of incorporation. They shall do it. In case company incorporated 60 days over, if they fail to do it, then the power will go to board of directors. They shall make an appointment within next 30 days. If they also fail to do it, then the power will go to shareholders. They shall do it within next 60 days at an extraordinary general meeting. So this is the procedure for appointment of first auditor, both in the case of government company and also in the case of non-government company. Now what is tenure, sir? In both the cases, the tenure of the first auditor is going to be till the conclusion of first AGM only. Both here also and even here also, tenure will be till the conclusion of first AGM. Now, coming to subsequent auditor, here in the case of government company, the power has been given to C&AG, and within what time limit means they have clearly told within 180 days from commencement of financial year. Whenever the financial year commences, that is from 1st of April of the respective year, within 180 days, C&AG shall make an appointment of the subsequent auditor. Whereas when it comes to subsequent auditor of a non-government company, here the subsequent auditor will be appointed by shareholders at an AGM, and the auditor so appointed, he will continue in the office till the conclusion of 6th AGM. So here basically in the case of government company, the tenure is going to be till the conclusion of next AGM. So what is going to happen in the non-government company is, let us try to understand with the help of one simple example. So this is what basically appointment procedure. So all the things are pretty much straightforward to understand. The only thing where there is a scope even for testing a practical question is appointment of subsequent audit of a non-government company. This is going to be a bit complicated. So here basically what will happen is, now assume that the company incorporated on 1st of June 2015. So first financial year will be 15-16. For this first financial year, following these rules, first auditor will be appointed. Now what will be his tenure? Till the conclusion of first AGM. So now in the first AGM, assume Mr. A is appointed as first auditor. In the first AGM, Mr. A's tenure will get over. Now what will happen is, in the same AGM, the shareholders will appoint subsequent auditor. Assume Mr. B has been appointed as subsequent auditor. Now his tenure is going to be from the AGM in which he is appointed. Now you should start counting till the conclusion of 6th AGM. So whenever 6th AGM happens, now Mr. B's tenure will be over. In the same AGM once again, another subsequent auditor shall be appointed by the shareholders, and his tenure will be once again from this AGM till the conclusion of 6th AGM. So like this, once in every 5 financial years, appointment of subsequent auditor of a non-government company will happen. So this is what the procedure for appointment of auditor of a non-government company. So this is basically the complete procedures for appointment of auditors. So now let us try to understand few more things. Sometimes what will happen is you will appoint an auditor, but before their tenure gets completed, something could happen and a vacancy might get created in the office of an auditor. Like for example, just if you take the previous scenario, the subsequent auditor has been appointed. Mr. B has been appointed. He was supposed to stay in office till the conclusion of 6th AGM. He conducted audit of 2 years, but he expired in the third financial year. Now that position can't be left vacant. This we generally call it as casual vacancy. Casual vacancy means a vacancy created in the office of an auditor by any reason other than expiry of the term. A casual vacancy means a vacancy which is getting created in the office of an auditor by any reason other than expiry of the term. That means you still have some tenure pending. You still have some years of service left. But before you can complete your tenure, then only some circumstances have happened and that led to the vacancy in the office of the auditor. Like if I talk about examples of that circumstances, that could be death of an auditor, that could be resignation of an auditor, that could be even removal of the auditor by the company, or even that could be dissolution of the firm which has been appointed, or it could be even reason of subsequent disqualifications also. The reasons are going to be plenty. So by any reason, if vacancy gets created in the office of an auditor by any reason other than expiry of the term, that auditor's position should not remain vacant. Some steps should be taken to fill that vacancy. So what is that procedure for filling of casual vacancy? Here also we divide the companies into two categories. One is government company, other one is non-government company. The procedure for filling casual vacancy in the case of government company is different. The procedure for filling casual vacancy in the case of non-government company is different. In the case of government company, even casual vacancy power to fill the casual vacancy also, power has been given to C&AG, which shall happen within 30 days of such casual vacancy. Whenever that casual vacancy gets created, within 30 days of such casual vacancy, C&AG will fill that casual vacancy. Whereas if it is a case of non-government company, here they will ask us to check the reasons. Is it because of resignation, or is it because of any reason other than resignation? If it is by any reason other than resignation, like death, removal, whatever it is, so if it is because of any reason other than resignation, the process is very simple. Board of directors will do it within 30 days. Here one more thing, in the case of government company, C&AG shall do it within 30 days. If they fail, the power will go to board of directors within next 30 days. Whereas in the case of non-government company, if the casual vacancy got created by any reason other than resignation, the process is very simple. Board of directors will do it within 30 days. If it is a case of resignation, here also what will happen is board of directors will fill that vacancy within 30 days, but that appointment that appointment done by board of directors should be even approved also. Approved by whom, sir? Approved by shareholders. Within what duration? Within 3 months from board's appointment. So within 3 months from board's appointment, this appointment done by board of directors shall be approved by shareholders also at an general meeting. This is what the procedure in the case of non-government company to fill the casual vacancy. If it is the case of government company, there you need not check for any reason why that casual vacancy got created. Whatever may be the reason, C&AG within 30 days. If they fail, board of directors within next 30 days. We have to see for reason only in the case of non-government company. If it is by any reason other than resignation, only one authority, board of directors within 30 days. If it is because of resignation, here also board of directors will do the appointment within 30 days, but that appointment should be even approved by shareholders within 3 months and that too at a general meeting they are supposed to do it. So this is what regarding non-government company. So these are the procedures for filling of casual vacancy. Now I forgot to mention one more point here. Whenever the auditor gets appointed, after the appointment of auditor, this intimation about appointment of auditor should be done to the registrar ROC. How the appointment of auditor will be intimated to the ROC? By simple submission of one form, which is form number ADT1, which who has to file? Company has to file. Within how many days they have to file it? Within 15 days of auditor's appointment, form number ADT1 has to be submitted by the company to the ROC intimating about appointment of the auditor. This formality has to be fulfilled by the company by submitting form number ADT1. And one more point here, as we have seen, the auditor has been given the power to resign from the company, but he cannot just like that put a WhatsApp message to the directors from tomorrow I am not coming to the office. It's not like that. Here also you need to follow some protocol. Here what protocol has to be followed is auditor has to submit one form. Which form? Form number ADT3. With whom, sir? With ROC one copy, with company one copy, that is management of the company. In case if it is a government company, to C and AG one copy. If government company, if not government company, only to two authorities, ROC and company. If it is a case of government company, then only to three authorities you have to submit: ROC, company, and C and AG. So this formality has to be fulfilled by the auditor in case if he wants to resign from his position before his tenure comes to an end. So this is what basically related to procedure for filling casual vacancy. So three procedures we have seen: procedure for selection, procedure for appointment, and then we have seen even procedure for filling of casual vacancy. And as a part of this discussion, what is the procedure to be followed in the case of auditor's resignation? So four procedures we have seen. Now let us try to understand the procedures for removal of the auditor. Even the power has been given to the management also to remove an auditor before the expiry of the term. See, if auditor has been given the power before your tenure gets completed, you have a power to resign from the company. Similarly, before the auditor's tenure gets completed, even the management has also been given the power to remove an auditor. But for removal also, there is one dedicated and a standard procedure which has to be followed. So what is the procedure to be followed for removal of the auditor? Let us try to understand it. So the So what is that procedure for removal? Let us try to have an understanding. So the process for removal of an auditor actually starts with, the first step is, if the auditor has to be removed, first board of directors shall conduct a board meeting, and in that board meeting, board of directors resolution will be required, and this will be ordinary resolution only. If more than 50% is there, that is fine. So first, board of directors should conduct a board meeting. The process for removal actually starts with board of directors conducting a board meeting, and in that board meeting, a resolution will be passed. Which resolution? Ordinary resolution. Now, once board of directors pass a resolution, now the next step is, within 30 days, the company has to submit one form. Which form? Form number ADT2. For what? For to whom? To the central government, for the purpose of getting the approval of the central government for removal of the auditor. So what is the first step? Board of directors will pass a board resolution, ordinary resolution only, and within 30 days of that board resolution, company will submit one form which is going to be form number ADT2. With whom the form will be submitted? With the central government. Within how many days? 30 days, asking the approval of the central government for removing the auditor. Now, once the application has been made to the central government, two things could happen. Central government might give a approval for removal. Central government might not give a approval for removal. If the central government is not giving approval, the matter ends then and there. The auditor cannot be removed. If the central government does not give the permission, if the central government does not give the approval for removal of the auditor can't be removed. That's it. If the central government gives approval, then what will happen is, within 60 days of receiving such approval, within how many days? within 60 days of receiving such approval, the company shall conduct a general meeting, and in that general meeting, special resolution of the shareholders will be required. So if you follow these three steps, if you observe, three authorities are involved. One is board of directors by giving a board resolution, then central government's approval, and after giving central government approval also, the auditor cannot be removed. Even what is required? Special resolution. Who special resolution? Shareholder special resolution. Where it will be obtained? General meeting. Within how many days the general meeting has to be conducted? Within 60 days from which the central government has given the approval. So three authorities are involved: board of directors, central government, shareholders. Even if one of the authority did not give their approval, auditor can't remove it. Auditor can't be removed. So board of directors have passed a resolution. Central government gave an approval, but shareholders are not giving special resolution. Auditor can't be removed. Board of directors are ready to pass resolution. Shareholders are ready to pass special resolution, but the central government is not giving approval. Auditor can't be removed. See, not just the three authorities, even order of the activities also should be set. First board of directors resolution, then only central government's approval, after that only shareholder special resolution. Sometimes they might test you a practical question in which they will say board of directors have passed a board resolution, shareholders have also passed a special resolution, now they have submitted the central government approval, can the auditor be removed? No, it can't happen. Why? Because order also should be same. First board of directors, then central government, then the shareholders. Order also should be same. And one more point, they say before an auditor can be removed from his office, he should be given an opportunity of being heard. Just don't remove him just like that. Give him an opportunity of being heard. If he wants to explain some reasons to you, we have to listen to him. Then only auditor can be removed. So this is what the procedure for removal of auditor by the company. There is even one more procedure for removal. Even the tribunal has also been given the power to remove an auditor. So removal of auditor by tribunal. Now, what procedure tribunal has to follow for removal of auditor? So, if at all tribunal wants to remove the auditor, first somebody should make an application to the tribunal. Sir, who can make an application to the tribunal, sir? Generally, nobody can. Generally, no one mandatorily needs to make an application. Sometimes a tribunal on its own can initiate an action. If they came to know that auditor of certain company is doing some fraudulent activities without any complaint, tribunal on its own can initiate an action, or even central government also can make an application. And one more point, they say any aggrieved person or any person concerned. That means he could be shareholder also, he could be creditor also, he could be debenture holder, anybody. So any person concerned, so any of these people can make an application. Tribunal on its own can initiate an action, or central government can make an application, or any other person concerned can make an application. Once the application has been received by the tribunal, now the tribunal will initiate the proceedings. Now, as a part of that proceedings, they will have hearings of both the parties, auditor and also the person whoever has made an application. And as a part of that legal proceedings, if the tribunal is satisfied that yes, auditor has only acted in a fraudulent manner, tribunal is satisfied, finally auditor acted in a fraudulent manner, then tribunal will pass an order for removal, and on passing such order by the tribunal, the auditor stands removed from the company. This is very simple procedure given to the tribunal. And sometimes here they have told even one more point: if the central government is making an application, order should come out in a less time. Then the tribunal cannot take their own sweet time for passing an order. If the central government made an application, judgment should come out within 50 days, within 15 days. And not just that, in this case, the power to reappoint another auditor also will be given to the central government only. This is applicable only for central government. If the central government gave the application, order should come out within 15 days. And in that case, the power to appoint another auditor also will be given to whom? Central government only. Sir, what if others made an application and auditor has been removed? Then what will happen is it will be covered under normal casual vacancy cases. Whatever procedure we have seen for casual vacancy, the same steps we need to follow here also. This is what the removal of auditor by the tribunal. One more point here, in one of the disqualifications under 141 subsection 3 clause H, we have seen that if the court has convicted a person of conducting any fraud, until 10 years or not elapsed, the person can't be appointed as auditor of any company. There we have left out one note point. There the note point says that if the tribunal has convicted an auditor of committing some fraud, then only 5 years of disqualification. If the court passed an order, the same person can't be appointed for 10 years as an auditor of any company. If the tribunal is passing an order, then no need to wait for 10 years. For 5 years only, he can't get appointed as auditor of any other company. After the expiry of 5 years, he can be appointed as auditor of the company. No restriction. This is what the note point which we did not explain that, so that I have linked it now. So with this, we have seen the procedures for removal of the auditor also. The next most important concept we are going to discuss is rotation of auditors. The concept of rotation. Now, what is this concept of rotation is? This concept has actually been brought under Companies Act 2013. As the name itself says, rotation. You have to change the auditors after a certain period of time. So earlier what used to happen is once an auditor gets appointed, management generally will not change him. For 20 years, 30 years, the same person used to continue. But government realized that if a person is continuously acting as an auditor of some company for a certain number of years, he will become more familiar with the client. He will develop some sympathy towards the client. And even though he finds a mistake, looking from the perspective of the client, he might not give a negative opinion. This is what the governments have thought. And they thought that a person can't be allowed to act as an auditor for any number of years. After a certain number of years, the auditors of the company should be changed. So with that intention, this concept of rotation has been brought in. So now what is the procedure? After how many years auditor has to be changed? So all that provisions are given under Companies Act. Let us try to understand what are the provisions of the Companies Act regarding this rotation concept. So we'll go to the material and start looking the content from that. Yeah. First of all, is the concept of rotation applicable for all companies? No. Under section 139 subsection 2, there has been a criteria given. Only those companies which will fulfill the criteria, though they are only required to change their auditors. The companies which are not coming under this criteria, they can continue the auditor for any number of years. They need not change their auditors. Now, what is the criteria given? Number one, all listed companies. All the listed companies, if a company is listed with any recognized stock exchange, no need to check for any criteria. The rotation concept becomes applicable. If at all, the client company is a unlisted public company but not yet listed. If they fulfill any of the two conditions, then they have to change their auditors. What are that conditions? Number one, if they are having a paid up share capital of 10 crore rupees or more, or if they are having borrowings from public financial institutions or banks or public deposits of 50 crores or more. If any of these two conditions are fulfilled, then rotation concept becomes applicable for a public company which is unlisted. And even rotation concept is applicable for private companies also. And once again, subject to fulfillment of some conditions, if they have a paid up capital of 50 crore rupees or more, or here also any of the one condition, with borrowings from public financial institutions or banks or public deposits of how much? 50 crores here. Previously, they have told 10 and 50. Here, they are giving both the figures as 50. So, if these conditions are fulfilled, then these companies are required to change the auditors after a certain number of years. Now, if the company doesn't come under this criteria, there is no requirement on them to change their auditors. They can continue the auditor for any number of years. And specifically, this rotation concept is not applicable for one person company, small company. And even this rotation concept is not applicable for government companies also. Now, okay, sir, we understood applicability. Now, what is the manner of rotation? After how many number of years auditor has to be changed? So the sections of the Companies Act says that the manner of rotation should be in the said manner. If an individual is getting appointed as an auditor, if an individual person is getting appointed as an auditor, he can't be appointed for more than one term of 5 consecutive years. Whereas if an audit firm is appointed, irrespective of number of partners, an audit firm can't be appointed for more than two terms of 5 consecutive years. You can say 10 consecutive years. So now what is the meaning of this? The meaning here is if you are appointing an individual practicing chartered accountant as an auditor, he can be appointed for only one term of 5 consecutive years. After that 5 consecutive years, you have to change him. Similarly, if you are appointing an audit firm, you can appoint that audit firm for two terms of 5 consecutive years. That means you can appoint them for 10 consecutive years. After that, you have to change them. Which means Sir, once the individual completes 5 years of respective service, or once the firm gets completed their 2 terms of 5 consecutive years, can't they be reappointed back in the same company throughout their life? Not like that. So what the act is saying is, once the individual or audit firm completes their respective term as specified here, they have to give a gap of 5 years. And this gap generally we call it as break in service or cooling off period, we say. So once you complete this cooling off period of 5 years, once again the same individual or firm can be appointed, but once again for the same tenure of 1 term or 2 terms of 5 consecutive years. So what I'm trying to say, let us try to understand it with the help of example. So assume that an individual is getting appointed. He can do audit of 5 continuous years. Once he completes 5 consecutive years, then he has to give a gap of 5 years. For the coming 5 years, he can't be appointed. Once again, the same individual can be appointed, but once again, for what tenure? For 5 years only, he can get appointed. After that, he has to give a gap of 5 years, and then he can be reappointed once again for 5 more years. Now, coming to the audit firm, if they have completed, first they have been appointed for 10 continuous years. After that, they have to undergo a cooling period of 5 years. Once they undergo the cooling period of 5 years, once again the same audit firm can be appointed, but once again for 10 continuous years only. Then once again 5 years of gap, they can be reappointed once again for a tenure of 10 continuous years. So this is what the manner of rotation. With this rotation, the continuous relationship will get broken. So the auditor will not become so familiar and he will not show any kind of sympathy towards the client. This is what basically the manner of rotation. Now, as a part of this rotation, the act has even told few more points. They say that uh, assume that there is a firm ABC and Co. They have just now completed the audit of X Limited and they have continuously done the audit of 10 consecutive years. Now, can they get reappointed for the coming 5 years? No, they have to give a gap of 5 years, which we know. Now, the company X Limited is looking for appointment of some PQC and Co, another audit firm as a auditor during this 5 years. Can that happen? No, the act says no. Why? Because they say that if the outgoing auditor, the auditor whose tenure has been completed, and the incoming auditor, the auditor whom the company wants to appoint, if both are having common partner, what if both are having common partner? If there is a common partner between outgoing auditor who have completed their respective tenure and incoming auditor who is supposed to get appointed, if in both the firms there is one common partner, here there is one common partner. Now even this incoming auditor also shall not be eligible for getting appointed during that cooling period of 5 years. This is point number one. And one more thing they say, if the outgoing auditor and incoming auditor both are belonging to same network. Now what is this same network? Like for example, same if we take another example, there is a sole proprietor audit firm A and Co. Just now they have completed audit of 5 continuous years. They can't be appointed for the coming 5 years. Now the firm is looking for appointment of B and Co, another sole proprietor firm, as an auditor for this 5 years of cooling period. But the thing here is this outgoing auditor, this incoming auditor, both are belonging to same network. Sir, what do you mean by firms belonging to same network? Firms belonging to same network means those audit firms which are operating under same brand name, same trade name, or which are under common control. Like franchise models, we say no. If two or more audit firms are operating under same brand name, if two or more audit firms are operating under same trade name, so then we call them as same networking firms. If the incoming auditor, outgoing auditor, both are belonging to same networks, even such incoming auditor also can't be appointed during that cooling off period. One more thing they will specifically say here. So assume that there is a firm ABC and Co. just now completed 10 continuous years of audit for the client X Limited. So now they can't get reappointed for 5 years. Now Mr. A, who is a main partner in charge of the firm and who certified the financial statements, if this partner left this firm and joined another firm PQR and Co, then even this firm also can't be appointed during this cooling off period. So this point is going to be a bit different from common partner. In the case of common partner, a person is continuing as partner in both the firms. But in this case, a partner has resigned from the outgoing firm and joined another firm then also this incoming auditor can't be appointed during that cooling off period. So this is what the special points regarding this rotation. Very important concept, high chances of getting tested in the examination. So with this, we are done with all the procedural formalities. Now, the next few set of concepts which we need to revise are what are the rights of auditor, what are going to be the duties of the auditor. So this removal, all these things we have seen. Now let us talk about powers. What are the powers of the auditor? As we all know, since it is a statutory audit, powers and the duties will be decided by whom? The act itself will decide the powers and duties of the auditor. So what are going to be powers and duties of auditor? First, talking about powers, what rights are given to the auditor, and these rights, whatever I am going to say, these are the rights given under the act itself. So one is right of access to books and documents. Whatever books and documents your client is maintaining, all the books and documents we can have access at all times. We can have access provided they are working days and business hours. And also we can not just, our access is not just restricted to financial books. We can have access to any book like minutes book, etc. And even if we are doing consolidated financial statements audit, we will even have access to subsidiary company, associate company, and joint ventures books of accounts also. Not just that, from the books of accounts, if you need any extra clarity, you can even obtain that additional information and explanation also. You will have right of access to books and documents, but not just that, even you can obtain additional information and explanation. The client has given you books. In that books of accounts, you need some clarification. Do you have the power to get that extra clarification? Yes. Who is responsible for giving that clarification to you? Either the management or employees, whoever it is. You have a right to get extra information and explanation. Not just that, the auditor is having right to attend for general meetings. Whenever general meetings gets conducted, auditor is having a right to go and attend that. Not just attending the general meetings, he is even having a right to receive notices of all the general meetings. Whenever general meetings are getting conducted, the company will generally circulate a copy of notice to each and every shareholder. That copy of the notice must be sent to even auditor. And he is having the duty also. It is not just a right of auditor to attend general meetings, it is even his duty also. And in addition to that, he will even have right to report to the shareholders. Whatever the auditor's findings are there, all that findings will be even reported to the shareholders also in the form of audit report. And finally, one more thing, he will have even right of lien also. If the client is not giving him the audit fees, you can exercise right of lien. On what you will exercise right of lien? On the books of accounts of the client, you can exercise right of lien. That means you can retain the possession of the client's books of accounts and say that, sir, if you pay me the audit fees, then only I will give you back your books. But the problem is, even though the right of lien has been given to the auditor, but it is impracticable for the auditor to exercise it. Sir, why it is impracticable? One is because of section 128, which says books of accounts are required to be maintained only at the registered office. So if you want to exercise right of lien, you have to move the books of accounts from registered office to the auditor's office. Then you yourself will be violating the provisions of the Companies Act. So because of section 128, and also today books of accounts are maintained in the electronic format, and even there are some case laws which say that it will be unprofessional on the auditor to exercise a right of lien. So because of all these reasons, even though right of lien has been given to the auditor, but practically it might not be exercisable. Then talking about what and all are duties of the auditor. Coming to the duties of the auditor, first, it is not just right of the auditor to prepare a report, it is even duty of the auditor to prepare a report. Why? Because people will say audit is completed only when you prepare your final audit report. So reporting is not just a right, it is even duty also. Not just preparing the report, even auditor is having the duty to sign the audit report. Why? Because without your signature, audit report is not going to be valid. So you have to sign the audit report. And as I have told, it is not just right of the auditor to attend general meeting, it is even duty to attend the general meeting. Why? Because Companies Act says the auditor shall attend general meeting. That means they have made it a compulsion to attend the general meeting. And this duty and right to attend general meeting is not just restricted to AGMs. He can even go, he has to even go and attend extraordinary general meetings also. So in the general meeting, whether financial statements are getting discussed or not, all that things also irrelevant whenever general meeting is happening, be it AGM or EGM, be the financial statements discussed there or not discussed there. It is both right of the auditor and also duty of the auditor to attend that general meetings. So he has a right, he has a duty to attend the general meetings, and even he has to do the audit after complying with standards on audit. It is not like you have to do the audit as per your own wishes. You have to do the audit after compliance with the standards on audit. That is also your responsibility. So these are powers and duties of the auditor given to him under Companies Act itself. Now there is one more particular duty which we need to understand, which is the duty given under 143 subsection 12 for the purpose of fraud report. So during the course of audit, if auditor comes to know about any fraud, he needs to follow some reporting requirements. So what will be that reporting requirements? Now for the purpose of this reporting requirements, the Act has divided frauds into two categories. On what basis, sir? On the basis of amount. The frauds in which the amount involved is 1 crore or more. The frauds in which the amount involved is less than crore. So in both the cases, reporting requirements are going to be different. So talking about reporting requirements in case if the amount involved is 1 crore or more. So here the reporting requirements will be something like this. First of all, the moment you come to know about fraud, you have to report the matter to audit committee if it is there. If audit committee is not there, to the board of directors, auditor should report the matter. Within how many days, sir? Within 2 days of knowledge of the fraud. Now, after communicating the matter with audit committee or board of directors, we have to give them 45 days of time for receiving replies. You communicate with them within 2 days. Like if I know about the fraud today, I will report it by tomorrow or day after tomorrow. Once the matter has been communicated with audit committee or board of directors, I have to give them how much time? 45 days of time I have to give. For what purpose? For getting replies. Now, after giving 45 days of time, if reply is received, then what the act says is within 60 days, 15 days of receiving reply. Then how many days? Within 15 days of receiving reply, this fraud has to be reported to central government by the auditor by submitting a form number 884. So if you observe here, in case if the amount involved is 1 crore or more, the matter must be reported to central government. And who has to report it? Auditor has to report it. By submitting which form? Form number 884, the auditor has to submit and report this to central government. So this is what the procedure. If audit committee or board of directors, if the amount involved in the fraud is 1 crore or more, first the matter has to be communicated with audit committee or board of directors. Within how many days? 2 days. And give them how many days of time? 45 days. For what purpose? Replies. If reply is received within 15 days, now if reply is received within 15 days of receiving the reply, the auditor shall report this fraud to central government by submitting one form called what? ADT4. And all this information should be submitted on letterhead of the auditor, which will contain all the details of the auditor, like what is the name of the audit firm, what is his address, what is the contact number, what is the official communication, and that letterhead should be signed by the auditor, and even it should contain the seal of the auditor also. Nothing but the stamp also should be there. And when I say you have to report this matter to central government, to whom in the central government? Generally to the Secretary, Ministry of Corporate Affairs. To that authority you have to send your form number 84. So this is what the procedure which you need to follow in case if the amount involved in the fraud is 1 crore or more. Sir, what if the amount involved in the fraud is less than a crore, sir? Here what will happen is your central government reporting doesn't become applicable. Then what will happen? Here also what we do is first the matter will be communicated with audit committee or board of directors. Within how many days? Within 2 days. And what we will basically report? Three things we will report. Nature of the fraud along with description. What is approximate amount involved in the fraud? And who are the parties involved in the fraud? So these three information will be submitted by auditor to audit committee or board of directors within how many days? 2 days. That's all. Your responsibility will come to an end with that. You are not supposed to do anything extra. Just submit this information to audit committee or board of directors within 2 days. That's all. Nothing else will be required. Now, auditor's responsibility will come to an end, but board of directors will have one more responsibility here. Board of directors will give something called a separate report, board's report they will give. In that board's report, board of directors shall disclose some information, not auditor guys. Who shall give disclosure? Board of directors. Where they have to give disclosure? In the board's report. What disclosure they have to give? The same above three information, nature, amount involved, parties involved, along with that what remedial actions are taken. Auditor has reported the fraud. No, on that what remedial or rectification actions are taken by the management, this information has to be disclosed. Where it has to be disclosed? In the board of directors report it has to be disclosed. So this will be the fraud reporting requirements as per 143 subsection 12 regarding the fraud. So on the basis of the amount, two kinds of reporting requirements are given. So let us now try to understand the remaining concepts from this particular chapter. Right. So now we have three more concepts to revise, which are going to be branch audit. Then we have to revise a concept called joint audit. Then we have to revise a concept called cost audit. And along with that, there is even one more topic to discuss, which is regarding secretarial audit. So we'll try to revise them quickly. First, we will start with branch audit. So what is basically this branch audit is? Generally, if you are conducting audit of a company, it's quite common for the company to have multiple places of business. They will have one registered office. Along with that, they can have so many number of branch offices also. In normal circumstances, what will happen is the person whoever is getting appointed as auditor for the company, he will only take care of all the audit of the branches also. But either at the request of the auditor or the company on their voluntary decision, sometimes they might take a call that the accounts of the branch will be conducted by one separate person. That person we call him as branch auditor. Let us assume a company X Limited. It is having a head office. It is having branch 1. It is having branch 2. Now company appointed some person Mr. A as an auditor of a company. And the company has decided that for branch 2 alone, separate person Mr. B will be appointed as an auditor. Now this person Mr. B will be called as branch auditor, and the main auditor whoever has been appointed for auditor as a company, that person will be called as principal auditor. So now what are the provisions regarding this branch audit? First of all, who is eligible for getting appointed as a branch auditor? Now, what is the act saying regarding the appointment of branch auditor? So like if you see here, who can be appointed as branch auditor? In normal circumstances, as I have told, the auditor whoever has been appointed for the company, the principal auditor himself will take care of audit of all the branches. Or if the company decides to appoint any separate auditor, they can appoint a chartered accountant having certificate of practice. Now sometimes company will be incorporated in India, but they might have a branch in a country located outside India. Now, who can do the audit of such a branch which is located outside India? They say that even if the branch is located outside India, the principal auditor himself can do it, or any other practicing chartered accountant from India can go and do it. And one more thing they say that a person who is duly qualified to act as auditor of the accounts of the branch office in accordance with the laws of that respective country, which means if if my client is a company located in India, they're having a branch in US. Who can do the audit of accounts of the branch located in US? Either company's principal auditor himself can do, or any other practicing chartered accountant from India can go and do it. Or even what could happen is a person who is eligible to act as auditor as per the laws of the country like US, like the local CPA. Here we have chartered accountant, there they have CPA. Even a local CPA also can do the branch audit. And not just that, if a branch is located in UK, the local ACCA who is eligible to act as auditor as per laws of that respective country can also be appointed as an auditor. So these are the people who can do the branch audit. So now who will appoint the branch auditor? So generally branch auditor also will be appointed by the members only. But if the shareholders want, they can delegate the power to the board of directors. If the power is delegated, yes, then even the board of directors also can make an appointment of an auditor. Now, what will be the reporting requirements? So, generally, branch auditor, after completing the audit, he will prepare an audit report. Now, that audit report will be prepared exclusively on the accounts of branch alone. Now, after submitting this branch audit report, after preparing this branch audit report, this will be circulated to the principal auditor. Now, principal auditor, using his work and also using branch auditor's work, he will prepare one single audit report on the entire company, and that audit report will be circulated to the shareholders. The thing here is what? First, branch auditor will prepare a branch audit report. That report will be circulated to principal auditor. Now, principal auditor using branch auditor's work and also using principal auditor's work, he will prepare an audit report on entire company, and this report will be circulated to shareholders. And whatever reporting requirements that are applicable for principal auditor, all the reporting requirements are equally applicable even for branch auditor also. So this is what the concept of branch auditor. Now coming to the next concept, which is regarding joint audit. The name itself says, what do you mean by joint audit? Joint audit means when more than one auditor has been appointed for the same company and also for the same financial year and also for the having same scope. Same company, same financial year and also having same scope. So if the company is appointing more than one auditor, when I say more than one auditor, it could be more than one individual. Assume that Mr. A and Mr. B, two practicing chartered accountants, are appointed to conduct audit of Reliance Industries Limited of the same financial year 2021. Now this is a joint audit. When I say more than one auditor, it could be one individual or it could be one audit firm also. Like a person, Mr. A and a firm PQR and Co. If individual and an audit firm has been appointed to conduct an audit of one company for same financial year. Or even it could be more than one audit firm also. So, when more than one auditor has been appointed for conducting audit of same company for the same financial year, and also if they have same scope of work, such an audits we generally call them as joint audits. And when I say more than one auditor, it could be more than one individual, it could be more than one audit firm, or even it could be a combination of individual and audit firm. Sir, why basically joint audit will be implemented, sir? Why the companies generally implement the joint audit? As we all know, no company will do anything unless they find some benefits. So what are the benefits of joint audit? As we could see here, it reduces the workload of an auditor. And also it ensures timely completion of work. Audit can be completed within less time. It can solve the critical problems. Why? Because more than one professional is doing the work there. Quality of the audit gets quality of audit gets improved, and even it promotes healthy competition among joint auditors also. And under joint audit, it is possible to get the extensive knowledge of different auditors. Since you are appointing more than one person, they can share their expertise and ultimately provide better service to client. So because of all these advantages, in the recent times the clients have started going for joint audit. Now, joint audit doesn't bring only advantages, along with that, it is even bringing so many disadvantages also. Like what? It will have the auditors might have superiority complexes, like ego complexes. One person might not coordinate with each other. And also, it is not suitable for small entity because it is a little bit costly. When you appoint one professional, when you make an appointment for more than one professional, obviously the cost is going to get increased for the company, and the joint auditors might not coordinate with each other. They have coordination problems, and sometimes because of others mistake you have to face the consequences. And if there is any common area, that area will get neglected. And one more major problem among the joint auditors is they have to share their fees. Earlier, if you single-handedly do the audit, all the fees you have to receive. Now, since one more person is appointed along with you, you have to share the fees with him. So like this, these joint audit is coming along with disadvantages also, like ego complexes, higher cost for the company, sharing of fees among the auditors, lack of coordination. Because of others' mistake, you have to face the consequences. So all these disadvantages are also there. Now, whenever joint auditors are appointed, what is the mechanism of the work? How the work will happen? Do you think all the auditors will do audit separately? Assume that in the case of SBI, there are 12 audit firms who have been appointed, who are principal auditors actually. Yes, joint audit is a reality. It happens in the real world also. So audit of SBI is a joint audit. 12 audit firms are appointed. Since 12 audit firms are appointed, will they do audit separately? And 12 times audit will happen? No. When joint auditors are appointed, they will divide the work among themselves on various bases. So generally how the work will be divided, sir? It could be on the basis of items of financial statements. Like they can divide work on the basis of assets, liabilities, incomes, expenditure. One joint auditor is saying, I will look after incomes and expenses. Other joint auditors are saying, I will look after assets and liabilities. So like that on the basis of items of financial statements. On the basis of geographical locations, region wise they can divide. Or on the basis of period of financial statements, I will look after first 6 months, you will look after next 6 months. Or even on the basis of identified units like different businesses. Like if Reliance Industries Limited is there, they are into multiple businesses. Joint auditors can divide the work on the basis of businesses. One joint auditor is saying, I will look after petroleum business and telecommunication. Other person is saying, I will look after retail segment and fashion segment. And one more thing, the division of work among all the joint auditors has to be documented. On what basis they are dividing the work, that should be put on a piece of paper and everybody have to sign it. Then what about responsibility? Generally, normal circumstances, what will happen is the joint auditors will be held responsible only for the work which was allocated to him. Assume two joint auditors shared the work on the basis of period of financial statements. A company has appointed more than one individual. So assume that Mr. A and Mr. B, they have divided the work on the basis of period of financial statements. Mr. A told he will look after the data from April to September. Mr. B told he will look after the data from October to March. So now Mr. A will be held responsible only for the misstatements which he was not able to identify in the April to September related transactions. Mr. B will be held responsible if he was committed some mistake in the October to March month transaction. Assume that these auditors gave the positive opinion and subsequently it was found out that there was a fraud happened in the company. And it was proven that the fraud happened in the month of July. Who will be held responsible? Only A will be held responsible. So in normal circumstances, each joint auditor will be held responsible only for the work which was allocated to him. However, in some circumstances, all the joint auditors will be collectively responsible. When, sir? When there is undivided work, some work was not divided. If in that work something goes wrong, who will be held responsible? All the joint auditors. Or if they have taken decisions collectively, if a decision has been taken by all the joint auditors collectively and that decision only has gone wrong, who will be held responsible? Everybody. Why? Because everybody has collectively taken the decision. Along with that, matters which are brought to the notice of all joint auditors. Information has been brought to the notice of all the joint auditors. For example, Mr. A has found out some mistake. Now he did not keep that misstatement to himself. He even communicated with Mr. B also. Now none of them have taken an action. If it was subsequently proven, who will be held responsible? Not just Mr. A. If he had kept the misstatement to himself, only A would have been held responsible. But since he has brought to the notice of Mr. B, if A is not taking action, B should have taken the action. If you don't know the information, you could have ignored it. But since you came to know about the information, if this person is not taking action, you should have taken the action. So that's why the act will punish even you also. So that's why if the matter has been brought to the notice of all the joint auditors, then everybody will be held responsible. Along with that, whether the financial statements are prepared and presented as per applicable financial reporting framework or not. So financial statements follow standards. Financial statements are prepared as per Schedule 3. Checking this is also responsibility of all the joint auditors. And also finally, whatever audit report they are giving, whether that audit report is complying with respective standards or not, checking that is also responsibility of all the joint auditors. So this is what relationship among joint auditors. Normal circumstances, everybody will be held responsible only for the work which was allocated to them. But in 5 cases, there will be collective responsibility. Number one, if the work is not divided. Number two, decisions taken by all the joint auditors. Number three, matters which are brought to the notice of all the joint auditors. Number four, the financial preparation of financial statements as per applicable financial reporting framework. Number five, whether the audit report is complying with the relevant standards or not. Now, what about reporting? When the joint auditors are appointed, how the reporting will happen? So if there are 12 joint auditors for SBI, do you think there will be 12 audit reports for SBI? The answer is no. Then how the reporting will happen? Generally, what will happen is all the joint auditors will come together collectively, form one common conclusion. That one common conclusion will be expressed through a single audit report. like 12 joint auditors of SBI, after completing all their audit, they will sit together. If everybody has agreed that financial statements are free from material misstatements, everybody will give only one single audit report in which they will give positive opinion signed by all the joint auditors. In case, what if there is a disagreement? See, when everybody is agreeing, no problem. When the problem arises, when there is a disagreement. Now assume that out of these 12 joint auditors, 11 are saying we will give positive opinion. One is saying I will give negative opinion. Now what this disagreeing person should do? 11 people are saying we will give positive, whereas one person is saying negative opinion. Now what this one person should do? Should he go with majority? No, the standard doesn't say that. Then what does the standard say? The standard says that if there is any disagreement, the no auditor is required to go with the majority. He will give a separate audit report containing a separate opinion. Now, if you observe, there will be two audit reports. One audit report which is signed by 11 joint auditors containing positive opinion, one audit report which contains a negative opinion signed by one joint auditor. So now which report will be circulated to shareholders, sir? Both the reports will be circulated to shareholder. Which report should the shareholder rely, sir? That is up to his choice. Let him decide. Our responsibility will come to an end once we share the information. Since there will be reasons also given, let the shareholder himself decide which opinion he wants to believe. So this is what the reporting requirements. This is what the discussion related to joint audit. Let us now try to revise the concept regarding cost audit. So whatever revision we have done till now, the discussion related to qualification, disqualification, and the discussion regarding various procedural formalities relating to audit. So all these provisions, whatever we have revised till now, those are normally related to statutory audit. And we basically call it as company audit also. And even some people call it financial audit also. So till now, whatever provisions we have seen, whatever procedural formalities we have seen, whatever qualities, disqualifications, everything, whatever we have seen till now, all that are related to statutory audit, which is otherwise called as company audit, which is also called as financial audit. Now, apart from this financial audit, apart from this statutory audit, some companies are required to undergo even the audit of their cost records also. That we call it as cost audit. In the financial audit, the auditor will be mainly concerned with financial accounts or financial records, you can say. Basically, books of accounts, financial statements. This is what statutory auditor is concerned with. But whereas when it comes to cost auditor, he will be concerned with the cost records. So let us try to understand now what are the requirements of the cost audit which are covered under section 148 of the Companies Act, which is going to exclusively talk about the provisions relating to cost audit. So let us try to understand now what this cost audit is and what does section 148 say. Before we talk about cost audit, first we need to understand something called cost records. Now, does every company require to maintain cost records? First of all, no. Cost records itself is not mandatory applicable for every company. So which companies are required to maintain cost records? Which companies are not required to maintain cost records? That applicability criteria has been given under section 148. So now what is that applicability criteria? Which companies are required to maintain cost records? First, let us try to have a revision of that. So like if you see here, according to Companies Act, applicability of cost records, which companies are required to maintain cost records. So the following conditions should be satisfied, including foreign companies. When I say foreign company, a company which is incorporated outside India but having a place of business in India. So which conditions are required to be fulfilled? The company must be engaged in production of goods or providing services. That means either an entity should be a manufacturing entity or it should be a service industry. If you observe carefully here, for trading industries, cost records doesn't become applicable. Like if the company is in wholesaling business, if the company is in retailing business, for that company's cost records will not become applicable. Why? Because number one, the condition number one is the company must be engaged in production of the goods or providing of the services. And not just that, even one more condition is required to be fulfilled. It must be having an overall turnover from all its products and services of 35 crores or more during the immediately preceding financial year. So two things they are trying to say here: the company must be either a manufacturing entity or a service sector entity, and also it should have an overall turnover from all the products and services should be how much? 35 crores or more, which I simply put it greater than or equal to 35 crores. If these two conditions are fulfilled, then cost records become applicable. If the company is not fulfilling both these any of these two conditions, then cost records doesn't become applicable. However, even though some companies are fulfilling the set two conditions, if they have certain extra fulfillment, then cost records will be exempted for them. So what are that exceptions? Even after complying with the above conditions, if you fall under the category which they are going to say now, cost records are not required to be maintained. So for whom it has been exempted? It is if the company is classified as either as a micro enterprise or as a small enterprise under Micro, Small and Medium Enterprises Development Act, MSMED Act. So, and that too also under MSMED Act, three kinds of entities will come. Micro entities will come, small entities will come, medium entities also will come. Now, exemption is given only for micro entities and small entities. For medium entities, even though if it is covered under MSMED Act, cost records becomes applicable. Whereas if your client is getting recognized as either a micro enterprise or a small enterprise under MSMED Act, and if they are fulfilling the above two conditions, still they are not required to maintain the cost records. Clear? Now, coming to the next few provisions for the purpose of and in what format you have to maintain the cost records. Cost records are required to be maintained in the form CRA1. That should be the format for maintenance of cost records. So those companies who have met the applicability criteria, they are required to maintain cost records, and the format for maintenance is CRA1. And those cost records should be maintained in such a manner that from that cost records, I should be able to calculate per unit cost of production, per unit cost of operations, per unit cost of sales, and profit margins also I should be able to calculate per unit. So this is what the format for maintenance of cost records. Now, sir, every company which is maintaining cost records, are they required to undergo mandatorily cost audit? No. Only few companies are required to maintain cost records. And from that also, all the companies which are required to maintain cost records are not mandatorily required to undergo cost audit. For cost audit, one more applicability criteria has been given. Now, what is that criteria for the cost audit? Let us try to understand. And for the purpose of this cost records and cost audit, the companies are broadly divided into two categories depending on the business in which they are engaged into. One is regulated sector, other one is unregulated sector. Under regulated sector, there are six companies which are notified like telecommunication, petroleum, drugs and pharmaceuticals, fertilizers, sugar and industrial alcohol, generation, transmission, distribution and supply of electricity. These six will come under regulated sector. Whereas under unregulated sector, there are total 33 businesses which are prescribed. I'm giving here example for example sake, only five examples have been given here, but a total of 33 kinds of businesses are specified under unregulated sector. For what purpose these entities are segregated? For the purpose of determining cost records and cost audit applicability. Now let us try to understand cost audit applicability. Now we are going to decide whether cost audit is applicable or not on the basis of business in which the company is engaged. If the company is engaged only in the regulated sector, which means if the company is engaged in any of the above six businesses, then when the cost audit becomes applicable. Here two conditions they have given. One is overall turnover, overall annual turnover of the company from all its products and services during the immediately preceding financial year, during the last financial year is 50 crore rupees or more, and the aggregate turnover of the individual products covered in this sector is 25 crores or more. So the calculation is going to be a bit tricky here. So if the company is engaged in any of the six regulated business, two conditions they say. One is overall turnover from all the products and services in the immediately preceding financial year shall be greater than or equal to 50 crores. And one more condition what they say here is aggregate turnover of the products which are covered in this sector, particularly regulated sector. If it is greater than or equal to 25 crores, then only cost audit will become applicable. Now, how to calculate this? Let us have a look at the calculation part. So assume that the company is in manufacturing four products A, B, C, and D. So it is there into manufacturing business. Now, let me give you the details of the turnover of this products also. Product A is having a turnover of 15. Product B is also having a turnover of 15. Product C is having a turnover of 10 and product D is having a turnover of 15. All the amounts are in crores. Now, product A is mentioned under regulated sector. Product B is also coming under regulated sector. Now, let us see how to check the conditions. First one, they say overall turnover. So now what is the overall turnover from all the products and services? So if we do the totaling here, it's going to be somewhere around 55. So is the first condition satisfied? Yes. Overall turnover is greater than or equal to 50 crores. Now coming to the next condition, which is aggregate turnover of the products which are covered in this sector. So which products are covered in this sector? A and B. What is the aggregate turnover of these two products put together? 30, which is greater than or equal to 25 crores. So since both the conditions are satisfied here cost audit becomes applicable. So this is how we need to calculate the limits for cost audit applicability in case if the company is engaged in regulated sector. Now, what if the company is engaged in unregulated sector? The manner of calculation is going to be same, just the amounts will change here. So in case if the company is engaged only in the non-regulated sector, then the conditions to be checked for applicability of cost auditors, the overall turnover of the company from all products and services during the immediately preceding financial year is 100 crores or more, and aggregate turnover of individual products or services covered in this sector is how much? 35 crores or more. Same, the manner of calculation is going to be same like the way we did in the previous case. Just what is changing here? Amounts. In the previous case, they say overall turnover is greater than or equal to 50 crores, whereas aggregate turnover of individual products covered in this sector is 25 crores or more. Whereas in case if the company is engaged in non-regulated sector, then they say overall turnover should be greater than or equal to 100 crores. Then aggregate turnover of individual products covered in this unregulated sector should be greater than or equal to 35 crores. That's all. Now, even though some companies fulfill the above conditions, but if they satisfy some extra criteria, then they will be exempted from the cost audit. So what are that conditions which will make the company exempted from the cost audit? Let us have a look at it. So any of the three conditions they need to comply. The company whose revenue from exports, that too in the foreign exchange, exceeds 75% of its total revenue. Out of the total revenue of a company, more than 75% of the revenue, if it is in the form of exports, then for that company, even though they fulfill the above criteria, cost audit doesn't become applicable for them. Or a company which is operating from SEZ, the company is operating from a special economic zone, then even though they fulfill above conditions, still they are not required to undergo cost audit. Or a company which is engaged in generation of electricity, that too for captive consumption. Some company is there which is engaged in the business of generating electricity, but not for the purpose of selling or distribution. They are generating the electricity for their own production consumption related activities. Then also this cost audit will be exempt. So even though if a company fulfills above conditions, but if they satisfy any of these three criteria, then they will be exempted from cost audit. Once again, I am telling not all the three conditions are required to be satisfied. Any one of these three conditions. So this is regarding cost audit applicability. Now let us try to understand who is eligible for doing cost audit, what will be his procedure for appointment, all these things we'll try to cover. So who can be appointed as a cost auditor? When it comes to company auditor, who can be appointed? Chartered accountant in practice. Whereas when it comes to cost audit, a cost accountant in practice only can be appointed as a cost auditor. And not just that, they say one more point. The person, whoever is appointed as company auditor, the same person can't be appointed as a cost auditor. Which means company auditor, cost auditor, both cannot be same person. Then coming to disqualification. Sir, will the cost auditor have any disqualifications? Yes. Whatever disqualifications that are applicable for a company auditor, all that disqualification will be applicable even for cost auditor also. Now, who will make an appointment of the cost auditor, sir? Simply board of directors, be it first auditor, subsequent auditor, whoever it is, the cost auditor will be appointed by board of directors. Within what duration? Within 180 days of the commencement of every financial year. However, if there is an audit committee will select, recommended, all that process will be there. But appointment should happen within 180 days from the commencement of financial year. And before that appointment is made, the cost auditor should submit some documents. He has to give written consent. What written consent he has to give regarding three matters? that he is eligible for appointment and he is not attracting any of the disqualifications. And also he satisfies all the criteria specified under section 141. Once again, qualifications and disqualifications. And also his appointment is within the limits. Nothing but even cost audit also, they will come within the limit of 20. If he is accepting this audit, whether the limit of 20 will be fulfilled or the 20 limits get exceeded, this written certification should be given by the cost auditor to the company before his appointment. Before appointment, and one more thing also, list of proceedings. If there are any pending cases against a cost audit. So regarding four matters, the auditor should give written consent. Number one, that he is eligible, he has satisfied all the conditions. Number two, he is not attracting any of the disqualifications. Number three, his appointment is within the limits. Number four, the list of pending cases, the list of proceedings against the auditor or any of audit firm or partners. And once the auditor gets appointed, cost auditor gets appointed, that information is required to be communicated with some regulatory authority. Which regulatory authority? Central government. Who should communicate? Company should communicate with the central government regarding the appointment of cost auditor by submitting a form. Which form, sir? CRA2 they have to submit. Within how much time limit? Within 30 days. They say two things here. Either within 30 days from the date of board's appointment or within 180 days from the commencement of the financial year, whichever is earlier. The appointment of cost auditor should be intimated to the central government by submission of one form CRA2, which should be submitted within 30 days or 180 days from the commencement of the financial year, whichever is earlier. And the remuneration of the cost auditor will be decided by the board, and which will be recommended by audit committee. Rights and duties, everything will be same like company auditor. And what is the tenure, sir? The tenure of the cost auditor will be till the time he submits the audit report or within 180 days from the closure of the financial year, which means there is the implied time limit on submission of cost audit report. The cost auditor shall submit the cost audit report within 180 days from the closure of the financial year. And then removal. Who can remove the cost auditor? Simply the board of directors by passing a board resolution. They can remove the auditor. No central government approval, no shareholder special resolution. Sir, what if there is a casual vacancy? Who will fill it? Once again, board of directors only will fill it within 30 days of such occurrence of the casual vacancy. And even this information is also required to be submitted to the central government in form number CRA2 within 30 days from the casual vacancy. So these are the procedural formats. Now coming to reporting requirements. So what are the reporting requirements of the company? First one, the cost auditor concerned, he will submit first, cost auditor will submit his report to board of directors by submitting a form called form number CRA3. Within how many days, sir? Within 180 days from the closure of financial year, the cost auditor will submit the cost audit report in form number CRA3 to the board of directors. Now, what board of directors should do is they should submit the report to the central government in form number CRA4. That will be the reporting requirements. So, if we observe here, first the cost auditor will submit his cost audit report to the board of directors in form number CRA3. In what time limit? Within 180 days from the closure of the financial year. And then what board of directors will do is they will submit the report to the central government in form number CRA4, that too within how many days? 30 days from the date of receipt of cost audit report by the board of directors. Whenever board of directors have received the report from the cost auditor, from that date within 30 days, the board of directors will submit one more report to the central government in form number CRA4. So this is what the provisions regarding cost audit. So we have seen applicability, who is eligible and not eligible, and procedural formalities along with that report. Now there is one more aspect which we understand, one more topic, which is the secretarial audit. So as the name itself says, like we have seen, company audit will be done by chartered accountant in practice, cost audit will be done by cost accountant in practice, and one more audit will be applicable, which is secretarial audit, which has to be done by company secretary in practice. And once again, secretarial audit is also not mandatory for all the companies. For that also applicability criteria has been given. Let us see criteria. Section 204 subsection 1 says about this applicability criteria for secretarial audit. Let us see which companies have to undergo the secretarial audit. If it is a listed company, no need to check for any condition, or secretarial audit will become applicable. And also, if it is a public company but not at list, if it satisfies any of the two conditions, What are they? If they have a paid up share capital of 50 crore rupees or more, or if they are having a turnover of 250 crore rupees or more. If any of these two conditions are fulfilled by a public company, then they have to undergo secretarial audit. Not just that, one more condition. Every company, when I say every company, it could be public company also, it could be private company also. If it is any company having outstanding loans or borrowing from banks or public financial institutions of 100 crores or more. So if you analyze this, what they are trying to say is, if it is a public company, impliedly any of the three conditions. One is condition regarding paid up capital if it is more than or equal to 50 crores, and other one is turnover greater than or equal to 250 crores, and also outstanding borrowings greater than or equal to 100 crores. Any of these three conditions. If it is a private limited company, only one condition, if they have outstanding borrowings of greater than or equal to 100 crores, then the secretarial audit will become applicable. So you have to analyze it a bit in a detailed manner. And not just Companies Act, even now SEBI's LODR regulations also say that every listed company in their annual report, they have to attach one more report called Secretarial Audit, both as per Companies Act and also as per SEBI related LODR regulations. Listed companies are required to get a secretarial audit. Now, who can act as a secretarial auditor? As we have already told, a company secretary having a certificate of practice. And who will appoint the secretarial auditor? Here, he will be simply appointed by conducting a board meeting, and in that board meeting, resolution will get passed. And in that by that board resolution, secretarial auditor will get appointed. Now, secretarial audit report. How the secretarial audit report should be? The secretarial audit report should be submitted in form number MR3, and the board of directors in the board report in which they give, if the secretarial auditor has given any negative comments regarding any of the matters, regarding that explanation should be provided by the board of directors, where they will give that explanation in the board's report which they give. Next, in addition to that, even SEBI related regulations, as we have told, every listed company shall submit one secretarial compliance report within 60 days from the end of financial year to the stock exchanges. So this is what the reporting requirements of secretarial audit. So with this, we are done with the key concepts of revision from the company chapter. So now we'll be starting audit reporting related. So the chapter which we are going to take up now, audit report, or even we can say audit. So now what we basically try to understand or revise in this chapter is, so like the way we are saying from the beginning of our discussion, the ultimate objective of the auditor is to express an opinion. And when I say auditor shall express an opinion, it is not like the auditor will come before the public, take the mic and say that I'm giving positive. Opinion should always be in a written format. The opinion should not be just in a oral format. The opinion should always be in a written form. So auditor will express his opinion, which is his ultimate objective, but not orally he will try to express the opinion. The auditor will try to express the opinion in a written document, and that written document which contains auditor's opinion, that that we call it as audit report. What is basically audit report? The written document which is prepared by the auditor containing the opinion of the auditor, that we call it as what? Audit report. And when I say auditor has to prepare the report, can he prepare it as per his own wishes? Can he prepare it as per his own set of rules and regulations? Not actually. The auditor shall prepare audit report, but not according to his intentions and not according to his choice. He cannot use whatever language he want. He cannot use whatever terminology he want. He need to prepare that audit report as per the standards on audit. So what are the guiding principles for the preparation of audit report? The auditor shall prepare audit report after taking into account the requirements of what? Standards on audit. Sir, which particular series of standard talks about preparation of audit report? SA 700 series of standards actually talk about audit report. And in this 700 series also, there are specifically four standards which are going to talk about audit reporting: SA 700, SA 701, SA 705, and SA 706. So these four are the standards from the SA 700 series, which will give a dedicated guidance to the auditor how exactly the audit report should be, what should be the contents in your audit report, what should be the format of your audit report, what language you have to use, what terminology you have to use. All that guidance has been provided under this 700. That's what we are actually going to revise in this particular chapter. So let us go into the topic now. Let us start revising the key concepts of this particular chapter, audit. First of all, what should be the essential characteristics of a good audit report? When we say a audit report is a good audit report, definitely it should have some characteristics. So what should be the characteristics of audit report in order to call it as a good audit report? So let us try to have that characteristics of a good audit report. So if you have a look at it here, so the following should be the characteristics, essential characteristics of a good audit report. If your audit report contain the below mentioned characteristics, then we call it as a good audit report. So what are that characteristics? Should be simple, should be as simple as possible. You should not make it over complex. If any user is reading that audit report, he should be able to understand what you are trying to convey through that audit report. Don't unnecessarily complicate the things. And also, that audit report should provide a clarity that should not create confusion. Like if you see here, they are saying the audit report should be clear and unambiguous. Unambiguous means without any confusion. Audit report should not create confusion. It should provide the clarity for the reader. And to the extent possible, it should be brief. Brevity means brief. You should not you include all the useless information. So all that unnecessary information should be taken out. Only relevant information should be included. So it should be brief enough. At the same time, it should be firmness. There should be a firmness in your audit report. So now what do you mean by this firmness in the audit report? Nothing but you should be conveying your opinion properly. Like for example, if I find something as wrong, you should say that financial statements are not giving true and fair. If you find everything is correct, you should say financial statements are giving true and fair. You should not be a confused soldier. You should not say the financial statements are giving true and fair view also, and in some cases not giving true and fair view also. You should not be so confused. You should be strong. You should be firmly stating your opinion clearly. And also, there should be objectivity. Objectivity means we already know unbiased manner. Whatever opinion you are giving, that opinion you should give it in an unbiased manner. You should not show any kind of partiality towards any of your client. It should be fair enough. Disclosure, whatever important information that you have to present, all that information should be properly disclosed in the audit report. Impartiality, more or less same like objectivity, only objectivity, impartiality both convey the same meaning. Along with that, information based, nothing but this is what I told it as brevity, more or less the same point. You should include only that information which is relevant. You should not unnecessarily include unnecessary. And timeliness, you have to give the audit report on time. You should not say that today the audit is getting completed, after 2 years I will give the audit report. After 2 years if you give the audit report, it will be of whose use? So you prepare audit report considering all the above characteristics, but don't take your own sweet time. You have to prepare the audit report in a timely manner. Then only the relevant, then only the information will make sense to the reader. So if your audit report contains all these characteristics, then we call that as a good audit report. Now let us try to understand what should be the contents of the audit report. What information should be included? What exact contents should be in my audit report? So as per the standards on audit, these are the list of contents which should be there. Number one, title. It always have an appropriate title. And what should be the title generally? The title of the audit report should be Independent Auditors Report. Then you should have addressee. So addressee means to whom you are expressing the opinion. Generally, to whom we will express the opinion? To the shareholder. If it is a company, the addressee will be generally to the shareholders of the. Then you should include the opinion paragraph. Now we need to understand. Now we need to have quick revision of different kinds of. So as we know, auditor's ultimate objective is to express an opinion. And in the layman terms, we have understood that opinion will be of two categories. One will be either a positive opinion or it could be negative opinion. Now we should stop to use this simple layman terminology for negative. Why? Because now we are all matured enough. Now we are all familiar with the audit basic concepts. So I am going to introduce you now some technical terminology for this opinion. Going forward, we should use that terminology only. So what is going to be that terminology? So opinions are broadly divided into two categories. Number one is unmodified opinion, and the other one is modified opinion. So nothing but in our common parlance, whatever we are saying till now, we are saying positive. That basically, technically, it will be called as unmodified opinion. Whereas till now we are saying negative opinion. That negative opinion, technically, we call it as modified opinion. So any opinion you take, that will be either positive or negative. Audit also contains the same kinds of opinion, but we have given some technical names to it. How do we call it? Unmodified or modified. Now let us try to understand when unmodified opinion will be given. As we already know, two objectives. If the auditor is satisfied that financial statements are free from material misstatements. That means if auditor is satisfied that financial statements do not contain any material mistake. And also if the auditor is satisfied that financial statements are prepared as per applicable financial reporting framework. So if the auditor is satisfied with both these things while doing the audit, then he will express unmodified opinion. When I say auditor will express unmodified opinion, what kind of terminology he should use in the opinion paragraph? He should use the terminology financial statement A and fair view. This is what the terminology should be used in the opinion paragraph. That means in the opinion paragraph, if you are able to see the phrase that auditor is using the phrase financial statements give true and fair view, that means you should come to a conclusion that which is what kind of opinion? Unmodified opinion. You have to be very clear about this. No auditor will say unmodified opinion in the opinion paragraph. But how we will identify it as an unmodified opinion? By looking at the terminology. So if the auditor says that financial statements are giving true and fair view, in which paragraph? Opinion paragraph. Then it is what opinion? Unmodified opinion. So this is what the terminology we used. Now coming to modified opinion. So when modified will be given? As usual, if you take it implied from the other case. So if the auditor is not satisfied with the true and fair view, he found some misstatements or he found some deviations from the applicable financial reporting framework, then he will give what? Modified opinion. That means when the auditor doesn't want to say that financial statements are giving true and fair view, auditor don't want to say it. Why? Because he had some observations. Then what auditor will do? Modified opinion he will. Now this modified opinion is also further divided into three categories. Number one, qualified opinion. Number two, adverse opinion. And number three, disclaimer of opinion. The auditor can modify his opinion, and that modification also can be done in three ways. What are the three ways in which modified opinion will be given? Either it can be in the form of qualified opinion, or it can be in the form of adverse opinion, or it can be in the form of disclaimer of opinion. So now we need to understand when qualified opinion, when adverse opinion, and also when disclaimer of opinion will be given. So, talking about qualified opinion, there will be two circumstances in which a qualified opinion will be given. Whereas adverse opinion will be given in one circle, whereas disclaimer of opinion will be given only in one circle. So, let us try to understand what are that circumstances where you will give qualified opinion, where you will give adverse opinion, where you will give disclaimer of opinion. So this you will try to understand it with the help of one example. So assume that we are doing some audit of the finance. That company, the extract of the finance is fixed assets 100 crores. Under current assets, we have different items like inventory we have, trade receivables we have, cash and cash equivalents we have. So some 50, 30 and 20. So this is the total of the balance sheet, 200 crore balance sheet. Now I am doing audit of this particular company. So I verified fixed assets, everything is okay. I verified trade receivables, everything is okay. I verified cash and cash equivalents, here also everything is okay. But the only problem is with inventory. In the inventory also, what has happened is I have obtained audit evidence. I have got some audit evidence, and on the basis of that evidence, I have concluded that this inventory contains some 5 crores amount of mistake. There is some error happened in the inventory. That too for how much amount? 5 crore. And for this, even I am having what? Evidence also. So I have a evidence. Apart from all other items are fine. There is only a mistake in the inventory. That too for how much amount? 5 crore rupees. This is what your observation. Now I will give you two options to express your opinion in the opinion paragraph. Option number one, you can directly say financial statements are not giving true and fair view. This is what one thing which we can do. Or the other thing which we can do is option 2. You can say except certain items, except certain items like inventory in the given case, except certain items, financial statements give true and fair. So if I give you two options to choose from, which option will you choose from? So if I am a prudent auditor, I will go for option 2. Why? Because I can't say financial statements are giving true and fair view. At the same time, I can't say completely financial statements are wrong also. So financial statements are not completely giving true and fair view. At the same time, it is wrong to say financial statements are completely wrong. But except one item, what is that? Inventory. Except that inventory, rest of the items of the financial giving true and fair view. This is what I can. So when you find this terminology in the opinion paragraph, which terminology? Except or subject to certain items, financial statements give true and fair view. Whenever you find this terminology in the auditor's report, that we call it as qualified opinion. So if we list out the circumstances when qualified opinion will be given, so one circumstance is going to be, let me summarize all. Number one, the auditor has obtained sufficient and appropriate audit evidence. Evidence is available. And on the basis of that evidence, auditor has concluded that financial statements are containing a misstatement. Auditor is having evidence, and on that basis, he has concluded that financial statements are containing a misstatement. And the effect of that misstatement is material, is big enough. It is not so small, it is material, but it is not pervasive. So now what do you mean by pervasive? In simple terms, there is a misstatement in the financial statements that is material, that is significant, but it is not so big enough to say entire financial statements are wrong. So if the misstatement is so big enough to say complete financial statements are wrong, then we call it as pervasive. But here what I am saying, financial statements are containing a misstatement. It is significant, but it is not pervasive, which means which is not so big enough to say entire financial statements are wrong. So this is one circumstance where we will give qualified opinion. Similarly, there could be one more circumstance also. Auditor is unable to obtain sufficient and appropriate audit evidence. So if we use the same example, let me try to put it some other way. So here what I am doing is, now other scenario I am talking about here. I am conducting audit of this company. Now while conducting the audit of this company, so what happened is I obtained audit evidence regarding all the items of financial statements. But when it comes to inventory, regarding one item, regarding one of the items of inventory, I am unable to check. Might be, for example, in that raw material, that inventory worth of 50 crores, there is some raw material A, which is of some 5 crore rupees of value. I'm unable to go and obtain that evidence regarding that 5 crores. Why? Because the warehouse where all this stock is kept is sealed by the GST department. So I was unable to go inside and check whether this 5 crores of stock is existing or not. That means I don't have audit evidence regarding this 5 crores worth of stock. But rest of all the items, I'm having evidence, and even I have concluded that financial statements are giving true and fair. So in this case, what has happened is I am unable to obtain audit evidence, and the item regarding which I am unable to obtain audit evidence, if that goes wrong, that 5 crores worth of inventory of raw material A, I'm not able to verify. Assume if that 5 crores goes wrong, the possible effect of that misstatement. I'm using possible effect. Why I'm using the term possible effect? Why? Because I'm saying and I'm unable to obtain audit evidence. If you are unable to obtain audit evidence, you don't know the actual impact. So that's why what I use the phrase there, the possible effect of the mistake and is going to be material. 5 crores goes wrong, it is material. But is it so big enough to say entire financial statements are wrong? Not exactly. So the effect is here also material, but not pervasive. So qualified opinion will be given in either you have a evidence or you don't have a evidence. But the effect of the misstatement should be material only. It should not be it should not be so big enough to say entire financial are wrong. Now, how to identify it is a qualified opinion? By looking at the terminology. In case of qualified opinion, the terminology is except or subject to certain items in the financial statements. Financial statements give true and fair view. Find this terminology, then it will be a qualified opinion. Now let us try to understand when adverse opinion will be given. So talking about adverse opinion. Adverse means saying completely wrong. We are saying that something is completely wrong. Adverse opinion will be given in only one case when we have evidence available, have sufficient and appropriate evidence available. And on the basis of that evidence, we concluded that financial statements are containing a material mistake. Financial statements are containing a misstatement, and the effect of the misstatement is material. It is not just material, it is pervasive also. So big enough to say entire financial are wrong. At qualified, we have given one case evidence we concluded financial statements contain a misstatement whose effect is only material but not pervasive. But here it is what? The effect of the misstatement is material and it is so big enough to say entire financial are wrong. So now what opinion we will give? Adverse. And what terminology? How to identify adverse opinion? By looking at the terminology. What terminology will be used? Your auditor will use the terminology financial do not give true and fair view. This is what the terminology which will be used by the auditor whenever he gives adverse opinion. Now, when disclaimer of opinion will be given? One case when evidence is not available. Auditor is unable to obtain audit evidence, and the possible effect, the items regarding which I am unable to obtain audit evidence, if all that items goes wrong, the possible effect of the misstatement is the material and it is not just what also. Then which opinion will be given? Disclaimer of opinion. How to identify disclaimer, sir? Auditor will use the terminology. We are unable to express an are unable to express an opinion on finance. But you find this terminology, then it indicates that it is a of opinion. Now all the three are nothing but different kinds of modified opinion. All the three are negative opinions only, but severity of the negativity is changing here. Qualified is negative opinion, but less severe. Adverse and disclaimer are more severe negative opinion. So whatever it is, the auditor will try to express his opinion in the opinion paragraph. So first thing, after including title, after including addressee, the next content will be opinion paragraph in which auditor will actually express his opinion. Along with that opinion, four other compulsory things must be included in the opinion paragraph. So the things which should come in the opinion paragraph are name of the client you should, and you have to state the fact that financial. Along with that, you need to check the titles of clients and also give reference to significant accounting this and also date and the period covered by the financial. These five items must be stated in which paragraph? Opinion paragraph. Now, after that, the next paragraph is going to be basis for opinion paragraph. In that basis for opinion paragraph also, you should explain on what basis you have given the opinion. So you need to mention four things in the basis for opinion paragraph. You should say that you have done the audit, and you have to give reference to the auditor's responsibilities paragraph. You have to include a fact that auditor is independent and is complying with ethical requirements, and also you should state that whatever audit evidences that you have obtained, they are sufficient and appropriate. These things must be in basis for opinion paragraph. Then coming to one more paragraph, one special paragraph will be included in the audit report on going concern assumption. On that, such paragraph will be included as per SA 57. Key audit matter. From the audit, if you find any important matters during the course of audit, so all that important matters are also required to be included in the heading key audit matter. Then we have emphasis of matter and other matter paragraph. So basically, emphasis of matter paragraph will be to highlight that information is already presented or disclosed in the financial statements. Management has already presented and disclosed some information in the financials, but you want it to highlight to the user. So if you want to highlight it, you can use emphasis of matter. Similarly, if some information is there which is not presented or disclosed in the financial statements, that you can highlight it in which paragraph? Other matter paragraph. The standards are very bulky, since it's a very big standard, but we need not go into the details of the standard. Why? Because that is not that important from the examination. So only two things you keep in your mind. Emphasis of matter paragraph will be used to highlight that information which is already presented or disclosed. Whereas other matter paragraph will be used to highlight that information which is not presented or disclosed. Then you should include a paragraph with the heading responsibilities of management paragraph, in which you should list down all the responsibilities of management. Then you have to include one more paragraph with the heading auditor's responsibility, in which you have to mention all the auditor's responsibilities. Apart from that, other than standards, if any law or regulation is putting some extra reporting requirements on the auditor, like Companies Act will have some reporting requirements which auditor has to fulfill. Banking Regulation Act will give some reporting requirements to the auditor which has to fulfill. So apart from standards on audit, if any other law or regulation is putting some reporting requirement, that we need to highlight, that we need to report it using a separate paragraph with the heading report on other and regulatory. Basically, we use this paragraph to fulfill those reporting requirements other than standards. Then finally, auditor has the document, sign the audit report. He needs to mention the place of signature, generally the city where the audit report is signed. Along with that, the date on which you are signing the audit report, that date should be mentioned. Along with that, there is one unique number which auditor has. We call it as UDIN. That unique number also be mentioned in the audit report. So this is what the standards are giving the guidance. So all these contents should be there in the audit. This is what the these are what the key concepts from say 700 series, how to prepare the audit report. And now one more important concept we have to discuss regarding this audit RO. So these are special reporting requirements. There are some 21 matters that are included in the Companies Act through a separate order called CARO 20, which is required to be reported by the audit. Let us try to understand what are that 21 matters which are required to be reported in the audit report under this order called CARO 2020. So I have told you this paragraph, no, report on other legal and regulatory requirements. In this paragraph, this CARO 2020 report. So let us try to understand, let us try to revise thoroughly what are that 21 matters which auditor is required to report as per the requirements of CARO 2020. So let us go to that respective section. Let me take you to CARO report. Here we have, there are total how many matters which are required to be reported? There are a total of 21 matters which are reported. First, let us try to understand applicability. Is the CARO reporting applicable for all the companies? Basically, yes, but subject to exceptions. Some companies are exempted. Some companies auditors are exempted from reporting on CARO. So what are they? Let us see. So CARO 2020 going to be a not 2016 actually for your exams, not 2016. CARO 2020 only become applicable. So the company's auditors report order CARO 2020 is an additional reporting requirement which applies to every company, including a foreign company. However, it shall not apply to following class of companies. Some companies are exempted from CARO. Which companies? Let us try. A banking company. If you are conducting audit of any banking company, CARO is exempted. If you are conducting audit of insurance company, then also Caro is exempt. And a company licensed to operate under Section 8, nothing but non-profit making companies. For them also Caro is exempt. Or a one-person company and also a small company. And not just that, if a private limited company, if it satisfies any of the four conditions, not any of the four conditions, if they satisfy all the four conditions, end has been given. So if a private limited company, if they satisfy all the four conditions which have been listed here, then also Caro will be exempted for them. All four conditions they have to satisfy. By whom? Private limited company. If they fail to satisfy any of these four conditions, then Caro becomes applicable. If they satisfy all the four conditions, then only Caro will be exempted. Sir, what are that four conditions? Number one, it should not be a subsidiary or holding of a public company. So if you are a private limited company, you should not have a holding company which is the public company, not have a subsidiary, a public company. And not just that, second condition, the total paid up capital along with reserves and surpluses shall not exceed 1 crore. That means it should be less than or equal to 1 crore as on balance sheet. Number three, and the total borrowings from banks and financial institutions shall not exceed 1 crore. The borrowings from banks along with the financial institutions should be less than or equal to 1 crore at any point of time, not just as on balance sheet date. During the entire financial year, even for one day also, if the borrowings have exceeded 1 crore, Caro becomes applicable. So at any point of time during the financial year, the borrowings from the banks and financial institutions shall not exceed 1 crore. Then the total turnover of the company calculated as per Schedule 3, including revenue from discontinued operation, shall not exceed 10 crore rupees. So turnover should be less than or equal to 10 crores. A private limited company, all these conditions, then Caro will be exempted. If they violate even. So now let us try to understand about what are the things which are required to report. 21 matters are required to be reported. Let us thoroughly go through. First point is regarding non-current, like all the fixed assets, intangible assets. Regarding them, auditor is required to report some. What are they? Number one, I need to check whether the company is proper records. Has to maintain proper records. The company's management has to maintain records, which should show quantitative details, nothing but number of fixed assets, and also situation where the assets are. Number two, physical verification. I need to comment whether the management is doing physical verification of property, plant and equipment, especially all this fixed all at reasonable intervals, once in every 3 years, whether management or not. And on such physical verification, whether any differences. Why we do basically physical verification? Whether the quantity of assets which are there in the books of accounts, the quantity of the assets which are lying there physically, both are matching or not. If there is any discrepancy, check whether the management has properly dealt with that in the books of accounts. Next one, third point. That specifically talking about immovable properties, we need to check whether the title of immovable property, nothing but land and buildings, I check whether the ownership is resting with the company or not. How to check it? By checking the ownership document. If not, if you find any immovable properties not in the name, you need to report some matters like description of what is its gross carrying value, held in whose name, reason why it has not yet been transferred in the name of the. Next, revaluation. We need to check whether the management has revalued their property, plant and equipment during the year. If yes, whether that revaluation has been done on the basis of listed valuer's certificate, and also before and after revaluation, if the change is 10% or more in the aggregate of each class of property, plant and equipment because of revaluation, if the change before revaluation and after revaluation, if the difference is 10% or more, then that amount is required to be reported. This is what the fourth point. Last point, I need to report whether any proceedings have been initiated or are pending against the company for holding what? Binami properties. The Binami Transaction Prohibition Act. Whether against your client company, any cases have been filed or initiated. For what purpose? For holding the Binami properties under Binami Transactions Prohibition Act. If yes, whether the company the detail that case in their financials or not. So five points auditor is required to report regarding non-current assets. Number one, whether the management is maintaining proper records. Number two, whether physical verification has been done, whether title of immovable properties are held in the name, whether any revaluation has happened during the year. Along with that, whether the company is facing any or holding Binami property. Second reporting requirement is regarding inventory. Here, what they say is first point, check whether physical verification of inventory has been conducted. By whom? Once again, the management. If yes, whether the coverage and procedure of such verification is appropriate. Whatever physical verification, whether they have done it in appropriate manner or not, I need. And on such physical verification, whether any discrepancy of 10% or more has been identified. Are you able to find discrepancy of more? Then you need to report the amount of that discrepancies between the stock which is lying there in books and stock which is lying there physically. The difference is 10% or more, then you have to report. Second point, working capital loan. So in the second point, they say that whether your client has taken any working capital loan. That too, when I say working capital loan, whether they have taken any overdraft facility or cash credit, that too of an amount exceeding how much? 5 crore rupees. If your client has taken a working capital loan like OD or cash credit, then what generally will happen is your client will submit quarterly stock statements to the banker. Now, as an auditor, what is my responsibility is whatever quarterly stock statements which my client is submitting to whom? To the banker. Whether that quarterly returns or statements are in agreement with the books of accounts. That means quarterly stock statements submitted by the company and the information which is there in the books of accounts, both are matching or not. Simply, if I have to put it, whether your client is submitting genuine stock statements to the banker or they are submitting the fake stock statements to the banker, that I need. Coming to the third reporting requirement is regarding loans, investments, guarantees, which are given by the company. In this point, what they say is check whether your client has given loans to any of the related parties. If yes, what I need to do? They simply ask you to segregate two things. What is the aggregate amount of loan given and what is the balance outstanding? And how to segregate, sir? We have to segregate on the basis of two categories. How much aggregate amount of loan has been given for subsidiary, associate, and joint venture? How much loan has been given for other than subsidiary, associate, and joint venture? So assume that your client has given of 100 crore of loan to the related parties. Now I need to find out of this 100 crores, how much has been given to subsidiary, associate, joint venture, and how much has been for other than subsidiary, associate, joint. For example, say I came to know that my client gave 60 crores worth of loan to subsidiary associate. Just for other than subsidiary associate joint venture, 40 crores they have given. Aggregate and not just aggregate amount given during the year, what is the balance outstanding as balance sheet date for subsidiary associate joint venture separately other than subsidiary associate. This is what the summary of that entire point. Second one, on whatever terms and conditions loans are given, are they prejudicial? That means are they harmful to the interest of the company? As a loan without mentioning, has the loan been given without accepting any security? Has the loan been given at a low interest rate or interest free loan has been given? To find out whether the terms and conditions on which such loans are given are they prejudicial to the company's interest. Next, third point, the company should not just like that give the loan and leave out. Even as an auditor, I need to check whether my client is collecting all the principal and interest on or before the due dates or not. I need to report. And if at all, if any amount remains overdue for more than 90 days, I need to check whether management has taken reasonable steps for when the amount remains for more than 90 days. And E point, they say that whether your client has given loan in the past, which have fallen due in the current year. Your client has given loan to somebody else in the past that has fallen due in the current year. But instead of collecting the money, what your client is doing is either renewing, extending, or fresh loan they are giving. Once again to the same party. Should have collected the payment. But instead of collecting the payment, what your client is doing, they are extending the due date. Or they are giving a fresh loan to the same person. Then what should happen? You need to report two things. What is the aggregate amount of such loans which are renewed, extended, or settled by fresh loan? Like for example, 100 crores of loan. The current year they have fallen due, but 40 crores only they have collected. 60 crores they have extended the due date. You need to report this amount. 60 crores have been extended. They did not collect it. They have just like that extended it. And not just that, you need to calculate percentage with the total loans also. Assume total loans given are somewhere around 100. Out of that, loans which are extended are 60 crore rupees. So what percentage of loans are in the form of extension renewal? 60%. This percentage also specified. Here, very simple point. Your client has given loan in the past. They are supposed to recover it, but they did not recover it. Instead of that, what they have done, they have extended the due date or rescheduling they have done. If yes, two things you need to report. What is the total amount of such loans given? And even you need to calculate percentage with the total loans and advance. Along with that, one more point, demand loans or without any repayment period. Has your client given any loan without mentioning any repayment period? This is what we generally call it as demand loans. Client is giving loan but not mentioning any repayment period. If yes, what we need to report? We need to report what is the aggregate amount of such demand loans given. Here also calculate the percentage with the total loans and advances, and along with that report how much amount has been granted to promoters. These 6 points are required to be reported regarding loans in which are given by your client company to others. So coming to the fourth point, which is required to be reported. So if we have a look here, fourth point is also regarding loans, investments and guarantees, once again made by the company. When I say made by the company, given by the company to the others. So third point is also talking about loans and advances given by the company to others, whereas fourth point is also talking about loans and advances given by the company to others. So talking about fourth point. So in respect of loans, investments, guarantees and securities which are provided by the company, check whether the provisions of section 185 and 186 are complied with or not. Very simple point. In case if your client company is giving loan to somebody else, so they cannot give the loans as per their own choices. They have to give the loans after complying with the provisions of 185 and 186 of the Companies Act. Whether they complied with or not, checking that is auditor's responsibility. Fifth point is regarding acceptance of deposits. This point will become applicable only when your client has accepted deposits from the public. In case if your client has accepted deposits from the public, we need to check whether your client company has complied with three things. What are they? Whether the provisions of section 73 to 76 of the Companies Act have been complied with or not. 73 to 76 contains rules and regulations to be followed by the company in case if they are accepting deposit. So whether that rules and regulations are complied with or not. And when it comes to acceptance of deposits, sometime RBI also will come and give some directives or instructions whether that directions given by the RBI are complied with or not. I need to check it. Along with that, if there is any order passed by company law board or any court or any tribunal regarding acceptance of deposits, whether that three requirements are fulfilled or not, checking that is auditor's responsibility. Very simple point. In case if your client has accepted deposits, three things: provisions of the Companies Act, directives given by RBI, and order given by CLB, court or tribunal has been complied with or not. If you find any non-compliance, report what kind of non-compliances have been made. Now coming to the sixth point, just regarding the cost audit related point which we have covered previously, you need to report on two things: whether your client is coming under that section 148. We have seen which companies are required to maintain cost records. Two conditions: it should be either engaged in the manufacturing activity or services, and overall turnover from all the products and services should be 35 crores or more in the immediately preceding financial year. So as an auditor, I need to check whether my client is coming under that criteria. If yes, whether your client has maintained that cost records properly or not, you have to give your comment. This is what the sixth point. Seventh point which you are required to report is regarding statutory dues. So what is basically statutory due? Nothing but whatever amounts which your client is required to pay because of the requirements of law. Your client is required to pay because of some requirement of the law. Like if I give some examples of the statutory due: income tax or GST payment, or even you take PF or ESI. So these are the amounts which your client will be paying, not out of their voluntary contribution, but they do it because of requirements of law. So those dues we call them as statutory dues. And for the purpose of auditors reporting requirements, statutory dues are divided into two categories. One is undisputed statutory dues and the other one is disputed statutory dues. Now what are these undisputed? What is this disputed? Very simple. if any issue is going on between your client and regulatory authority, some proceedings are going on regarding some tax payment or some PF payment or ESI payment between your client and some regulatory authority. Like a case is going on between your client and income tax department. A case has been filed against your company in the Supreme Court. So that we call it as disputed dues. Whereas undisputed, no case, nothing is pending, no conflict is existing. That dues we call them as undisputed dues. So if there are disputed dues, there are different reporting requirements. If there are undisputed dues, then there are different reporting requirements. So let us try to understand what are that reporting requirements of the auditor. First, talking about undisputed dues. Regarding undisputed dues, auditor is required to report two things: whether your client is regular in depositing all the undisputed statutory dues like PF, ESI, income tax, GST, or any other dues with appropriate authorities. So, what do you mean by regular in depositing? Whether your client has deposited all the undisputed statutory dues with the regulatory authorities on or before the due dates, that we need to check. Since no dispute is existing, your client should have deposited all the money on or before the due date itself. Check it. If not, that means if your client has not deposited some undisputed statutory dues, then the extent of arrears of outstanding statutory dues, nothing but the amount of such outstanding dues for a period of more than 6 months from the date they become payable, shall be indicated or reported by the auditor, which means that assume that your client is required to pay some PF amount. Actual due date is somewhere around 31st of January 2022. There is no dispute existing regarding it. The amount they are required to pay is 10 lakh rupees. This amount is still remaining unpaid as on 31st of March 2022 also. Is this amount required to be reported? The answer is no. Why? Because even though this amount is outstanding, it is outstanding for less than 6 months as on balance sheet date, so no need to report. If I say that the company is required to pay some income tax, the due date is 31st of July 2021, no dispute is existing, but the company did not pay it as on 31st of March 2022 also, amount involved is 20 lakh rupees. Now, is this amount required to be reported? Yes, this amount is required to be reported. Why? Because it is outstanding for more than 6 months as on the balance sheet date. Very simple point: whether your client is depositing all the undisputed statutory dues with the regulatory authorities on or before due dates. If not, what is the amount of outstanding? What is the amount outstanding for a period of more than 6 months as on the balance sheet date? From the date it has become payable, that amount is required to be reported. If at all the dues are not paid because some issue is going on between the client and regulatory authorities, then your reporting requirements will be two, which are going to be: you need to report what is the amount involved in the dispute, and also you need to report forum where the case is pending. So regarding disputed dues, two things: what is the amount involved in dispute, and what is the forum between which authority the case is pending. Is it pending before Supreme Court? Is it pending before a tribunal? Is it pending before commissioner? That forum is also required to be reported. So this is what the reporting requirements regarding statutory dues. Now coming to the next point, undisclosed income. So what is this undisclosed income? Here they ask you to check whether during the year any tax assessment has happened, like whether any income tax rate or scrutiny, these kind of assessment has happened. And as a part of that assessment, has your client surrendered or disclosed some income during the year? Some income tax raid has happened and your client did not disclose some income in the past, and as a part of that income tax raid he disclosed some income. Now assume that some 1 crore rupees of income which was hidden in the previous, it was surrendered or disclosed in the current year as a part of income tax assessment like raid. If so, whether that unrecorded income has been properly recorded in the books of accounts also or not. So if you would not have disclosed to the income tax authorities, you would not have recorded in the books of accounts also. Now, if you are surrendering that income to the income tax department, just surrendering to the income tax department alone will not be enough. That income, since you would not have recorded in the books in the prior years, auditor should check whether the same has been included in the books now. So this is what regarding eighth point. Now coming to the ninth point, repayment of loans. Till now we have seen so many points regarding loans which are given by the company. This ninth point is going to talk about loans which are accepted by the company. So regarding the loans which are accepted by the company, what are the reporting requirements? Number one, whether there is any default in the repayment, whether your client has made any default in the repayment of the dues. Your client has taken loan from others, but they are not paying it. When I say default, default includes two things, either not paying, or even if you pay the money after due date, that also will come under default only. If yes, we need to report what is the period of default and what is the amount of default. For each lender wise we need to report. So for each lender, how much amount you have made a default, for what number of days you have made a default, that you need to report it. Willful defaulter, whether your client has been declared as a willful defaulter by any bank or financial institution. When I say willful defaulter, it is like one bad credit remark given to some borrowers if they fail to fulfill some conditions. You need to check whether your client company has been classified as willful defaulter by any bank or financial institution. Then, third point, you need to check whether your client has taken any long term loans. And after taking long term loans, instead of using it for set purposes, have they used the funds for other purposes? Generally, when a company goes to the banker and asks a long term loan, the banker will ask you purpose. Now, as an auditor, I need to check whether my client has got any long term loan. If yes, whatever amount they have received, whether they are using it only for the set purposes with the banker or they are misusing it for other purposes, that we need to check and report. Next one. Fourth point is regarding short term loans. Whether your client has taken any short term loan like working capital loan, cash credit loan. But instead of using it for short term purposes, is your client using it for long term purposes? If yes, report it here. Next point, your client is taking loan, but not for meeting your client's requirements, but for meeting the obligations of subsidiaries, associates, or joint ventures. Your client company has taken loan, but not for your client's company's requirements. They are taking the loan and using that money for subsidiary, associate, joint ventures requirements. So if you find any such transactions, report it. And not just that, one more point, loans against pledge of securities of subsidiaries. Now this point is your client has taken loan for your client's requirements only. But for loan, you have to give some security, no? So what has been pledged with the banker or the financial institution is the shares you are holding in subsidiary, associate, joint venture. See, the difference here is in the fifth point, they're asking you to report whether your client has taken loan, but not for your client's obligations, your client's subsidiary, associate, and joint ventures obligations, whether your client has taken loan. F point, they say your client has taken loan for your client's requirements only. But the thing which they have given as security is the shares, debentures which they are holding in the subsidiary, associate, joint venture. So these are the six matters which are required to be reported regarding loans which are accepted by your client company. Very important, huge chances of testing in the examination. So 6 points are required to be reported: whether your client has made any default in the repayment of loans, whether your client has been declared as a willful defaulter, if your client has taken long-term loan, whether they are using it only for set purposes, if your client has taken short-term loan, whether they are using it only for short-term purposes, not for long-term purposes, your client has taken loan not for meeting your client's requirements, but for meeting the obligations of subsidiary, associate, joint venture. Similarly, whether your client has taken loan, but the thing which they have offered as security is shares which they are holding in subsidiary, associate, and joint venture. Next, 10th point, utilization of IPO or FPO. Very simple, whether your client has made any IPO or FPO of the shares, whether your client has made any IPO allotment or FPO allotment. From that, they will raise the money, no? So whatever money they have raised from IPO or FPO, they have utilized it only for the set purposes. Generally, in the prospectus, they will mention the purpose, whatever money the company has raised by way of IPO or FPO, whether they have been utilized only for the set purposes. If not, that means if the company is misusing it for other purposes, I need to report some details like what defaults they have done, what delays they have done, and what subsequent rectifications they have done. That needs to be reported. In addition to that, check whether your client has made any preferential allotment. Now, preferential allotment or private placement, more or less both are same. So what actually happens in the preferential allotment is here also shares will be issued, but not for the common public, only for a specific group of people shares will be issued. That we call it as preferential allotment. So check whether your client has made any preferential allotment or private placement of shares. If yes, we need to check whether the provisions of section 42 of the Companies Act is complied with, and also whatever amount that has been raised by preferential allotment, whether it is used only for the set purposes or not. If not, that means if the amount is getting misused, here also you need to report some details. What is the amount involved and what is the nature of non-compliances that has been done. These information is required to be reported. Now talking about the next one, reporting of frauds. So here you need to report whether any fraud by the company or any fraud on the company, whether has it been noticed or reported. If yes, auditor should report nature of the fraud and amount involved in the fraud in the CARO reporting requirements. In addition to that, whether any of the auditors submitted Form ADT4 during the year, like as we have seen fraud reporting under 143 subsection 12, if the amount involved in the fraud is 1 crore or more, that information is required to be reported to central government by submitting one form called ADT4. So you need to comment whether any of the auditors submitted form ADT4, that we need to comment. Along with that, during the financial year, whether there are any whistleblower complaints. Whistleblower complaints means some internal people in the organization only. If they find something going wrong in the organization, they will intimate to regulatory authorities. So check whether any such whistleblower complaints, internal people only will report about deficiencies in the organization to the regulatory authorities. Check whether any such whistleblower complaints have been received during the year. So three things are required to be reported under clause 11: whether any fraud has been noticed or reported, if yes, nature and amount involved, whether any of the auditors submitted form ADT4, and whether the company has received any whistleblower complaints. Next, talking about next reporting requirements, this reporting requirement will become applicable only for a Nidhi company. So for Nidhi company, three things we need to check. Nidhi company means basically a chit fund company. So in case if you are conducting audit of Nidhi company, on 3 points you need to comment. Number one, they should have net owned funds to deposits in the ratio of 1:20, which means for every 1 rupee of net owned funds, Nidhi company can accept only maximum of 20 rupees of deposits. So if the Nidhi company is having 1 lakh rupees of own capital, they can accept only maximum 20 lakh rupees of deposits from the public. So we need to check if my client is a Nidhi company, they comply with this net owned funds to deposits ratio of 1:20 or not. And also, Nidhi company should maintain out of their total deposits, 10% should be kept in unencumbered term deposits. Term deposits means fixed deposit. Unencumbered means without any charge. So if the Nidhi company has collected total 200 lakhs of deposits, in that 10%, which means 20 lakh rupees, should be kept in a fixed deposit, and this fixed deposit should not be given as security for any loan. Whether this condition has been complied with or not, I need to check and report. Similarly, the last point, whether the Nidhi company has made any default in either payment of interest or repayment of principal to any of its deposit holders. So these are the 3 points which are required to be reported regarding Nidhi company. What if your client is not a Nidhi company? I will mention the same thing. My client is not a Nidhi company, hence reporting requirements under this clause will not be applicable. Next, along with that, point number 13, which is regarding related party transactions. Regarding related party transactions, 2 points I am required to report: whether the provisions of section 177 and 188 are complied with or not. 177, 188 actually contains rules and regulations regarding related party transactions. I need to check whether that two sections are complied with or not. And also, details have been disclosed in the financial statements as required by applicable accounting standards. So whatever disclosure requirements that are required to be given by related parties, whether they have been given as per the accounting standards or not, I need to check. Next one, internal audit system. I need to check whether my client is having enough of internal audit system, which is commensurate, which is matching with the size and nature of the business. And also, if the internal auditor has given any report as an external auditor, have you considered the report of internal auditor? That also needs to be reported here. Coming to the next point, non-cash transaction, whether your client company has entered into any non-cash transaction, simply barter transactions. With whom? With the directors or any other related parties. Then there is a dedicated section which is giving some rules and regulations in this matter, which is section 192 of the Companies Act. So I need to check if my client is entering into non-cash transactions with the directors or related parties, whether the provisions of 192 are complied with or not. Then next point, NBFCs. If your client is a NBFC, then this point will become applicable. So 3 points I am required to report regarding NBFCs. Some NBFCs are required to obtain registration under 45(1)(a) of the Reserve Bank of India Act. I need to check whether my client NBFC is required to get that registration. Number two, I need to check whether my client is conducting any non-banking financial or housing finance activities without having a valid certificate of registration. Number three, core investment company. I need to check whether my client company, client NBFC, is enjoying the status of CIC. CIC is a special status given to some NBFC subject to fulfillment of conditions. So I need to check whether my client company is enjoying that status of CIC. If yes, whether they fulfill the criteria for becoming that CIC. In the CIC also, one more categorization will be there: exempted or unregistered CIC. In case if your client is fulfilling coming under that extra criteria of unregistered CIC, whether they continue to fulfill such extra criteria also or not. Like after becoming NBFC, if your client follows some 10 conditions, they will become CIC. If my client is a normal CIC, I need to check whether these 10 conditions are satisfied or not. Now, after becoming CIC, if they fulfill some extra 5 conditions, they will become exempted CIC. If my client is exempted CIC, then I need to check whether that extra 5 conditions are also satisfied or not. And one more thing, as a part of my client's group, is there only one CIC or more than one CIC? Like my client company is a CIC and one more subsidiary is also a CIC. I need to mention how many number of CICs are there in the part of the group. So these are the 3 points which are required to be reported in case if my client is NBFC. What if my client is not an NBFC? Then you will simply say the same fact: my client is not an NBFC, hence the reporting requirements under this clause will not become applicable. Next, cash losses. You need to check whether your client has incurred any cash losses both in the current financial year and also in the preceding financial year. If yes, what are the amounts of such cash losses are also required to be reported. Then coming to the next point, resignation of auditors. We need to check whether any auditor, whether any statutory auditor has resigned during the year. If yes, you need to take into consideration because of what issues or because of what objections or because of what concerns the previous auditor has resigned and how they are going to affect you. And one more point you need to comment. You need to check on the basis of doing some ratio analysis, on the basis of analyzing the dates of realization of financial assets and financial liabilities, and also using financial statements and other information, you need to express opinion. Is the company having ability to pay all their liabilities which fall due within coming 1 year, or there is any material uncertainty? Nothing but somewhat like commenting on going concern. So what you should do is you should do some ratio analysis. You should understand what is the expected date of realization of debtors, what is the expected date of payment of creditors, and you should sit with the management and discuss their future plans. After considering all this into account, you need to tell your opinion: is the company having financial stability to meet their liabilities which fall due within coming 1 year, or is there any uncertainty existing? That's all. Next one, unspent CSR expenditure. Very simple point. Whether, as we all know, some companies, if they fulfill certain criteria, they need to spend certain amount of money on corporate social responsibility, and that amount which they are required to spend is 2% of average net profits of last 3 years they are required to spend. And regarding that CSR expenditure, you need to check two things. One is if there is any amount other than ongoing projects. Like, we will try to understand it with the help of example. Assume company is required to spend some 100 crore rupees of money on CSR objectives, on social responsibility. Out of that, company is having a project ready for 50 crores. They want to use it for construction of some schools in the in the backward areas. Some 30 crores they want to give it as a donation to old age homes or other charitable institution. So they need to spend 100 crore rupees, but they have projects ready. I'm not telling they have spent 80 crores. Just what I'm saying, they have a project ready. 50 crores they have a project for constructing the schools. Another 30 crores they are having ready. They want to donate it for the orphanages or charitable institutions. But they are having plans for only 80 crores, but amount required to be spent is 100. So for 20 crores, the management is not having any plan. So what should happen to this 20 crore rupees of unplanned money? Let us see what they are saying. Whether in respect of other than ongoing projects, the company has transferred unspent amount. So whatever money is there regarding which company is not having project, that money should be transferred to a fund which is specified where under Schedule 7 to the Companies Act. Within what period? Within a period of 6 months of the expiry of the financial year. That means assume you are required to spend this money as on 31st of March 2022. Now from this date, 6 months is also over. 30th of September has also come. But still you are unable to decide the project for this 20 crore rupees. Now what should happen to this 20 crores? This should go to some fund which is specified under Schedule 7. Like what funds are specified, sir? Like Prime Minister National Relief Fund, PM Cares Fund. So like the some funds are specified, you contribute that amount to the fund, government will take care of it. Why? Because you are unable to decide a project even within 6 months from the end of the financial year also. That is what the first point. Second point, whether any amount remaining unspent under 135 subsection 5 of the Companies Act pursuant to any ongoing project. That means this point they're talking about regarding projects which are ready. First point is talking about you don't have any project that should go to fund. Second point, you have a project ready, but you did not spend it. Like for example, we have projects for 80 crores. 30 crores you want to give donation. Immediately donation has been given. 50 crores you want to construct the school. But school construction will not happen in day or a two. It will take enough of time. So you have project ready, but you have spent only 10 crores. 40 crores you will spend it. On what you will spend it? For school construction only you will spend it. But it is going to take some considerable amount of time. So now what should happen is this amount regarding the project that should be transferred to a special account. When I say special account, nothing but just a bank account. So 40 crores, you have a project ready, you will spend it for social welfare only, but separate these funds from normal funds. Open one separate bank account with the company. Bank will open one CSR account. In that account, you keep that 40 crore rupees. Company only will have control over this 40 crore rupees. They will only spend the money for social responsibilities only. They will spend it. Just they will try to separate the funds from normal funds. Whereas the first point, if you are unable to have project, that money should go to fund altogether. The money goes to the fund, you will no longer have control over it. You will lose the control over it. Government will take care. In the second point, amount will go to only separate bank account, and from that bank account also company only will spend it. That's all. These 2 points I need to check and report. Now last point, this will come only in the audit report of consolidated financial statements. Here we need to check on two things. Now, as we know, in the consolidated financial statements, financial information of holding company, financial information of subsidiary company, associate company, and even joint ventures, all these four entities information will be included. Now, what they say is when you give the audit report of consolidated financial statements, generally CARO is exempted for consolidated financial statement, except one clause, which is clause number 21. That means only this 21 clause will come in the consolidated financial statements. Rest of all the clauses will not come. Now, in this clause also, what you are required to report is very simple thing. You need to go through individual audit reports of the companies which are included in the consolidated financial statements. So go through audit report of holding company, go through audit report of subsidiary company, go through audit report of associate company, and even go through the audit report of joint ventures also. Now you need to find out in any of these audit reports whether any auditor has given negative comment regarding any of the above 20 CARO points. If yes, tell the name of the company which contains that negative comment and also give the paragraph number. Like if I have to give example, assume in the associate company's audit report, the concerned auditor of the associate company has reported some fraud. He has notices some fraud and he has mentioned the nature and amount involved in the fraud. So which paragraph? Paragraph number 11. So now what I should say in my consolidated financial statements audit report is so and so company X Limited, which is the associate company. In that company's audit report, paragraph number 11 contains negative remark. That's what you need to report. That is what the last point is. This will come only in the case of consolidated financial statements. So if I read it, whether there has been any qualification or adverse remark by the respective auditors in the CARO reports of companies which are included in the consolidated financial statements. If yes, the details of the companies and the paragraph numbers of the CARO report containing that adverse or qualifications should be indicated. So these are all the 21 matters which are required to be reported under CARO 2020. So with this audit reporting related revision has been completely done. Now we will proceed further with the next two topics revision. Let us now try to revise the topic. which is going to be audit documentation and audit evidence. So audit documentation and audit evidence. So this particular topic actually contains two concepts. One is regarding audit documentation and the other one is regarding audit evidence. So first we will try to have one quick revision regarding audit evidence. Then we will go and revise the concepts relating to audit documentation. So what basically is this audit evidence? Now we need to recollect the entire process of audit as we have told earlier. The process of audit, what actually happens is first auditor will be appointed, then he will perform audit procedures. By performing audit procedures, he will get something called audit evidence. And on the basis of that audit evidence, auditor will express an opinion. And once the auditor expresses an opinion, then the process of audit will actually come to an end. So this is what basically happens in the entire audit. So as I have told you earlier, the meaning of the term audit evidence is whatever information which supports the auditor's opinion or which forms the basis for auditor's opinion, that we call it as audit evidence. Like any opinion needs some supporting information. If I am expressing the opinion today, if tomorrow someone comes and asks me, boss, you have given unmodified opinion, what is the basis for the opinion? I should be able to prove them with the help of some information. Or if I have given any adverse opinion, if tomorrow someone comes and asks me, boss, you have given adverse opinion, on what basis you have given adverse opinion? I should have some supporting information in my justification. So that information, which is forming the basis for auditor's opinion, that we call it as audit evidence. And we will not just like that get the audit evidence. We need to perform some audit procedures in order to get that audit evidence. So first we need to understand what is this audit procedures. Then we will understand audit evidence. So let us proceed further and try to revise the concept of audit procedures. What basically audit procedures are? In simple terms, whatever procedures which are performed by the auditor to obtain audit evidence, that procedures we collectively call it as audit procedures. So the term audit procedures is a very broad term. It includes everything which you do in the audit in order to obtain that audit evidence, that we call it as audit procedures. Now, these audit procedures are broadly divided into two categories. Number one, risk assessment procedures, and the other one is going to be further audit procedures. And this further audit procedures are further divided into two categories. One is compliance procedures and the other one is substantive audit procedures. Now let us try to understand what do we mean by risk assessment procedures, what do we mean by compliance procedures, and what do we mean by substantive audit procedures. First, we will try to understand what are risk assessment procedures. So risk assessment procedures are those procedures which are performed to obtain an understanding. And to obtain that understanding regarding three things. One is to obtain an understanding about the entity, to obtain understanding about the environment in which your entity is operating, and also to obtain an understanding of the client's internal control system. So whatever procedures which an auditor performs to obtain an understanding of entity for which he is doing the audit, the environment in which your entity is operating, and also the internal controls in your entity, in order to understand that whatever procedures we perform, that we call it as risk assessment procedures. Like if I am doing audit of some company, I will not blindly go to their accounts department and start verifying their books of accounts. First, what I will try to do is I will try to understand my client. What is my client doing? What is my client's business? What products he is selling? What kind of industry he belongs to? What kind of internal controls he is having, that I will understand. So that procedures I call them as what? Risk assessment procedures. So why do we need to understand about entity? Why can't we directly go to the accounts department and start verifying the books of accounts? Because if you obtain an understanding of entity, environment, and its internal control, then you will be able to, the purpose of understanding about this entity, environment, and its internal control is to identify and also to assess risk of material misstatement. So why we are trying to obtain an understanding of entity, environment, and its internal control? Basically, the purpose is to identify, to find out, and after finding out, even to analyze, that is assess. What to identify and assess? To identify and assess the risk of material misstatement. Now, what is this risk of material misstatement? A risk of material misstatement means the chance of happening of misstatement, the possibility of happening of the misstatement that I want to identify. To identify that, first I will try to obtain understanding of entity, environment, and its internal control. That I basically call it as risk assessment procedure. So I will start with doing risk assessment procedures. I will try to understand about entity. I will try to understand about its environment. Find out in which area there is risk of, in which area there is chance of happening of misstatement, in which area there is no chance of happening of misstatement. That I will do first. Now, once I'm done with risk assessment procedures, the next thing which I do is compliance procedures. Now, what exactly are these compliance procedures? Compliance are compliance procedures are those procedures which are performed to obtain audit evidence regarding operating effectiveness of internal controls. So why do I perform compliance procedures? These compliance procedures are performed to obtain audit evidence regarding what? Regarding the operating effectiveness of internal controls. Nothing but whatever internal controls which are there in the organization, are they working effectively? Basically, why we implement internal control? To ensure that, to prevent, detect, or correct frauds and errors. So now I will perform some audit procedures to find out whatever internal controls are there which are implemented by management of the organization, are they really able to prevent, detect, or correct the misstatements or not? That I will try to perform the procedures and obtain audit evidence. So that procedures I call it as compliance procedures. There is other name for compliance procedures. We even call it test of controls also. The name itself says you are testing the controls. You are verifying whether internal controls are operating effectively or not. So first we will identify risk assessment procedures, then we will perform compliance procedures to know their operating effectiveness of internal controls. Then finally, we have to go to the accounts department and start verifying the books of accounts and financial statements. So nothing but the audit procedures which we perform to know about reliability of financial information. So if you observe carefully, till the stage of substantive audit procedures, we did not verify a single entry in the financial statements. We did not check a single item of the financial statement. In the compliance procedures, we are just testing internal controls. In the risk assessment procedures, we are just understanding the entity. So actual verification of the financial information is going to happen only at the stage of substantive audit procedures. So this is the ultimate audit procedures which will give me audit evidence. Now, this substantive audit procedures can be further performed in two ways. It can be performed either by way of test of details, or even that could be performed by way of analytical procedures. Now, what is this test of details? Just you imagine as an auditor, you want to know whatever information that is presented in the financial statements, whether that is correct or not. How you will come to know about it? If I am an auditor, what I will do is I will check the supporting documents. Like a purchase entry has been written in the purchase ledger. I want to know whether that purchase entry is correct or not. How I will get to know about it? By checking the invoice. So if you check the supporting documents, that we call it as test of details. And the test of details will be of further two types. That could be test of transactions also, that could be test of balances also. If you check the supporting documents of P&L items, that I call it as test of transactions. If I check the supporting documents of balance sheet items like assets and liabilities, that I call it as test of balances. So this is what one way to check whether the financial statements are reliable or not. And the other way is analytical procedures. In the analytical procedures, I will not check the supporting documents, but instead what I do is I will try to study relationship between financial information and non-financial information to determine whether the financial information is correct or not. Like if I give example, I will study relationship between a financial item and non-financial item. Take number of employees and salary cost. So if you observe between these two items, one is non-financial item, which is number of employees, which will not be shown anywhere, whereas other item is financial item, which is going to be salary cost. And if you observe carefully, both are related. And what kind of relationship they do have? They have a direct relationship. If the number of employees are increasing, salary cost should increase. But I came to know that in the last year, the employees are 1 lakh, salary cost was 10,000 crores. In the current year, employee count increased to 1.2 lakh. What should have happened to my salary cost? Salary cost should have gone up. But to my surprise, in the current year, client has showed only 9.5 thousand crores of salary cost. So you tell me now if there is a chance of this salary expenses getting understated or not. I investigated further. I found out that management tried to underreport the salary cost. I found a material misstatement. How I found it? By checking the supporting documents? No. But instead, how did I get to know about it? By studying the relationship between financial and non-financial information. So these kind of procedures have been given one specific name. And what do we call it? Analytical procedures, we do call it. So these are three different categories of audit procedures we perform: risk assessment procedures, compliance procedures, and substantive audit procedures. And substantive audit procedures can be further done in two ways. One is test of details and the other one is analytical procedures. Now there is one more thing which we need to understand. There is a close relationship between compliance procedures and substantive audit procedures. The outcome of one procedure will decide the nature, timing, and extent of other audit procedure. Let me be very straightforward. The standard says that we perform compliance procedures, and on the basis of outcome of compliance procedures, we determine nature, timing, and extent of the substantive audit procedures. Like as I have told, in the compliance procedures, we perform two things. We perform audit procedures to know whether internal controls are operating effectively or not. So by performing compliance procedures, two outcomes could be possible. Number one, you might obtain audit evidence that internal controls are operating effectively. So if you came to know that internal controls are operating effectively, as we know, substantive audit procedures, we do it on sampling basis. If I came to know that internal controls are operating effectively, will I perform bigger sample size or smaller samples? That means, will I verify more number of transactions or will I verify less number of transactions? I will try to perform less amount of substantive audit procedures. On the other hand, by performing compliance procedures, if I find out that internal controls are not operating effectively, then I will try to verify more number of transactions. That is, I will perform more substantive audit procedures. So this is what I am trying to say here. On the basis of outcome of compliance procedures, I will determine how much amount, nature, timing, and extent of substantive audit procedures I have to perform. So this is what the important discussion regarding audit procedures. Now, why we discussed about audit procedures? Why? Because by performing audit procedures only, auditor will get what? Audit evidence. Now, let us try to understand what is this audit evidence. As I have already told, audit evidence means information which supports the auditor's opinion or information which forms the basis for auditor's opinion, that we call it as audit evidence. Now, there will be different kinds of audit evidences. So, audit evidence on the basis of form or nature, audit evidence is divided into two categories. Sorry, three categories they have been divided on the basis of form or nature. So the three categories are: one is oral evidence, second one is documentary evidence, and also third one is visual evidence. So on the basis of form or nature, evidences are divided into three categories. What are they? Oral, documentary, visual. The names itself say it. Oral evidence, which you get it by way of word spoken. Documentary evidence, which is there in the written format, either in paper form or electronic form. Visual evidence, which you get it by way of actual observation. So on the basis of form or nature, evidence is divided into three categories. Whereas on the basis of source, evidence is divided into two categories. One is internal evidence and the other one is external evidence. So the name itself says internal evidence, external evidence. Internal evidence refers to that evidence which is generated within the client's organization. Whereas external evidence refers to that evidence which is generated outside of the client's organization. Like if I give examples, purchase invoice. Purchase invoice is what kind of evidence? Internal or external? Purchase invoice is an external evidence. Why? Because if you go and buy the item, the supplier will give you the bill. If the supplier is giving you the bill, where it is getting generated, outside of the client's premises or inside the client's premises? Outside of the client's premises. So purchase invoice is an external evidence. Sale invoice is an internal evidence. Purchase order is an internal evidence. External confirmation is an external evidence. Bank statement is an external evidence. So like this, on the basis of source, evidences are divided into two categories. So like this, different kinds of evidences will be there. Now talking about next most important topic, whenever the term audit evidence is used in the subject of audit, this term will always be preceded by two terms. They will never say auditor should obtain audit evidence, but instead what the standard says, auditors should obtain sufficient and appropriate audit evidence. Most frequently used term, sufficient and appropriate audit evidence. So we need to understand, what do you mean by sufficiency? What do you mean by appropriateness? Sufficiency is actually a measure of quantity of audit evidence, whereas appropriateness is a measure of quality of audit evidence. When I say quantity, that is talking about volume, number. Like if I verify 1,000 invoices, my quantity of audit evidence is 1,000. If I verify 500 invoices, the quantity is 500. So that measure of quantity, we call it as sufficiency, whereas the measure of quality, we call it as appropriateness. Okay, agreed. Sufficiency is a measure of quantity. Appropriateness is a measure of quality. But what amounts to sufficiency and appropriateness? Which means how much quantity will be called as sufficient, or what quality will be called as appropriate? Can we say 1,000 invoices will be sufficient? Or can I say 10% of the invoices will be sufficient? Or can I say this much quality is sufficient? No, I can't say it. So what amounts to sufficiency, what amounts to appropriateness, that has to be decided by the auditor depending on facts and circumstances of each and every case, and using the knowledge, experience and training of the auditor. That in the audit terminology, we simply call it as professional judgment. So standards only will say one thing, sufficiency is a measure of quantity, appropriateness is a measure of quality. But the standards are not saying what amounts to sufficiency, what amounts to appropriateness. It all has to be decided by whom? Auditor, depending on facts and circumstances, using his professional judgment. But there are some factors which will affect this decision. Like what amounts to sufficiency, that depends on some factors. Like it depends on size of the organization. If your client is very big, the quantity of audit evidence required will be very big. It depends on effectiveness of internal controls. If the controls are effective, you will perform less procedures, less quantity of audit evidence you will have. If you came to know controls are less effective, more audit procedures you will perform. When you perform more audit procedures, you will have more quantity of audit evidence. It even depends on materiality. If the items are very material or very significant, more quantity you will obtain. And it will even depend on risk of material misstatement also. If you find the risk is very high, you will try to obtain more quantity of audit evidence. If you find risk is very low, you will try to obtain less quantity of audit evidence. It even depends on characteristics of the population also. Like if the population is a homogeneous population, if it contains similar transactions, then you ask for less quantity of audit evidence. If the population is a heterogeneous population, that means it is having different characteristics, then you keep on asking for, sorry, then you keep on asking for more quantity of audit evidence. So all these factors auditor will try to keep in mind, then he will decide how much quantity will be sufficient. Whereas what amounts to appropriate quality, it depends on relevance and reliability. So quality appropriateness means quality. Quality further depends on two things. It depends on relevance. It also depends on reliability. Relevance means how logically the evidence is connected with the given item of financial statements. Reliability means how trustable the evidence is. And reliability once again depends on form and source. Like if we talk about oral, documentary, visual, between these three evidences, which evidences will be more reliable? Documentary evidences will be more reliable. If you talk about source, between internal versus external, which evidences will be more reliable? External evidences will be more reliable than the internal evidences. So why external evidence is more reliable than internal evidence? Basically, external evidence is getting created outside of the organization. So your client's staff and the client's management will not have control over it. So that's why it is more reliable. Whereas if we say internal evidence, since it is getting generated within the client's organization, client's staff and management will have more control over it. So it is less reliable. So like this, appropriateness is quality. Quality depends on relevance and reliability. Reliability further depends on source and nature from which you are getting the audit evidence. So this is what regarding sufficiency and appropriate audit evidence. Now there is one more concept which we need to understand. What are the various methods to obtain audit evidence? What are various methods? So we have seen audit procedures like risk assessment, compliance, substantive. But in order to achieve the outcome of audit procedures, what techniques or methods we have to follow? So for performing any kind of audit procedures, we have only 7 methods which are available. So those 7 methods are going to be, let me list them out. One is inquiry, then we have observation, then we have inspection, then we have external confirmation, recalculation, reperformance, and analytical procedures. So what happens in each of these techniques? Let us try to understand. Inquiry, very simple. What do you mean by inquiry? We ask the questions, get the responses. From that, we will try to obtain audit evidence. And these inquiries may range from formal written inquiries to informal oral inquiries. When I say formal written inquiry, whatever information you want to know, whatever questions you want to ask, that you will write it on a piece of paper, and even you will expect the response also on a written format. That is a formal written inquiry. Informal oral inquiry, just as a part of our casual conversation, we'll try to extract the information. So it could be a formal written inquiry or it could be informal oral inquiry. But the problem with the inquiry is it is the least persuasive audit evidence. That means it is the least convincing audit evidence. This evidence is not that reliable. Why? Because no person will voluntarily come out and say what and all mistakes he would have done. So this is what basically inquiry is. Then what is observation? If you look at the process which is being performed by others and try to get the evidence, that we call it as observation. Like I am sitting here observing what the management is doing, how the accountant is passing the entry, and I am getting the evidence. This is observation. See, the problem with the observation is observation will give evidence, but that evidence reliability is restricted only till the point of time such observation takes place. Why? Because if the auditor is not observing, what is the guarantee the same person will do the same activity in the same manner? So observation will give audit evidence, but the problem is the reliability will be restricted only till the point of time such observation takes place. Talking about next thing, inspection. Sir, what happens in the inspection? In inspection, what we will do is documentary examination we will do. Whatever documents are there, that we will try to examine. And it even includes physical examination of assets. I go and physically examine the assets whether they are really existing or not. That we call it as inspection. So inspection involves documentary examination or physical examination of asset. Then comes the fourth technique, external confirmation. External confirmation is a direct written response obtained by the auditor from a third party like debtor, creditor, banker. Like I want to know in my client's books of accounts, there is one debtor shown for 1 crore rupees. I want to know whether really debtor is required to pay 1 crore rupees or not. Ask the debtor directly, send him a request. Sir, I came to know that you are required to pay to my client 1 crore rupees. Please confirm whether you are required to pay it or not. You want to know whether bank balance is correct or not. Send a confirmation to the banker. Ask him, sir, let me know what is the amount my client is having with your bank account. So like this, if you get a direct written response from a third party, that we call it as external confirmation. Coming to the next one, recalculation. This we basically do to check arithmetical accuracy. Accounts involve so much of calculation. I will check whether all that calculations are done properly or not. This technique is no longer required in the today's environment. Why? Because today all the basic accounting is handled by accounting software. Coming to reperformance, in the reperformance, what will happen is whatever activity that has been done by the management already, that auditor will do it once again out of his own and try to analyze whether that performance has been done correctly or not. Like management has already prepared the BRS, auditor is trying to do it once again. He's saying, I also know how to prepare BRS. So he is preparing the BRS and comparing it with the management's BRS. So this is basically reperformance. Analytical procedures, as I've already told you, here we try to study the relationship between financial and non-financial item. So like one example I have also given, we'll try to study relationship between number of employees and salary cost. So these are the 7 methods or techniques also you can say which are available for achieving the outcome of any audit procedure. So this is what the discussion regarding audit evidence, and whatever discussion we had till now regarding the term audit evidence, that has completely been taken from SA 500. So SA 500 is the relevant standard which is talking about audit evidence. Now let us start discussing the topic audit documentation. So now what basically is this audit documentation? So as we have seen that whenever auditor expresses the opinion, there is always a possibility of auditor's opinion going wrong. So we discussed a concept called inherent limitations, which means the process of auditing is suffering from some limitations because of which no matter how effectively you do the audit, there is always a chance of auditor's opinion going wrong. So you do the audit in whatever sincere manner you want, still there is always a chance of your opinion going wrong. So does that mean if after conducting the audit, if auditor's opinion has gone wrong, that means will auditor not be punished at all? No. Does that mean in all the circumstances will auditor will be punished? Definitely no. Then how to decide, sir? So what the standard says is the punishment if the auditor's opinion has gone wrong. Whether auditor will be punished or not, it depends on the facts and circumstances. So on what it will depend is if it was proven that auditor's opinion has gone wrong because of inherent limitations, which means auditor has done his job properly but still his opinion gone wrong because of inherent limitations, like he verified the transactions on sampling basis, in that sample misstatement did not come, that's why his opinion has gone wrong. Then there will be no punishment for auditor. So auditor has done the audit, he has given his opinion, but that opinion has gone wrong. Then if it was proven that the opinion has gone wrong because of inherent limitations, then there will be no punishment for the auditor. If it was if it was not proven, or if it has been found out that auditor's opinion has gone wrong because of other than inherent limitations, auditor's opinion has gone wrong by any reason other than what? Inherent limitations. That means it has nothing to do with the inherent limitations, which simply, if I have to put it, auditor was simply negligent. So if it was proven that auditor has acted in a negligent manner, that's why opinion has gone wrong, there is nothing to do with the inherent limitations, then what will happen is then the auditor will be held punished. So whether auditor will be held punishable or not, it depends on proving whether auditor's opinion has gone wrong because of inherent limitations or other than inherent limitations. So if it was proven that if it is because of inherent limitations, there is no punishment on the auditor. If the auditor is unable to prove it, then he has to face the consequences. Now, who has to prove that? Is it gone wrong because of inherent limitations or because of other than inherent limitations? This fact who has to prove? No one else will prove. Auditor himself has to prove. Now, how the auditor will prove? Will you go and swear before the judge of the court? Sir, promise, sir, I did the audit sincerely. Still, my opinion has gone wrong. So, will the judge is going to believe your swearing and all? Definitely not. So now auditor will use something called audit documentation to prove before the regulatory authorities that he has done the work sincerely, but still his opinion has gone wrong because of inherent limitations. This fact has to be proven by auditor himself, and what he will use for proving it is audit documentation. So we understood what is the purpose of audit documentation. So audit documentation is going to act as evidence in the court of law to prove the auditor. So this is what the purpose. So we understood the purpose. Let us now try to understand the meaning also. So audit documentation means it is nothing but a record of audit procedures you have performed, and by performing that audit procedures, what audit evidence you have obtained, and on the basis of that audit evidence, what are the conclusions which are reached by the auditor. Nothing but, if I put it in simple terms, whatever you have done in the audit, whatever audit procedures you have performed, whatever audit evidences you have obtained, whatever conclusions you have reached, that recorded information, we call it as what? Audit documentation. This is the most important thing in the audit. Than whatever audit you have done, what documentation you have done, what documentation you have maintained is very important. Why? Because assume that you have done the work very sincerely, you behaved in a very honest manner, but still your opinion has gone wrong. But if you don't have audit documentation to prove it, all your work will go waste. So it is not that important how effectively you are doing the audit, but it is going to be very, very important how effectively you are maintaining the audit documentation. Now this audit documentation is having other names also. We call it even working papers, or we even call it work papers, or sometimes it will be even referred to as audit file also. So everything is going to have same meaning. So if they ask you audit documentation or working papers or audit file, all the three collectively refers to the same thing, which is nothing but record of audit procedures performed, audit evidences which you have obtained, and whatever conclusions that you have reached in the audit. So this is what the audit documentation is. Now there are some concepts regarding this audit documentation. Let us try to understand them. Let us try to revise them. So let us go to the relevant topic in our material. So what is audit documentation? So audit documentation means nothing but, as we have seen, it is a record of audit procedures performed, audit evidences, whatever you have obtained, and conclusions which the auditor has reached. So all this information collectively, we are going to call it as audit documentation. There are other names for it. We even call it working papers, or we even call it as audit file also. And that audit documentation can be maintained either in physical form, or it can be even stored in electronic format also. Now, a few more concepts, like what is the purpose of audit documentation? Why do we basically require to maintain audit documentation? As I've already told you, maintaining audit documentation will act as a evidence in the court of law, whether you have done the work properly or not. And even it will act as evidence that you have done the audit as per standards on audit, not as per your own wishes. And if you maintain proper audit documentation, you will be able to betterly guide your engagement team members. So audit documentation will assist the engagement team members to properly plan and perform the audit. And also it will help for better supervision and direction of the work done by engagement team members. And not just that, it will even make them accountable for their work. So they will feel more responsible. In the audit documentation, even I will store which work was allocated to which person. So if tomorrow something goes wrong, I can refer to my audit documentation, call the concerned person, whoever has done that work, and punish him. So tomorrow the article assistant or somebody else, they can't simply skip saying, I am not the person who has done the work. Why? Because there is a record available. So in this manner, even engagement team members feel more responsible while doing the work. And it will even help you for doing audit of future years also. It will even help you to plan and perform the audit of future years. And it will enable any internal inspection to happen. If at all someone wants to do internal inspection, like as a auditor, I want to know whether my team is doing the work properly or not. If I want to review the work of my team, if there is documentation, I will review the work. If there is no documentation, what review I will do? No review I will be able to do. Not just any internal inspection, if at all any external inspection has to happen, like some outside authorities wants to come and do the investigation whether auditor is doing the work properly or not. If documentation is there, review will happen, be it internal review or external review. If there is no documentation, there is no concept of review only. So maintaining documentation will help the auditor to achieve these many purposes. Now, so what should be the form of documentation? What content should be there in the documentation, and who should be the owner of that audit documentation? Let us see. Talking about format. So when it comes to format, there is no format prescribed in the standard. Standard did not give you any specified format, and they are not saying auditor should maintain the documentation in this format only. But instead, what they have told is you maintain the documentation in such a manner that some other experienced auditor having no previous connection with this audit, he should be able to understand what audit procedures we have performed, what results we have obtained, what conclusions we have reached just by going through your documentation. The standard is not giving any specific format for documentation, but instead what they are saying, maintain documentation in such a manner that some other experienced auditor having no previous connection with this audit, just by going through the documentation, he should understand what audit procedures were performed, what conclusions were obtained, what evidence were obtained, and what conclusions have been reached. Just by reading my documentation, you should get that understanding. And this documentation should be prepared on a timely basis. You have to complete it on a timely manner. Don't delay it. As and when you perform the audit, you collect the documentation. Don't try to delay that collection of the documentation. And what contents will be there in the documentation? All my audit programs, nothing but my audit plans will be, or whatever my plan of audit is, that will be documented. Whatever analysis we have done, that will be documented. Whatever evidences we have gathered, and significant matters, any important matters which we found out, that will be documented. Whatever confirmations and representation letters, whatever confirmations we are getting from debtors, creditors, bankers, so all that will be documented. And whatever significant matters are there regarding that, whatever communication we had, and who performed the audit, who reviewed the audit, in simple terms, whatever we do in the audit, everything has to be documented. And whatever audit documentation which you have created, that is whose property? Is it auditor's property or client's property? It is containing whose information? Client's information. So it is whose property? Auditor's property or client's property? The standards have clearly told audit documentation is always the property of auditor. Auditor is the owner of audit documentation. Agreed, it contains client's information. Agreed, it contains information regarding your client's operation. But who collected it? Auditor. Who gathered it? Auditor. Who assembled it? Auditor. So it is going to be whose property? Audit documentation always and always is the property of auditor. Now, if the client is coming to the auditor and asking them to share the copies of audit documentation, is the auditor under a mandatory obligation to share the copies of the documentation with the management? No. So what the standard has told us, it is up to auditor's choice. They use the phrase discretion, which means it is up to auditor's choice. If he wants to share the documentation with the management, he will share it. If he doesn't want to share the documentation with the management, he will not share it. That is completely up to the decision of auditor. It is his property. The standard is giving you exclusive ownership. You decide whether you want to share the documentation or you don't want to share the documentation, even with the authorities also, even with the client also. However, if there is any legal or regulatory requirement, then auditor must submit his documentation to the legal and regulatory authorities. There you should not do the overaction. I am the auditor. I will have my ownership. You should not say it. If there is any legal or regulatory requirement, share the documentation compulsory with the regulatory authorities. And now, for what period you have to maintain the audit documentation? How long you have to store it? Can you throw that documentation away immediately? No. What the standard says is audit documentation should be retained for a period of 7 years. How many years documentation should be stored for? For 7 years, audit documentation has to be maintained from the date of auditor's report. Then, coming to the next concept, now this audit documentation or audit file should be maintained in two categories. One is permanent audit file and the other one is current audit file. Now, what are the differences between permanent audit file and current audit file? Very simple. Whatever documentation which will help me not just in the current year, if I feel that audit documentation will help me in the future years also, that I will store it as a part of permanent audit file. On the other hand, if I feel that some documentation will help me only in the current year, it will not have any usage in the future years, that I will store it as a part of current audit file. So depending on usability of the documentation, you have to store it either as a permanent audit file or as a current audit file. So that's what they say. Whatever documentation that is of continuing importance, that is which is useful for subsequent years, it will go to permanent audit file. Whereas whatever documentation which is used only for the current period, which have no chance of using it in the subsequent period, that will go to current audit file. So some examples also they are saying here. So like in the permanent audit file, you will have those documents which are related to legal and organizational structure like MOA, AOA. This will not change year after year. So generally I will store it in the permanent audit file, or some legal documents, ownership documents. This also will go to permanent audit file. And whatever understanding and evaluation which you have done regarding internal control, this will also go to permanent audit file. Why? Because year after year, internal controls will not change. Analysis of significant ratios and trends, copies of the audited financial statements, etc. So these kind of documents which will get used in the next years also, that will be stored in permanent audit file. Now coming to current audit file, some examples like your annual reappointment letter, and also important current year's general meetings and board of directors minutes, and copies of the management letters, analysis of some transactions and balances. So like this, whatever I feel which will get used only in the current year, which will have no usage in the next years, that I will store it as a part of my current audit file. Next one more concept. What is audit notebook? Generally, whenever we go for audit, we will also get one, we will, as a part of our documentation, we will maintain one more notebook called audit notebook, in which variety of matters we will record. Especially mainly we record our queries. So daily while doing the audit, we get lot of queries, we get lot of doubts, but we humans are tend to forget. So we might not remember the queries, we might forget it. So in order to keep a track of all our issues which need further clarification, so all that queries will be recorded in a document called audit notebook. And whatever queries you have recorded, not just recording the questions, even you need to write their state of disposal also. So if you came to know that queries are resolved, you should write a comment there what response you have obtained to resolve that query. In case if the query is remaining unresolved, that I will do the follow up till the time I get the response, so that you will not forget. That is what the main purpose of maintaining audit notebook. So that's what they say. In order to avoid any chances of such issues being unanswered, the auditor generally records them in a separate notebook. Nothing but whatever queries you got, you have a chance of getting them forgetting them. In order to avoid that, you have to write it in a separate notebook, which we call it as audit notebook. And generally for every client, we have to maintain one separate notebook for each client separately. And what kind of contents will be there? Basically whatever contents will be there in the documentation, all that contents will be there in the audit notebook also, like name of the business enterprise, what is their organizational structure, their copies of MOA, AOA, and with the previous auditor if you have communicated that communications, management representation. Like if you observe carefully, whatever contents are there in the audit documentation, that only will be there even in the audit notebook also. So this is what the concept regarding audit notebook. And as a part of this audit notebook, we have seen a term called our, as a part of this audit documentation, we have seen somewhere that our audit documentation includes audit programs also in this question if you observe. Now what basically is this audit program? If I put it simply in simple terms, whatever your plan for the audit is there, that itself we call it as audit program. Nothing but in which area, how much time you are spending, which work was allocated to which person, within how many days you have to complete the audit, what techniques you have to follow in that area. So like that, we will try to have one detailed plan in a written format, which contains time which we have to spend in that concerned area, which person has to do that work, what instructions he has to follow, how much verification he has to do. So like that, a detailed plan, whatever you are supposed to do in the audit, all that things should be written down in a proper format. That itself we call it as a audit program. In simple terms, if I have to put it, a detailed plan of the audit, what and all you have to do in the audit, that we will try to write it in a document, give it to our staff and ask them to follow all that instructions along with the time limits. That we call it as audit program. So that is what this particular question is about. So an audit program is nothing but a detailed plan of auditing work that you have to perform, which is specifies even what audit procedures you have to perform. And this plan should be in a written format also. And what we can do is when it comes to audit program, either we can have one standardized audit program which is suitable for all types of audit. Along with that, depending on requirements of each and every client, some special program also you should have it. Why? Because one single set of plan will not work for all the clients. Clients to client industry changes, businesses changes, transaction changes. But some common programs will be there. So whatever can be done in all the audits, that we will have one common audit program. But depending on requirements of each and every client, whatever special plans we need to have, that we will maintain special program also. So there can be common audit program applicable for all the clients. In addition to that, there can be even special program also which will be applicable depending on the requirements of each and every client. Now, by maintaining audit program or by developing audit program, what advantages will be there? Since audit program contains all the instructions which has to be followed, so it will act as a ready checklist of audit procedures. So you will have less chance of missing out some area. Why? Because detailed instructions are there. You have to follow it. And this the audit work can be properly allocated. Even you can properly allocate the work by having one proper plan. And the auditor may easily know extent of work done at any point of time. So we are halfway through the audit. I want to know till what stage my team has done the work. I can take the assistance of audit program and determine to what extent work has been performed. And audit program would not only be useful for audit assistance in carrying out the audit work, it will even help the principal too, as it would help him in fixing responsibilities. Using audit plan, I can fix the responsibilities also. So which person has done which work. So tomorrow if in that area something has wrong, I will go to the concerned person only. I will not shout at all my engagement team members. And if you have a proper audit program, that will help you for planning the audits of the next years also. And it can be used as evidence in the court of law if someone is blaming you. And you can betterly select your team members, and even he can prove that there is no negligence. Once again, similar point like evidence only. This point and this point both are trying to convey the same thing. So now audit program will not have just advantages, it will even have disadvantages also. Now what will be the disadvantages of audit program? So one of the most argument regarding this audit program is, since we are giving all the instructions which are required to be followed, audit staff might feel that their work is becoming more and more mechanical. They might feel that their work is very boring. Why? Because there is no scope for applying their mind. So they will be given a list of instructions. They have to follow that as it is. This is what some people's argument, that article assistants might feel that their work is becoming very mechanical in nature and they might lose the interest in doing the audit. And also for small entities, you don't need a audit plan or program separately. Why? Because entity itself is very small. You can just like that finish it off. And sometimes some inefficient staff will defend themselves by using this audit program. Assume an audit assistant was negligent. He found some mistake, but he did not report it. So when principal asked him why you did not do this work, he's simply saying, this you did not say it in my instruction. So like this, lazy staff, inefficient staff may hide before this audit program to defend themselves. And also, you cannot have a single standardized audit program which can be suitable for all the businesses. As I have told, client to client businesses changes, transactions changes, nature of doing the business changes. So you can't develop one single audit program applicable for all the clients. You have to customize it for every client. You have to customize it. So that is also going to be a time consuming activity. So audit program is not just bringing advantages, it is even bringing disadvantages also. Now talking about the next topic, which is regarding assertion. This is also one more important topic which we need to revise. Assertion. So what is basically assertion? Assertion means nothing but the representations which are made by management. Representation means nothing but whatever information management is conveying regarding items of financial statements, that representations only we call it as assertions. Now, all the assertions, all the representations done by the management need not be done expressly. The assertions can be even implied assertions also. So, what I am trying to say. So, if you take any balance sheet, assume in the balance sheet, management has shown fixed assets at a value of 100 crores. Now, by showing this fixed assets for a value of 100 crores, management is trying to do so many representations, which might not be expressed, which are so much implied. Like by showing fixed assets as 100 crores, management is trying to say that fixed assets worth 100 crores are existing with the company as on balance sheet date. This we call it as existence. The management will not state it expressly, but just implied. By showing fixed assets as 100 crores, management is trying to say that fixed assets worth 100 crores are existing with the company as on balance sheet date. And also they are making a assertion that fixed assets are completely recorded without missing out anything in the financial statements. This we call it as completeness. And also they are saying that they are the owners of this asset rights, and also they are trying to convey that they have valued all their assets properly, then the value came to 100 crores. Similarly, if you take any borrowing has been shown at 50 crores. Regarding these also so many assertions are made, so here also they are trying to convey that borrowings worth 50 crores are existing with the company as on balance sheet. They have completely recorded all the borrowings, then the value came to 50 crore rupees. They did not miss out anything, and they are having obligation to pay that 50 crore rupees, and they have valued all the liabilities properly, then the correct value came to 50 crore rupees. So all these things whatever I have told, these are nothing but representations made by management, which I call it as assertion. Management might not expressly state it, but all these are what implied. Similarly, if we take any P&L item, regarding P&L item also they will give assertions. Like if you take revenue, but for revenue there will not be assertion called existence. Why? Because assets and liabilities we will see whether they are existing with the company as on balance sheet date. For revenue and expenses, we will not check existence, but instead we will check occurrence. Whatever revenue that has been shown, whether that has occurred during the year or not. Then even they are making a representation regarding completeness. That means they have recorded all the revenue completely, then the correct value was so and so amount. And even they are making an assertion that regarding cutoff, which means whatever revenue they have shown in the financial statements that belongs only to current year, none of the prior year's revenue, none of the future year's revenue has been recognized in current year. And also here they are making a assertion called measurement. That means they have measured the revenue properly at correct amount, then only correct value has been determined. So all this whatever I have told you here, everything is an assertion. So who is saying all these assertions? Management is saying assertions. Are they expressly saying it? No, all these assertions are implied. And when I am doing audit, I will try to obtain audit evidence regarding these assertions only. Like if I am verifying fixed assets, what I will try to verify? I will try to verify whether fixed assets are in existence or not, whether fixed assets are completely recorded or not, whether the company is the owner of that assets or not, whether the valuation of the assets has been done properly or not. So if I check the revenue transactions, there also I will try to get evidence regarding these assertions only. Whatever revenue that has been shown, whether that has taken place during the year, is the revenue they have completely recorded it, and does the revenue belong to current year, and also whether the revenue has been measured. So these are the assertion means nothing but representations which are made by the management, and these are the only assertions which auditor will try to obtain audit evidence. So let us try to proceed further now and revise a few more concepts. So in the previous revision, I forgot to revise one more concept. Let me do it now. So with the concept regarding that is audit engagement letter. So what is basically this audit engagement letter, or simply we even call it as engagement letter. So what exactly is this engagement letter? As we all know, in any commercial transaction, there is always a chance of misunderstanding between the parties to the contract. Like for example, if I agreed to provide some services to some customer, now there could be a possibility in future we might have some sort of misunderstandings which can create a conflict between us. Like any other commercial transaction, even audit is also going to be a commercial transaction only. So simply we chartered accountants or cost accountants, we agree to provide audit services to the client. Client in return agrees to pay us the audit fees. So like any other commercial transaction, even audit is also going to be a commercial transaction only. Like in any other commercial contract, there is a chances of happening of misunderstanding between the parties to the contract. Similarly, in audit also, there could be a chances of misunderstanding. So if you look it from the other transactions perspective, like for example, there is a person who is a landowner. He entered into one contract with some builder for the purpose of construction of the building in that land owned by that landowner. So now various terms and conditions were orally agreed. What quality of cement has to be used, what quality of raw material has to be used, how many floors are required to be constructed, what are the payment terms, all these things they have orally agreed. But there is no written record. So in these kind of circumstances, this is what I was referring. If there is no written agreement, there is a chances of misunderstanding between the two. Like in this audit also, we agree to provide some services. Client has agreed to pay us fees in return. Here also there could be a chances of misunderstanding. Like what? Like as we all know, auditor is required to do the audit. Management is required to prepare financial statements. But after I have accepted the audit, the client is asking the auditor to prepare the financial statements. Is it a forming part of our auditor scope? Definitely not. So these kind of, now there will be a case of conflict there. Auditor will say, no, I will not prepare financial statements. Management will say, you have to prepare financial statements. So like this, there are chances of misunderstanding even in the audit also. What we can simply do in order to overcome all this misunderstandings, one simple step will resolve all the problems. What is that single step is, whatever terms and conditions are there, all the terms and conditions relating to the contract should be mentioned in a written document signed by both the parties to the contract. That alone will be enough to solve the conflicts between both the parties. That's what we basically do in our normal commercial transaction. The same thing has to be done even in the audit also. Whatever terms and conditions of the audit, scope of audit, rights of audit, duties of auditor, fees of audit, mode of payment, time for completion of audit, all the terms and conditions should be put down in a piece of paper. Auditor should sign it, client should sign it, both should keep one copy. That written document which contains the terms and conditions of the audit, that we call it as audit engagement letter or letter of engagement. What is simply meaning of audit engagement letter? A written document which contains terms and conditions relating to the audit. Now, as per the standards, who is supposed to prepare the engagement letter? The standards always will say auditor shall prepare the engagement letter and give it to the client and get it signed by him. And if you remember, we have divided audits on the basis of applicability of law into two categories. One is statutory audit, other one is non-statutory audit. Now, in which kind of audit, the audit engagement letter is very, very important. So if you observe carefully, in the case of non-statutory audit, the engagement letter is very, very important. Why? Because in the case of statutory audit, as we know, scope, rights and objectives will be decided by law. In this case, even if you don't have engagement letter also, still you need not worry about if there is any conflict, we can take the help of the law to resolve the issue, where in the case of statutory audit. But in the case of non-statutory audit, if there is no engagement letter, no law will come to the rescue of the auditor or the client. So why? Because non-statutory audits are those audits which are not mandatorily required under any law. Since there is no law itself, if any disturbances come, no one will come to our rescue. So that's why in the case of non-statutory audit, engagement letter is highly recommendatory. Now, what and all contents should be there in the engagement letter? Let us try to quickly go through that contents also once. Let me show you the material and revise it quickly. Yeah. So here we have engagement letter and or letter of engagement. So all the introduction I have told, and SA 210 is the relevant standard which is talking about how to prepare the engagement letter. And this engagement letter, when it will be prepared? Before the commencement of the audit, not after the commencement of audit. Before the commencement of the audit, we have to prepare the engagement letter. Next one, what and all are contents of the engagement letter? That means what information should be included in the engagement letter. Like if you see, what is the objective of audit and also what is the scope of audit, what are management responsibilities. You should also mention there are inherent limitations and also management's confirmation letter, restrictions and limitations if any on the auditor, what is the basis for computation of the audit fees, billing arrangements, nothing but mode of payment, what is the form of report, in what format you have to give the report, till what time the report will be valid, and limits on submission of report to other authorities. Is there any requirement to submit the reports to any regulatory authorities also? Like this, whatever terms and conditions are there, all the terms and conditions has to be included in the written document before commencement of the audit. Auditor shall prepare it, he should sign it, give it to the client, and also get it signed from the client. So this is what the concept of engagement letter. Now we will try to revise one more concept. The next chapter we'll try to revise now. So we have one chapter called internal controls, then we have internal check and internal audit. So like this, we have three concepts. With this, we have a chapter titled chapter with the title internal control, internal checks, and internal audit. So first, let us try to basically understand what is the meaning of this term internal control, what is the meaning of the term internal check, and what is the meaning of internal audit. Then we will try to revise all the technical aspects regarding them. Now, first of all, what do you mean by internal control? Internal control, as we have already seen earlier, any policy or any procedure which is getting implemented, any policy or procedure which is getting implemented by whom? Management of the company. For what purpose? To prevent any mistakes from happening. That policies and procedures, we simply call it as internal control system. Any policy or any procedure which is getting implemented by management to prevent, detect, or correct frauds and errors in the organization, that we simply call it as internal control mechanism. Now, what is basically internal check? If I give examples of internal controls, there are plenty. Like any policy you take in the organization, if you go and visit any supermarket store, you will be checked before you enter inside the premises. That is an example of internal control. Once you do all your shopping, when you come out of the premises, security guard will check what items you are taking, whether they are included in the bill or not. Internal control. If you want to enter into any IT company, they will allow you inside only after you have provided your identity card and biometric. Internal control. Or having CCTV cameras installed at the premises of the companies, internal controls. So like that, there will be plenty of policies and procedures which will be implemented by the management to prevent, detect, or correct the frauds from happening, that we call it as internal controls. Now, what is internal check? Internal check refers to such a process where the work will be divided among the employees in such a manner that the work done by the previous employee will be automatically checked by the next employee. So what is basically internal control? It is the division of duties among the employees in such a manner that the work performed by one person will be automatically verified by another person. If I have to put it simply, internal check means it is a part of internal control only, I will say. Internal check is actually a part of internal control system. Like if you go to the bank and you want to withdraw some check, what will basically happen? First, what we do is we go to the concerned bank, we go to the clerk there, give the check to concerned employee. Now he will sign and do some validation and all, and he will ask us to go and approach some another person. If we go to the another person, he will check once again all the details, signature, all these things he will check. Now once again he will route us to one more person. Now if we go to one more person, he will also do one more checking whether signature is matching or not. So all the rounds of checks will happen. Then finally they will give us the payment of money. So if you observe in this process, we have gone to three employees in the bank. So first person has verified and given you the token number. Second person has verified the signature. Now third person will verify signature once again, token number once again, and after all this, if he is satisfied, then only he will give payment. So here if you observe, the work done by each person is getting reviewed by another person. The work done by this person is getting reviewed by another person. So this division of responsibilities among the staff in such a manner where work of every person will be verified by the work of another person, that we call it as internal control system. And internal control is actually a internal check system, and internal check is actually a part of internal control. Then talking about internal audit, in the recent times, one more robust audit mechanism is evolving, which is internal audit actually, which is almost different from the company audit. So we will do company audit, but apart from the company audit, there is one more audit called internal audit. So the name itself says it is something which is internal to the organization. Whereas company audit, whatever we have seen is that is external. Some outside party will come and do the audit, whereas internal audit, an internal person only will come and do the audit. And here In the case of company audit, the auditor's objective is to only express opinion, whereas when it comes to internal audit, the auditor's objective is to create the value creation to the company. That is what the objective of creation of the introduction of internal audit. And company auditor will only verify financial information. The company auditor will internal auditor will verify financial information, operating information, internal controls, laws and regulations. So like this, the scope of internal auditor is much wider than the company auditor. And in the case of company auditor, only a person will come after the end of the financial year, spend some 20-30 days in the organization, sign the audit report and go away. But internal auditor will be continuously associated with the company. So what is the expectation of the industries? They thought that in big companies and listed companies, having company audit alone will not protect the interest of the shareholders or outsiders. They need some even more robust mechanism where a person will be continuously associated, value will be created, not just financial information, all the operating information, internal controls, laws and regulations should be verified. With that intention, they have brought this concept called internal audit. So these are what the three terms which are used in the title of the chapter: internal control, internal check, and internal audit. Now there are some concepts which are associated with these terms: internal control, internal check, and internal audit. Let us try to understand what are they. First of all, why internal control, internal checks, or internal audit systems will be required is because of audit risk. Or auditor will basically face some risk by doing audit. Do you think auditor will face the risk by doing some audit? Yes. That's what we have seen even in the inherent limitation also. No matter how effectively you do the audit, there is always a possibility of auditor's opinion going wrong. You do audit with whatever sincerity you want, but still the opinion given by the auditor can go wrong. If the opinion given by the auditor goes wrong, regulatory authorities will ask the auditor explanation why his opinion has gone wrong. Whether he will be punished or not, keep it aside. But you have a responsibility to prove that you have done the work sincerely, but still your opinion has gone wrong because of inherent limitations. This burden of proof lies on you. That itself is a risk which you are facing. Yes, by doing audit, there will always be a risk associated with the audit. Can I eliminate that risk completely? Can I say, I'm doing the audit and I'm giving my opinion. Now my opinion will never go wrong. My opinion will be guaranteed. Eliminating the risk means that. If I say I have to eliminate the audit risk, that means if I am saying that I have done the audit of this company and I have given the opinion, my opinion will not go wrong. So whatever opinion I have given, that is not just an opinion, that is guarantee. Can I say that? No, I can't say that. So audit risk can never be eliminated. And even you can put it in other way, audit risk cannot be reduced to zero, which means no matter whatever you do, there will always be a audit risk associated. So first of all, what is the meaning of audit risk? Audit risk means risk of expressing inappropriate opinion, when the financial statements are materially misstated. So the definition is a bit tricky here. Let us try to have a look at the material and revise it. Right. So define the term audit risk. If you see here, the risk of expressing inappropriate opinion when the financial statements are materially misstated, which means the financial statements are containing a material misstatement, but what auditor is doing? An inappropriate opinion you are giving. Which means if the financial statements contain material misstatement, you are supposed to give modified opinion. This is what you are supposed to give. But instead of giving modified opinion, auditor is giving inappropriate opinion. That means he is giving unmodified opinion. This will be termed as what? Audit risk. So if you give unmodified opinion, when which opinion is appropriate? Modified opinion is appropriate. That we call it as audit risk. Whereas if you give modified opinion when unmodified opinion is appropriate, which means financial statements are not containing any material misstatement, you are supposed to give unmodified opinion, but still what you are doing is you are giving modified opinion, this will not come under audit risk. Why? Because if you technically have a look at the definition, so what they are trying to say here is the risk of expressing an inappropriate opinion when the financial statements are materially misstated. That means financial statements contain material misstatement, which means you are supposed to give modified opinion. But if you are giving unmodified opinion, this will be coming under audit risk. Whereas you are supposed to give unmodified opinion only, but still if you are giving modified opinion, that will not come under audit risk. However, audit risk also does not include business risk faced by the auditor. When I say business risk, like loss of clients, loss of reputation, non-receipt of fees from the client, all these are business risk. Audit risk will not include the business risk. Audit risk is something which auditor has to face legally, whereas business risk are something out of his practical limitations, etc. So audit risk does not include business risk. And this audit risk is made up of two components. So what are the two components of audit risk means? The two components are going to be, so audit risk is going to contain two components. One is risk of material misstatement and the other one is detection risk. Now what is this risk of material misstatement and what is this detection risk? So risk of material misstatement means simply the chances or possibility of happening of material misstatement. In the financial statements, if you find any chance of happening of financial statements, that chance or possibility we call it as a risk of material misstatement. Like I was observing the company's premises. When I observed the company's premises, I am able to find that there is no internal control implemented at the warehouse, no CCTV camera, nothing is there. So that will cause it, that there is a chance of happening of misstatement in inventory or not? Yes. So this chance of, this possibility of happening of misstatement in the financial statements, that we call it as a risk of material misstatement, one of the component of audit risk. And this risk of material misstatement is further made up of two components. One is inherent risk and the other one is control risk. Now what is this inherent risk and what is this control risk? So broadly what I am trying to say here is audit risk contains two components. One is risk of material misstatement and other one is detection risk. And risk of material misstatement is further divided into two parts. One is inherent risk, other one is control risk. Now what is this inherent risk and control risk? Let us try to understand it with the help of example. So assume there is an organization which is protected by three internal controls: internal control 1, internal control 2 and internal control 3. And after having three controls also, still a misstatement has happened. Misstatement 1 has happened, misstatement 2 has happened. So now misstatement 1 has happened because there is a absence of internal control system. There was no internal control system to prevent the misstatement 1 from happening. Whereas misstatement 2 happened, to protect that internal control is also there, but internal control failed miserably to prevent that misstatement from happening. So this absence of internal control, I simply call it as inherent risk, whereas this failure of internal control is there, but that has failed to prevent the misstatement from happening, that I call it as control risk. So both will collectively create risk of material misstatement. So risk of material misstatement means the chance of happening of a misstatement in the financial statements. This can happen either because of inherent risk or it can happen either because of control risk. Inherent risk means absence of internal control system, whereas control risk means failure of internal control system. Now talking about the other component, detection risk. Now what is detection risk? Detection risk is the risk that the audit procedures which are performed by auditor may not be able to detect a material misstatement which has already happened in the financial statements. So what do you mean by detection risk? Whatever audit procedures the auditor has performed. He has performed the audit procedures, but those audit procedures were not able to detect a material misstatement. That means there is a material misstatement in the financial statements. And generally, we auditors perform audit procedures to identify them. So with that intention, we perform the audit procedures. But whatever audit procedures that we have performed, those are unable to detect a material misstatement. That we call it as detection risk. So both the risk of material misstatement and also detection risk both collectively create the audit risk in the organization. So this is what the concept of audit risk and the this is what the audit risk and also the components of audit risk. Now let us talk about few more concepts regarding internal control systems, etc. So as we have seen, internal control can be defined as any policy or procedure which is adopted by management of an organization for what purpose? To achieve the respective objectives, basically to prevent the frauds and errors from happening. So that policies and procedures we call it as internal control. So if you take any internal control, that any internal control will be implemented with some objectives. What will be the objectives of that internal control? So mainly the main objective of any internal control will be safeguarding the assets, protecting the assets of the company. Like if you install a CCTV camera at the warehouse, what is the purpose of that internal control? To protect the assets. Which assets? Inventory. So most of the internal controls will have a direct objective of safeguarding, protecting the assets. And also some internal controls will be implemented to ensure orderly and efficient conduct of business, to have proper conducting of the business. Like for example, banks will undergo maintenance, server maintenance they will say. During that point of time, we will our bank server will not work. What do you think is happening in during that maintenance time? They will try to check the systems, they will try to do that backup facilities and all. So this is also one internal control. So why the bank is doing this maintenance activity? To ensure proper functioning of the business, so that there will not be any bugs further, the systems will not get stuck or hanged. So in order to avoid that, the banks will have a policy of scheduled maintenance. That is a internal control for efficient conduct of business. Or the management will keep some policies to ensure compliance with that policies. Also internal controls can be implemented. And as I have told, one of the main objective for prevention and detection of frauds and errors. And some internal controls will be implemented to increase the accuracy and completeness in the accounting records. Nothing but to make the financial statements more reliable, to make the books of accounts more reliable. Also some internal controls will be implemented. And sixth point is also more or less same, to ensure the timely preparation of financial information. So these are the various objectives with which internal controls can be implemented. Now talking about what are the important elements if you want to have strong internal control system, what characteristics it should have, or what features an internal control should have. So first of all, whatever internal controls you want to design, that should be in line with the financial and organization plans. At a broad level, every management will have some organizational plans, they will have some financial plans. So whatever controls that we want to implement, that should be in line with the financial and other organization plans. It should not be like financial plans are saying something, your internal controls are doing something else. It should not be like that. Our internal controls should be in line with financial and also other organizational plans. We should have capable staff, competent people we need to have, who are knowledgeable, who are efficient to work enough. Why? Because when I have to implement internal control, I need to take the help of various staff. So if my staff are capable and competent, internal controls will work effectively. If my staff are not competent, not capable, no matter how effectively you design internal controls, they will not work effectively. Next, there should be proper division of work. Internal control should be designed in such a manner that the work is divided among different people. Not like simply internal check, you can say. Work should not be given in the hands of only one person from beginning to ending. The work should be divided. Then separation of custody of assets from accounting. This in the simple terms we call it as segregation of duties. Those people who are maintaining the accounts, the same person should not be given the responsibility to keep the custody of the assets. Like if you take cashier, cashier is responsible only for handling the cash. That means he should collect the receipts, he should make the payments. He should not be given the power to pass the cash entries. This simple control we call it as segregation of duties. Same with inventory also. The person whoever is receiving and issuing the inventory, the same person should not be made to maintain the inventory records. So the person whoever is handling the asset, the same person should not be given the custody of the asset. Segregation of duties should be there. Proper authorization mechanism. So there should be proper approval mechanism. Just like that, any employee, any of the staff cannot incur expenditure on their own. It needs some top level management's approval. And there should be continuous managerial supervision and review. Top level management should continuously review that internal control. So if these elements are there, then the controls will function effectively. So what are they? What are the elements of internal control? They should be in line with financial and organizational plans. They should have competent personnel. There should be division of work. Segregation of duty should be there. proper approval mechanism, and there should be managerial supervision and review. See, when they ask you advantages, no need to remember any separate points. Whatever objectives we have seen, the same objectives will even come under advantages also. So when they ask you objectives or advantages of internal control, we can write the same thing. So even if you read the points there, more or less the same things will be there. Then talking about various types of internal controls, controls will be basically divided into two categories. One is preventive control and the other one is detective control. As the name itself says, preventive controls are those internal controls which are there to prevent the mistake from happening. Like if I give you some example, like if you see here, preventive controls are those controls which are designed to discourage the errors or irregularities. They will try to stop the errors from happening first of all. Like segregation of duties. If we are dividing the duties among cashier and accountant, why we are doing it? To prevent a fraud from happening. So we are addressing the root level problem here. We want to reduce the chance of happening the fraud at all. So that we call it as preventive control. Like examples also they have given segregation of duties or approval, authorizations, verification mechanism, security of assets, like appointing a like appointing a security guard. So these kind of things we call it as preventive control, which are implemented to prevent altogether a fraud or error from happening. Whereas, as the name itself is saying, detective control. What do you mean by detective control? Detective controls are something which are implemented to detect the fraud which has already happened. Hope you are able to make a difference here. So preventive controls will altogether implemented to stop the fraud or error from happening. Whereas detective controls are implemented to ensure that once the fraud or error has happened, to identify them, to detect them, detective controls will be implemented. Like one simple example, if I have to give, we'll prepare the BRS. No, why we'll prepare the BRS? To reconcile why the difference has come between bank balance as per bank statement, bank balance as per cash flow. So the simple preparation of BR is the detective control. We are doing it to detect any error or fraud which has happened, or even reviewing the performance after the employees have done the work. We are checking. Why we are checking it? To detect whether they have found anything, whether they have done anything wrong, and even physical verification of inventory. So periodically they will go, periodically we'll try to do physical verification of the stock. Why we do physical verification of stock? To know whether the stock is matching as per the records or some stock is missing. Once again, a detective control. So depending on the purpose which the controls are achieving, they are broadly divided into two categories: preventive control, detective control. Now, talking about inherent limitations. Now, what is this concept of inherent limitation is, no matter how effectively we implement internal control, the internal controls also will give only reasonable assurance. That means even if you effectively in 100% in a perfect manner you have implemented internal control system, still there is a possibility of frauds or error happening. Why? Because like the way audit is suffering from some inherent limitations, even internal controls are also suffering from some limitations which are unavoidable in nature, which cannot be avoided no matter whatever you do. So because of that inherent limitations, even internal controls also will provide only reasonable assurance. They can't give you guarantee, which means no matter how effectively you implement internal controls, still there is always a chance of happening some frauds and errors. Why? Because of what reasons? So the thing, the inherent limitations have been highlighted here, like breakdowns. Even a perfectly designed internal control also can break down. Why? Because the people who are required to implement internal control, they might not understand the instructions, because of which errors can happen. You have to train the staff properly in order to implement internal control. Assume I have appointed a security guard. I asked him to check each and every customer who is entering inside, and also I gave him some other instructions. But at the time when the training is happening, he was not careful and he did not understand why he was getting appointed there. If it doesn't know the basic purpose of the internal control only, can you expect the internal control to work effectively? No. So like this, people might misunderstand the instructions. That's why the controls can fail. And by the end of the day, internal controls are designed by humans. And we humans are always wired in such a way, we tend to make some mistakes. Sometimes what could happen is there could be a error in the design of the control itself, which can make the internal control fail altogether. And also management themselves might override the controls. Who will implement internal controls? Management. When they have designed the internal control, they even know how to override it also. Sometimes management themselves will try to override the controls. That means they try to violate the rules which they themselves have set in order to achieve their own objectives. Like the recent scams and all, P10B scam and all these scams have happened because of management themselves overriding the internal controls only. And internal controls also can be overridden by collusion among the staff. Like cashier, accountant, both people's duties are segregated. We told that cashier will be responsible only for collection of receipts and accountant will pass accounting entry. Now what is happening is this cashier and accountant both are colluding with each other and they can commit a fraud. Like cashier is saying to the accountant, I will bring 20,000 from the cash box, you pass a fake entry, we both will share the proceeds. Collusion simply. So like this collusion also can make the internal control to fail. And control over common business activities. Internal control system is suitable only for common activities and repetitive business activities. See, we can't expect something which will happen once in a while. We basically implement internal controls, whatever we regularly think of. But always a mistake can happen in a new way which we did not think of, that can also make the controls fail. So because of these inherent limitations, and even one more thing they are saying, costly system. Implementing internal controls is not going to be a simple effort. It involves a lot of investment. It involves a lot of recurring expenditure also. So what some organizations will do is, because of these costly systems, they will try to design the controls, but they will not effectively implement it. So all these inherent limitations will make the internal controls fail no matter how effectively you implement it. Now coming to the techniques, using what techniques you will try to evaluate the internal controls. Evaluating means understanding internal controls. So how do you evaluate internal control system? What techniques are available? So let us try to have a look at them. So there are four techniques which are available for evaluation of internal control system. So what are the four techniques which are available for evaluation of internal control system? Number one is narrative record. Number two, we have checklist. Number three, we have internal control questionnaire. And the last one, we have flowchart. So let us try to understand what happens in each of these techniques. So first, flowchart, which we will start with something which is easy to understand. First, we'll start with flowchart. So what is basically flowchart? So as we all know, flowchart means a diagrammatic presentation of internal control. So here also what will happen is, first we will try to understand what is happening in the internal control system. Then we will try to visualize, we will try to summarize whatever understanding we had regarding internal controls in the form of a chart. So that diagrammatic presentation of internal control, we call it as flowchart. Whereas when it comes to narrative record, here also what I do is, first I will try to observe internal control process, what is happening in the internal control system, how the goods are moving, what processes are happening. So all this I will try to understand even in the narrative record also. But instead of presenting it in a diagrammatic format, what I will do is, I will do an exhaustive description of internal control. Nothing but in a detailed paragraphical manner, I will try to explain. So the only difference between flowchart and narrative record is, flowchart is a diagrammatic presentation. Whereas in the narrative record, what I will do, I will try to explain it in a detailed manner. Whatever I have understood, whatever I have observed in the internal control system, everything I will try to exhaustively describe in a detailed manner. I will describe that. I call it as narrative record. Between narrative record and flowchart, which one is most concise or briefest? So the most concise or briefest is a flowchart. That means it is a short form of presentation of internal control. Whereas narrative record is a very exhaustive description. So it is going to be very time consuming activity. Which one will give better overview of internal controls? Always flowchart will give better overview of internal controls than when compared with the narrative record. Now let us come to two most frequently used techniques for evaluation of internal controls. One is checklist and the other one is internal control questionnaire. Now what is the difference between the two? In both the cases, what will happen is, I will try to draft a series of questions regarding elements of internal control system. Both in the checklist and internal control questionnaire, who will draft the questions? Auditor will draft the questions. Regarding what he will draft the questions? Regarding the elements of internal control. And the questions will be drafted in such a manner that answers will be either yes, no, or not applicable. So in both checklist and internal control questionnaire, auditor is going to draft a series of questions, and the questions will be drafted in such a manner that answer will be yes, no, or not applicable. Sir, if in both the cases, if it contains series of questions, and in both the cases also questions are drafted in the format in which answers are yes, no, or not applicable, then what is the difference between the two? The difference will come is who is going to answer. In the case of checklist, that questions will be answered by auditing staff. That means my staff itself will answer it. Whereas when it comes to internal control questionnaire, that questions will be answered by management or client's staff. That is the only points of difference between the two. Like if I'm following checklist, I will prepare questions. I will call my article assistant, give it to him, ask him go to the concerned area of the organization, come back to me with the answers. This is checklist. Why? Because I'm asking my staff to get the answers filled. On the other hand, if I take this list of questions, go to the management and ask them, sir, I have given these questions. You please get back to me with the answers. Either management will fill it or client's staff will fill it. So if I'm asking the client's staff to get back to me with the answers, that I call it as internal control questionnaire. So both are very widely used methods in the market. So these are the four methods of evaluation: narrative record, checklist, internal control questionnaire, and flowchart. So depending on facts and circumstances, the auditor will decide which technique he will make use of. So these are all the key concepts regarding internal control system. Now let us try to revise a few concepts regarding internal check. As I have told, internal check means it is a process in which the duties of various staff of business are arranged in such a way that work performed by one is automatically checked by the next staff while performing their duties. So that as a part of this verification, if any errors are committed by the previous staff, it will be automatically detected. And even the example has been given, that process for presentation payment of the checks. And one more thing, internal check is an integral part of internal control system. So why do we implement internal check system? Why we need to divide the duties among the people? Why? Because it will lessen the possibility of fraud. That means it will reduce the chances of happening of the fraud. And also you can identify the fraud or error at an early stage. You need not wait till the completion of the year to identify the error. It will be identified as a part of regular activities only. And it will even improve the efficiency of workforce. Nothing but if errors are identified early, they will make the changes to their work and make sure that these kind of errors will not happen again and again. In that manner, the efficiency of workforce is increasing. And also allocate the duties and responsibilities of each worker in a way that it can be easily identified and held responsible. So if you divide the duties among different people, if something goes wrong, you need not get confused whom to blame. Why? Because since we have divided the duties, if something has wrong, we'll go to the concerned person, whoever has performed the activity, and make him only responsible. And it will exercise moral pressure, nothing but a pressure on the employees, a control on the employees. Even if they have a thought of committing a fraud, this internal check will act as a control. Why? Because they will have a fear that this will be verified by next higher level of authority. So that's why the employees might stop themselves from committing the errors and frauds. And it will even reduce the workload of the staff. Since work is divided among all the people, the individual workload on each person will get reduced. Why? Because work is getting shared. So this is what regarding internal check. Now let us try to understand the concept of internal audit. So as and what does the sections of the Companies Act say? Section 138 is a relevant section of the Companies Act, which is giving some guidance regarding internal audit. So let us try to understand what is the meaning of internal audit, which companies are mandatorily required to undergo internal audit, who will appoint the internal auditor, who can be appointed as internal auditor. Let us try to have a understanding of provisions of the Companies Act. So as I have told, first meaning is internal audit is also a independent management function which involves continuous and critical appraisal, review of functioning of an entity with a view to suggesting improvements. I never told normal auditor will give suggestion. Why? Because normal auditor will only express an opinion. But internal auditor, what he will do? He will not just express opinion. He will even give what? Suggestions. And he will try to strengthen the overall governance mechanism, including entities risk management, internal control system. So this is what I have simply called it. He will add the value to the organization. Value addition will be there because of internal auditor. External auditor will just give the opinion and go away. But internal auditor will not just give the opinion, he will find out weaknesses, give the suggestions for improvement, and he will try to strengthen the company. And which companies are required to undergo internal audit? So does every company required to mandatorily appoint internal auditor? Not required. There is a applicability criteria. What is that criteria? Listed company. If your client is a listed company, no need to check any criteria. For all the listed companies, this internal audit will become applicable. In case if the client is unlisted public company, we need to check any of these four conditions. They need to comply with any of the four conditions for internal audit to become applicable. So let me tell you shortcut how to remember. So remember the figures like this. It will start with 25, 25 to 50, 50 to 100, and 100 to 200. So now which amount is for which item of the financial statement? As we all know, the biggest figure in the financial statements will be turnover. So what is the biggest figure? Biggest figure here? 4. So fourth one, 200. So now one condition is turnover should be 200 crores or more during the financial year. If they have a turnover of 200 crores or more during the immediately preceding financial year. Generally, very limited number of companies will have deposits, and even if they have deposits, also very smaller amounts. So smallest figure is 25 if the outstanding deposits are 25 crores or more. Next one. And remaining we have 50 and 100 in the ratio of 2 is to 1. As we know, ideal debt equity ratio is 2 is to 1. So 2 is 100 here. Outstanding borrowings from banks, financial institutions of 100 crores or more, and 50 is paid up capital if they have a paid up capital of 50 crores or more. So if they satisfy any of these four conditions, if I have to revise it once again, if they have deposits of 25 crores or more at any point of time during the preceding financial year, the most important term here is at any point of time. So let me highlight it here. Outstanding deposits of how much? 25 crores or more at any point of time, not just on the balance sheet date, at any point of time during the preceding financial year. At any point of time, even for one single day also, if the outstanding deposits is 25 crores or more during the immediately preceding financial year, internal audit becomes applicable. Number two, second condition is what? Paid up capital. So if you see paid up capital of 50 crores or more during the preceding financial year. Next, outstanding borrowings of 100 crores or more. So here, outstanding loans or borrowings from banks or public financial institutions exceeding 100 crores or more, here also at any point of time during the financial year. And then we have turnover 200 crore rupees or more during the financial year. So remember this shortcut: 25, 50, 100, 200. Generally bigger figure will be revenue or total turnover. So 200, turnover 200 crores or more. Smallest figure will be deposits, 25 crores or more. And remaining 50 and 100 in the ratio of 2 is to 1. So that's why paid up capital equity should be greater than or equal to 50 crores. Outstanding borrowing should be greater than or equal to 100 crores. And even some private companies are also required to appoint internal auditor, but they also need to fulfill any of the two conditions only. Here they say only two conditions. Out of the above four conditions, only two. Amounts are also same. Turnover of 200 crores or more, outstanding loans or borrowings of 100 crores or more at any point of time. So only these companies are required to mandatorily make an appointment of auditor, internal auditor. Now, who can be appointed as internal auditor? They say a chartered accountant, whether in practice or not, a cost accountant, whether in practice or not, or such other professional as may be decided. So the summary is not just chartered accountant, not just cost accountant. The company can take a decision to appoint any other professional also as an internal auditor. Then, who will decide objective and scope of internal auditor? It will be decided by the management. If audit committee is there, audit committee will decide. If audit committee is not there, board of directors, after consultation with the internal auditor, objective and scope of the internal auditor will be decided. So these are the key concepts from internal audit, internal control, internal check, and internal audit. So now I want to revise a few more last things as a part of this marathon. In the audit of items of financial statements also, there are some special items which we will be revising now, which are very frequently and very regularly tested in the examination. So let us try to revise that audit of various items of financial statements. In that also, not all the items of the financial statements we are revising. We are going to revise that special items which are very frequently tested, and with that we will end our marathon revision. So let us go to special items, audit of items of financial statements. So in the audit of items of financial statements also, as I have told, we'll not be doing all these regular things. There are some special items which will be very frequently tested. that we will do. Yes, here we have audit of special items. Question number 21, if we observe here, alteration of share capital. If you are conducting audit of a company and if you came to know that your client has done the alteration of share capital, that means they have either done consolidation of the shares or splitting of the shares. So in such cases, how you will verify this alteration of the share capital? Some list of points they have given here. First of all, the audit procedures to be applied in this matter of alteration of share capital is: first thing we need to check whether the alteration of share capital was authorized by articles. First, there should be a clause written in the articles of association authorizing the company, approving the company that yes, this company can do alteration of share capital. Only if it is authorized, then only the alteration of share capital can be done. If there is no authorization, now the resolution of the shareholder shall be passed. Update the articles first, then only alteration can be done. So without authorization from the articles of association, alteration of share capital cannot be carried out. And also, before this alteration of share capital will happen, board of directors shall conduct a board meeting, and in that board resolution should have been passed. And even general meeting of the shareholders should be conducted. In that also shareholders ordinary resolution will be required. Now, if there is a alteration of share capital, first there should have been approval from board of directors and shareholders or not. They should have passed board resolution. How I will come to know whether board resolution and shareholders resolution has been passed or not? How auditor can get to know about it? Simply by verifying the minutes of board meeting. So first check whether the alteration of share capital is authorized by the articles, and also verify the minutes of the board meeting and also general meeting to check whether approval of the members has been obtained or not. And also you shall verify that alteration has been effected in the copies of memorandum and articles. Nothing but whatever alteration of the share capital you have done, whether that respective changes are updated in memorandum and articles also. And you shall check that whether there is any change in voting percentage of the shareholders due to consolidation and division of all or any of its share capital into shares of larger numbers than its existing shares. Generally, what will happen is because of alteration of share capital or because of consolidation or division of the share capital amount, there should not be any change in the voting percentage. Why? Because assume that if there are total 10,000 shares outstanding, now each share has been split into 10 shares. Now after splitting, how many shares will be there? 10,000 into 10, 1 lakh shares will be there. Earlier, I used to have 100 shares in the company. If I have 100 shares, or let me, okay, so I am having 100 shares earlier in the total 10,000 shares. So I will be a 1% shareholding. Now, since for each share 10 shares are issued, after my splitting of the shares, I will have 1,000 shares. Now total quantity of shares will become how much? 1 lakh. Now 1,000 in 1 lakh also will be 1% only. So because of alteration of share capital, there should not be any change happening in the voting power. That's what they are asking you to check. Check whether there is any change in voting percentage of shareholders because of alteration. Generally, it should not happen. Next one, he has to confirm that the alter share capital's denomination should be more than 1 rupee. Sorry, it should be more than 1 rupee. That means the fair value of the shares, the share capital should have a face value of minimum 1 rupee. They can't split the shares for less than a value of 1 rupee. So that we should check that. After alteration, it should be the share face value should be more than 1 rupee. And check that for this alteration, proper accounting entries have been passed in the books of accounts, and even the register of the members also should have been updated. So very simple 6 points they have told. First one, check the authorization by the articles, verify the minutes of the board meeting and general meeting, and check the resolution. After doing this alteration, check whether proper adjustments has been made in memorandum and articles. And because of this alteration of share capital, there should not be any change happening in the voting percentages. And after alteration, we need to make sure that the shares are having a face value of 1 rupee minimum, and proper accounting entry should have been given in the books of accounts and register of members. Now, next, one more concept: how to verify the bonus shares, issue of the bonus shares. Let us try to check what points we need to verify here as an auditor. So first, here also we need to check whether that bonus shares, issue of the bonus shares, was authorized by articles of association. First, there should be a explicit permission. And here also verify the minutes of the board meeting and also general meeting to check whether resolutions are passed at the board meeting and also general meeting. And we need to make sure that company should issue only fully paid bonus shares, that too to its members only, not to the outsider. When I say bonus shares, you should give it to existing shareholders. Bonus shares will not be given to any new or outsider. So fully paid, and that too not partly paid bonus shares. The issue of bonus shares should be fully paid bonus shares, that too issued only to their members. And we should check that the bonus shares are not issued by capitalizing reserves created out of revaluation of assets. You should not use the revaluation reserves for issue of the bonus shares. Then, before that bonus shares should be made, the company should not have made any default in either payment of interest or payment of principal in respect of their fixed deposits or debentures or other debt securities. Which means the condition of the Companies Act is if the company has made any default in payment of principal or interest to any of the fixed investments or debt instruments, they can't give the bonus shares. Why? Because debentures will have creditors will have upper hand when it comes to collectability, no? So that's why first the company should meet the outside obligations. After that, if the reserves are left, then only it should be utilized for issue of the bonus shares. So check that if the company is giving the bonus shares, they should not have done any default in either the repayment of principal or payment of interest to any of the debenture holders or deposit holders. And also I should make sure that if the company is giving bonus shares, they should not have made any default in payment of statutory dues like employees contribution to pf gratuity, etc. If they are not paying this pf gratuity, etc. to the employees, first they should clear out all that, then only they can issue bonus shares. Next one, he shall check whether partly paid shares are made fully paid up. So first, if there are any partly paid shares, first they should be made fully paid up, then only bonus shares should be issued. And one more important point, the bonus shares shall not be issued in lieu of dividend. So these are the points which we need to check for issue of bonus shares. Okay. So coming to the next one, see, splitting of the shares, nothing but it is one of the alteration of share capital only. So all the points will remain common. No need to have any separate revision. Now let us try to have a look at how to verify reissue of the forfeited shares. So sometimes company will forfeit the shares for non-payment of call money or by some defaults done by the shareholders. And once the shares are forfeited, they can reissue it once again. So in case if your client has first forfeited the shares and then reissued the shares, how do you verify this reissue of the forfeited shares? Let us have a look at them. So here also the auditor should ascertain that board of directors has authority under articles of association. Common point. First there should be a approval in the first there should be a clause in the articles of association permitting the board of directors to reissue the forfeited shares. And even check the board resolution. How to check the board resolution we already know by going through the minutes of the meeting. And whatever amount that has been collected by reissue of the forfeited shares, I have to watch that amounts collected. I have to verify that amounts collected with entries in the register of members. And also I should check that total amount received prior to forfeiture and total amount received now by reissue of forfeiture should not be less than par value of the shares, which means face value. For example, earlier the shares are paid up to the extent of 5 rupees. The face value of the shares is 10 rupees. Now the reissue price should be minimum 5 rupees. So they are saying that the auditor should check that total amount received on the shares, including received prior to forfeiture. Prior to forfeiture, you should have received some money. In our example, I am saying 5 rupees. And by reissue, you will receive some money. Both put together should not be less than face value of the shares. That means total amount collected from that forfeited shares should be equal or more than face value. It should never be less than face value. And if you receive any surplus out of the reissue of the shares credited, that should be taken to capital reserve. If you are getting a surplus on the reissue of the shares, that has to be taken to the capital reserve account. And in case if the company has reissued the shares and the amount is less than face value, then it has to be considered as issue of shares at a discount. Then we need to check the provisions of section 53 has been complied with or not. Like if I read this point, where partly paid shares are forfeited for non-payment of call. and they are reissued as fully paid shares, then the reissue will be considered as allotment at a discount and compliance of the provisions of section 53. I have to see. That means we have first the company has forfeited the shares. Why? Because the previous shareholder did not pay the call money. Now these shares are issued as fully paid up, reissued as fully paid up shares. This will be considered as what? Allotment of the shares which has happened at a discount. And in case if the shares are allotted at discount, section 53 is going to tell a lot of rules and regulations. I need to check whether that section 53 related rules and regulations are complied with or not. Very simple. So simple 4 points they are saying. Check the authorization by the articles of association, board resolution. Verify the amount received, verify that total amount received because of reissue and total amount received prior to the forfeiture should not be less than face value. And in case if you are receiving any surplus out of it, take it to capital reserve account. And if the non-payment, if the shares are forfeited because of non-payment of the call, and if these are given as fully paid up shares, then it will be considered as allotment of shares at a discount. I need to check whether provisions of section 53 of the Companies Act are complied with or not. Then talking about how do you verify issue of the debentures, what things I need to check. I need to check even in the case of issue of debentures also, prospectus has been filed with the register. A copy of the prospectus should be submitted with the register. Check that. And whatever amount that has been collected, that you verify with counterfoils of the receipts, nothing but the duplicate copies of the receipts. And also cross check the amount into application and allotment book, nothing but try to match the amount collected with multiple sources. And verify the debenture trust deed and try to understand what terms and conditions are written there. And if the debentures are covered by a mortgage of a charge, nothing but if the debentures issued are secured debentures, check that whatever asset that has been given as security, whether that has been updated in the register of mortgages and it is also registered with ROC. If the company is giving secured debentures, they will give some asset as a security. No, that details should be updated in the register of mortgages. And also this information should be submitted with register of companies also. And even SEBI guidelines will be there for issue of debentures. Check the compliance with that SEBI guidelines also. And in case if the debentures are given as settlement, not for cash, debentures are given as a settlement to the vendors, I need to check that contract in this regard has to be verified. Because of what contract, because of what settlement you are giving this debentures, I need to go through the contract and find out terms and conditions. So these are the points which I need to verify regarding issue of the debentures. Similarly, redemption of debentures, here what they ask us to do is first check the debenture or debenture trusted deed. So in that trusted deed, terms and conditions will be there, like whether redemption will happen at a discount or it will happen at a premium. So try to understand the trusted deed, understand what are the terms and conditions of the repayment of debentures, and check that whether the repayment is happening only as per conditions mentioned in the trusted deed. And also see the director's minutes book authorizing the redemption, nothing but whether dissolution has been passed or not, check the minutes book. And watch the redemption with the help of debenture bonds cancelled. If you are repaying the debenture bond should be cancelled. No, so with that you try to cross verify, and also you try to verify the entry in the cash book. And even you should check whether proper accounting treatment has been effected or not. So we need to pass proper accounting entries giving proper treatment for this repayment of debentures. Now, few more questions like final dividend and interim dividend. So both are more or less same. So I will revise final dividend quickly. So if the company is paying dividend, what we need to verify? First of all, check the minutes of the board of directors meeting containing board resolution. Similarly, check the shareholders meetings minutes also to check whether whether the shareholders have approved the resolution recommended by the board of directors. So as we know, the procedure for declaring the dividend, first board of directors will recommend it. Now the shareholders has to approve that dividend which is recommended by the directors. So check both board of directors resolution and also shareholders resolution. And also the auditor should check that dividend has been calculated appropriately. Nothing but check the calculation part. And ensure that the provisions of the Companies Act has been complied with. As we know, when it comes to declaration of dividend, Companies Act will give you so many rules and regulations. Whether all that rules of the Companies Act has been complied for declaration of dividend or not, I need to check. And one more thing, whenever the company has declared dividend, that amount should be transferred to a separate bank account. That too within how many days? Within 5 days from the declaration of dividend. Once the dividend is declared, all this money is required to be transferred to a separate bank account. That too within how many days? Within 5 days from the date of declaration of such dividend. and I should check that the dividend has been paid only to rightful owner. For that, he need to verify dividend register, bank statements, all that you verify, and make sure that dividend has been paid only to the correct owner. And the auditor should verify whether sufficient effort was made by the management to distribute the dividend within how many days? Within 30 days from the date of its declaration, the dividend should have been distributed. So check all these points regarding final dividend. More or less, interim dividend also will contain similar points that you can go through it. Now, one more last aspect regarding unpaid dividend. What if there is a unpaid dividend? What are the things which we need to check? So first thing what they say is collect a statement or collect a list of every detail regarding unpaid dividend. Like which shareholder, what is the name of the shareholder who did not get that dividend, what is the dividend amount payable, dividend warrant number which has been given to him, and what is the reason why the dividend is remaining unpaid. So ask the management to give me a list regarding this unpaid dividend, to which shareholder, name of the shareholder, what is the amount payable, what is the dividend warrant number, what are the reason why the dividend is unpaid till now. Ask the management to give me a complete list. Now the auditor shall conduct an inquiry to identify whether there was any fault on part of the company. That means as the dividend is remaining unpaid because of the fault from the company's side, check it. If yes, whether proper action has been taken by the company or not. Next, the auditor should verify other supporting documents like dividend register, returned warrants, bank statements. Nothing but you will transfer the money to a separate account. If the dividend is not paid, that should remain in the bank account or not. Try to check in the bank statement. And even warrants should have been returned. Check with the returned warrants, and even check with the dividend register. And what even this is, the auditor shall verify that unpaid dividend has been transferred to a separate account, namely unpaid dividend account. That too within how many days? Within 7 days from the expiry of 30 days allowed for declaration and payment of dividend. Nothing but company will declare the dividend. Now within that 30 days, so assume that company declared the dividend on 1st of January 2022. Now within 30 days, the dividend should have been paid on or before 31st of January 2022, dividend should have been paid. Now within this 31st of January also, if the dividend is not yet paid, from this within 7 days, that unpaid dividend should be transferred to a separate account, unpaid dividend account. Like that, an account has to be opened in the bank account. To that account, money has to be transferred, that unpaid dividend has to be transferred within 7 days from the expiry of 30 days from the date of declaration of dividend. And the auditor must verify whether there is any fault on the company for transferring this amount. Check whether the company has made any default in transferring the money within 7 days. If yes, then the company has to transfer the money along with interest and penalty, not just unpaid dividend, even interest and penalty also they have to deposit. And the auditor shall verify company should publish all the details of the unpaid dividend in their official website and also in any other website which is approved by the government. And any payment of previously unpaid dividend must be verified by the auditor to see that the same has been paid to the rightful owner. See, now this all unpaid dividend will remain in a separate account. If tomorrow that particular shareholder is coming and asking the dividend back from the company should pay it from that account. So check that if any unpaid dividend is getting paid later, verify whether that unpaid dividend is now getting paid to the rightful owner or not. And in case the amount will remain in that unpaid dividend account, in that it will be there for 7 years. Till the time of 7 years also, still if nobody is coming and claiming that unpaid dividend, then all that money is required to be transferred to Investor Education and Protection Fund. So money will remain in unpaid dividend account for how many years? 7 years. Within this 7 years, if any shareholders comes and claims it from the company will pay. So now within 7 years also, if no one is coming and claiming that unpaid dividend money, now after the expiry of 7 years, that amount will get transferred to IEPF. The auditor should also verify whether all shares in respect of which unpaid dividend has been also transferred to IEPF, not just the dividend amount, the shares against which that dividend is unpaid, that shares also should be transferred to IEPF. And for that 7 years, the money is remaining in the unpaid dividend account, no? That money along with interest accrued, everything will be transferred to the IEPF. So this is what I thought of revising, guys. So we have covered so much of the concepts, whatever things we have revised, that will easily cover some 35 to 40 marks in the examination. We all hope that our marathon and revision has been very helpful for you. So all the very best for your exams. Do well and do great in your exams. All the very best, guys.